All right. Test, test, 1, 2, 3.
Thank you all for joining us today. I call this meeting to order at 8:39 a.m. And we'll start with the Pledge of Allegiance. Ms. Ginsburg, would you like to lead us? Thanks. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Bonnie, do we have any Linda, do we have any announcements?
Bonnie, please join the meeting.
Bonnie.
Thank you, Ms. Sanchez. This meeting is being conducted as a virtual and an in-person meeting. So I will do roll call of the trustees to confirm attendance. Ms. Ginsburg?
Here.
Mr. Santos?
Present.
Mrs. Jones?
Here.
Mr. Jones?
Present.
Ms. Sanchez?
Here.
Ms. Gray from the Board of Retirement, and we have Mr. Green, David Green, Mr. Kelly, Mr. Jason Green, and Mr. Rue absent. Trustees, staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, CEO Santos Kryman, Chief Counsel Stephen Rice, Deputy CEO Louis Lugo, and Interim CFO Ted Granger. Investment staff include Vache Masaragian, Magdalia Armstrong, Krista Powell, Cindy Rivera, David Simpson, Daniel Joe, and Calvin Chang. Consultants and presenters include Jean Boyven of BlackRock, Tim Filla, Asen Killick, Imran Zahid, Leandro Festino of Makita, Nick Collier of Millimit, and Ashley Dunning of Nossman Group. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Thank you. Do we have any requests for procedure under AB 2449?
We do not.
All right, moving on to the welcome. So I just want to welcome everyone to LACERA's offices, where we don't normally hold our offsite because it's on site, but thank you for pretending with us. And I hope that the next couple of days will be informative, illuminating, and for us, for the board, this is a working session to kind of move our thinking forward and really kind of get our heads around the direction that we're headed, and so that we have at least some consensus and agreement coming out of this meeting. Those are my goals and my hopes. And with that, I will turn it over to Mr. Grable to make a few opening comments as well.
Thank you, Madam Chair. Today will be different. The onsite, I'll stand here as opposed to sitting there. So it's beginning differently. And like the chair, I look forward to a productive 2023 Board of Investments onsite. An offsite, onsite, or onsite, offsite. We can debate the order of that over the next day and a half. There are lots of people involved in producing the materials that we have in front of us for the next day and a half. The planning began many months ago. It was a full organizational effort. It's not just the investment office, but it's folks throughout the organization, and also a big thanks and shout out to the people who traveled many miles to be here today and tomorrow. So thank you, thank you everyone who was involved. The materials that we have, hopefully we use them, but not too much. I hope that they're there more as a guide to facilitate dialogue and engagement, as opposed to just us making presentations. To me, that would be the basis for not the most optimal offsite. The sessions that we'll have over the next day and a half are based upon BOI input. There was a vote, and so the materials and the sessions and the themes really are constructed or a result of input from the board. And so I took those and tried to come up with a theme. So maybe this is a little corny, but I'll give it a go. So the theme is at LACERA, we talk a lot about being good. And I think that we are good. However, so that's like the comma, forget everything you say, that's before the comma. We are good, but good is not our destination. Good is not our destination. It is part of a continuous process that we're engaged in. So this offsite is about that continuous process, the fact that good is always just slightly beyond our reach, yet at the same time, it's important for us to celebrate small victories. So we'll celebrate some small victories because they are important, but they also provide some context such that good becomes closer and good becomes better. So the offsite, well, we have 6 sessions over the next day and a half, and we have 2 about the environment being the macroeconomy, and that will be the first session this morning. And then we have 1 about capital market expectations this afternoon. We have 2 sessions on oversight, also today, 1 on governance, which will be our second session this morning, and then our funding policy, which will be our second session this afternoon. Then we have 2 sessions tomorrow, 1 on the investing framework, which is about risk management. And then the second is learning. There's been a lot of talk about how we become a learning organization, or are we a learning organization? And the learning that we'll discuss tomorrow is the evolution of the portfolio, specifically what has worked and why, what has changed and why, and how both of those really position us, for tomorrow, such that good is better and better is tomorrow and each subsequent day beyond that. So the 6 sessions will be over the next day and a half. They'll be followed by a more formal board meeting tomorrow. There'll be plenty of foods and breaks. Downstairs on the first floor is where all the food will be. I think our first break is scheduled for 10 a.m.-ish. And I hope that everyone enjoys and engages in what will be a really productive offsite. So thank you, everyone.
Thank you, John. And thank you to all of the staff and the entire everybody who had a hand in today and tomorrow. So with that, I will ask, do we have any public comment?
We do not have any comment.
Okay, so moving on, let's have Magdalena Armstrong, Magdalia Armstrong and Jean Bovin? Jean. All right, there you go. Who will be discussing the macro environment.
Okay. Thank you, John, for that great introduction, and welcome everyone to the first session of the offsite. If you look up macro in the dictionary, one of its definitions says large scale overall. It's wide-ranging, and in the context of the macroeconomic environment, it changes every day regarding themes that are top of mind for investors. If we go to slide 4, please. And thank you, Cindy, for running the slides today. You just go to slide 4. Thank you. So observing the left side of this slide, there are many factors complicating today's environment, from supply chain disruptions, demographics, and interest rates, to name a few. LACERA is a significant investor and is acutely aware of the environment. And on the right side of this slide, you can see LACERA's current strategic asset allocation. The portfolio has evolved throughout its lifetime and continues to do so. And as John mentioned, one of the sessions tomorrow, you'll get to hear about the evolution of the portfolio. And with respect to the other topics that you'll be listening today and tomorrow, they all require a thoughtful approach to best prepare LACERA to overcome challenges to ultimately meet its mission. Jean Boivin with BlackRock is joining us today for this session. His bio is located in your materials, where you'll see his prior work and education experience. He is a managing director and leads the BlackRock Investment Institute, which generates proprietary research on macroeconomics, sustainable investing, geopolitics, and portfolio construction. Thank you, Jean, for joining us today, and the floor is yours.
Great. Thank you very much. It's a great pleasure to be here, and very happy to spend the next few minutes to engage in the discussion here on the macro environment. And what I'm planning to do is maybe start by giving you the broad lines of our framing around this environment, the challenge we're seeing, and hopefully that leads to spark some questions and that we can engage on. But as you will see, and I even before I go into the key point in the presentation itself, like the key words you'll hear throughout are about this being a new regime, a new environment, where the old playbook that has worked well for the last 20, 30, 40 years cannot be assumed to continue to work. And that leads to rethinking about, to maybe borrow from what John was talking about. I think it needs to at least to rethink about how we achieve good. And actually, I think this is really about, this is not about the destination as he was saying, but this is really about rethinking the process that leads to that outcome. And that's really the way we think about this. We've been thinking about this for the last few years at BlackRock. So that's going to be kind of, hopefully gives you a teaser of what I'm trying to build for the next few minutes, but let's build it. So I'm going to spend a few minutes describing why this is a new investment regime. We think this is driven by some very big fundamental forces. That new regime, when we say that, oftentimes leads people to be scared or to think of it about like, this is bad for return, this is bad for, this is bearish. We think actually it's not, but we need to pivot to new type of opportunities. And that's about identifying those. So we cannot, again, assume the old playbook will continue to work. And then I'll try then in the third piece to try to drive more directly to what it means in terms of implications for investors and for portfolios. So with that, let me first move to what I think is slide, well, it's labeled as slide 4. It's a few slides ahead of what we have here. This one, perfect. Managed to convey information without actually saying anything. This is where we have even telepathy working here, which is great this morning.
Quality staff that we have.
Exactly. I mean, clearly, can read my mind. Scary. So we have, we think, ahead of us, and it's been at play for the last couple of years, big fundamental forces that are changing and are very different from the last 40 years prior to 2020. And you'll see, we will talk about the pandemic and how it affects the near term, but we think the pandemic has kind of masked the turning point in these forces for a couple of years. And now we're kind of like getting on the other side, and we're facing a pretty different world than the one before 2020 as the pandemic hit. So I'm going to talk about three big forces that are changing and that have profound implications about the investment landscape. The first one is on the geopolitical front. We are seeing geopolitics now being geopolitics has always been a consideration for investors. Let me just start by saying that it's not like we were ignoring geopolitics until recently, but something has changed over the last 2 years. And the way I would summarize that is that before the last 2 years, geopolitics was something that you would think about, but more as a contingency plan. If something happens, what do we think is going to do to portfolio? It was in a risk discussion type, and not something that you could necessarily do anything in advance because these were binary events, maybe with low probabilities. So you could not really position for this, but you would want to prepare on how you would be reacting. We think things have changed over the last 2 years. Geopolitics now is not only a contingency plan or risk discussion, but it is something that drives how we think about investment return. It is actually a live source of risk as we speak now, and it is something that investors globally are taking into account now and wants to be compensated for the risk that it represents. We have the strategic tension between the U.S. and China as clearly being a live example of that. But there's more broadly, there is a reorganization of the geopolitical landscape, which after 30 years of globalization in one direction, where it was about Washington consensus, was about like trying to get to international rules that everybody would agree with, things are materially different now. And that means that has a few very important implications. The first one is when you think about investing in emerging markets, for instance, we used to look at that space, think first about what the macro landscape looked like, what the policies of the central banks were like. Then we would look at the debt of these countries. We would look at the balance sheet of the companies you're investing in. That would be the classical way of looking at the emerging market landscape as an investment destination. Whereas now, maybe the first starting point to analyze opportunities is the voting pattern at the UN Security Council. So how countries are positioning themselves in this geopolitical landscape is in our mind now a much more important lens to apply and think about how things will evolve in emerging market than maybe the fundamental analysis would have been in the past. So that's one of the key implications. What you have on this chart is our BlackRock geopolitical risk indicator, which measures the attentions of markets on risk, on geopolitical risk. The Russia invasion of Ukraine, as you can see here, has led to a spike in the attention to geopolitics. It has waned. That doesn't mean geopolitics is not important. That means it's not like in the headline of the news right now, but we think underneath that, this has been a big game changer. The other implication of this is that it leads companies to think differently about their global operation. And as a result, there's a dynamic now where companies needs to take geopolitics explicitly into account, needs to think about building buffer insurance or resilience against the geopolitical risk. And they'll do that by diversifying their supply chain, for instance. This is the onshoring discussion we're talking about. This is about being able not only to manage the geopolitical risk, but like pandemic risk, be able to shift production more easily. And one implication, macro implication of this is that after 30, 40 years of one-way globalization that was all about efficiency and driving down costs globally, this landscape I'm describing here is one where this is more about resiliency than efficiency. It means about building duplication of supply chains, but ultimately what I'm driving at is that it is a world where it's going to lead to higher cost of production. Because taking into account geopolitics, building resilience comes at a cost. So to summarize, 3 key points here on the first trend. It is something that always was in the picture, but now is driving return, and it's a consideration where investors need compensation for that risk. The second is that the lens to apply to emerging market has changed, and now there's more of a geopolitical lens that needs to be applied as a starting point. And the third is that there's a macro implication on cost, which will lead to some of the points I will make on inflation in a minute. Shifting to the next big trend on the next slide, demographics is a huge story that we think is underappreciated. Even as we analyze where we are currently in the US state of the economy. This is an unprecedented situation for the US. I've seen people aging in retirement like we've never seen before over the last few years. Again, this has been masked by the pandemic, because during the pandemic, we got a big shock to the labor market. We got a lot of people leaving the labor market during that period. But if we had not had seen the pandemic, there would have been this demographic evolution that would have lead to people leaving the labor force anyway. They might have decided to leave a bit earlier as a consequence of the pandemic, but we are saying, and this is what the chart on the right-hand side here is showing, we're seeing a massive decline in the U.S. labor share of. We've seen a massive decline in the U.S. labor share of income over time. As labor was abundant, but this is turning. This is turning. We think the labor market right now is tight, not because the economy is healthy. The economy is not too bad, but it's not like roaring. The labor market is tight because there's not enough people to work, because a lot of people, because of demographics, are leaving the labor force. It gives the appearance of a never seen market that we've never seen as tight. And I think it leads oftentimes to the wrong inference that the economy is healthy, whereas in fact, it's the opposite. It's demographics that is putting pressure on the labor market that is holding back the labor market and activity. And we think our view is that much of the discussion is having the causality the wrong way. It's the labor market is not a manifestation of a healthy economy. The labor market is a manifestation of demographics that are driving a stagnating economy, as we see it right now. One of the key implications, I mean, there's a lot of implications of demographics, what it means for the fiscal outlook for the US, what it means as a result for how we think about treasuries in portfolios. But it has one implication that is macro, which is on inflation. We have a tight labor market that's going to lead over time, in our view, to, and it's going to be persistent because, the Fed raising rates will not change the demographics. This structural trend is there. It's going to continue to put pressure on wages. The Fed can try to maintain or reduce those pressure, but there's going to be pressure on wages. And this is where the labor income share that we see has been trending down since the 60s. We think might be starting to go back on a higher path. And so that's a shift that means higher cost of production as well. That's going to be part of the inflation story. It also means that we're going to be in a world where workers might be will be able to get a bigger share of the overall income generated. That has implication on how we think about corporate profits going forward, and equities, valuation of equities as a result of that. So that's the second big trend. I tend to get overexcited on stuff, so and I feel I'm getting overexcited here. So I'll move forward, and you can signal to me, hurry up when you feel that's the need. But the next big trend on the next slide is the transition to the low carbon economy. This is happening. So no matter what we think about what is desirable for the world, what is the right path to be on, the reality is that there's a shift happening. We've done a lot of work at BlackRock to develop our own view on how the transition is likely to evolve. We focus on what's likely to evolve as opposed to what should happen. That's what we need to solve for when we think about portfolios. And when we think about what is likely to evolve, you see here the mix of energy demand that we expect to see in 2020. That was a few years ago. What we expect to see by 2030 and all the way to 2050. And the mix is shifting materially. The reality is that if it was cheaper, it would probably have happened by itself and naturally. So I think it's not, it's not surprising to assume that as we transition, we're going to face, at least for some time before the innovation kicks in, a more expensive mix of energy to produce what we're producing globally. And that's another piece of the story that leads to higher costs. And as you can see on the right-hand side of this chart, the impact of this energy transition by itself on inflation will be to boost it over the next 10 years. And this is in the order of 30 basis points, sustain. The Fed might decide to offset it, but that's going to imply higher rates than it would otherwise have to be able to do. So it is a driver that's going to be with us for some time, and that's the third big theme. So with that in mind, let me shift to what that means in terms of the macro landscape, and then to the investment implications. The first implication is on the next slide. We are in a world that we have been saying for a long time, for the last 2 years at BlackRock, at least in the BlackRock Investment Institute, that where we are facing sharper trade-offs. We're facing sharper trade-offs, very different from the last 30, 40 years of 1980 to 2000, where we were in a world that was steadily growing year after year. Production capacity were increasing, And central banks were basically taking the downside on growth. Whenever there was an adverse shock, they could step in and provide the support to try to keep the activity growth back on track. And they didn't have to really worry about inflation because inflation was under control, was trending down, and there was excess capacity that could be always tapped into. We think things are very different now for all the three reasons I've mentioned so far. So we think inflation, even though it's coming down, there's no doubt, it's going to be coming down to closer to 2 in the near term, which is great news. But that evolution reflects the normalization of the post-pandemic shock. And we think we're going to be on a roller coaster on inflation, where even though the normalization of the pandemic mismatch is happening, which is welcome, the forces that I describe will be with us and will provide inflationary pressure. We think the demographics are kicking in later this year as the labor market continues to be tight and the wage start to continue to put some pressure on inflation. So we think we're going to have stubbornly high and persistent inflation. Central banks can deal with it to some extent, but I think we're going to be in a world that looks more like 3% inflation than 2% inflation over the next 5 years. Something that's very different.
Can I ask a question to that?
Absolutely.
So is the 2% target real, or should we think in more 3%? I mean, I've seen articles, people argue that if the Federal Reserve continues their push to get down to 2%, that it might it might break, and we really go into recession at that point. What's your opinion on that?
So so I should full disclosure. I don't know if it's full disclosure. I'm a former central banker, so I guess I've been brainwashed in some ways.
You're reformed.
Reformed
central banker.
I'm a reformed central banker. I can put it that way. So it's been a long time, but I still kind of I still believe some of what I believe on inflation back then, which is I guess, or at least it leads me to believe that they have a strong anchor in their mind, the central banker, where before they consider that and seriously. They will have to have inflation back at 2% on a sustained basis. They will have to be able to say we've delivered, we've claimed victory, and at that point, then maybe say, well, we've learned something, and going forward, maybe we should consider raising the target. But if they do that before this, it's going to look like a Arthur Burns type of story, where we're not able to achieve 2%, so we're going to move the goalpost. We're losing credibility, and they're going to be afraid that that's going to lead to ramping up of inflation expectations. And that's how central banks lose credibility. So I think they'll be very afraid of that. And so I don't expect, even though there's a discussion, I don't expect any central bank to seriously go out and say we're actively considering that. That said, I think it's going to be more of a fudging it. So they're going to continue to show forecast of inflation going to 2%, but they'll miss it. And then they'll see 2.9, 2.8, and they'll say it's a 2 handle on inflation, good enough. And that's how we're gonna end up. I think in a world they're gonna relax, because they will be your point. They will be afraid of causing too much damage, but they won't fully admit that this is because they're changing their goalposts. So they'll try to. I think that's going to be the pragmatic way to try to get at that. And the question is whether they can maintain credibility. And if there's more pressure from from the public saying that 2.9 is not 2, then they might be forced to do more. But I think they'll try to gauge it over the next few years in this way. But to your point, I do think that the trade-off is real. The trade-off between bringing inflation to 2 and what it means in terms of growth is real. And what is a bit surprising to me, actually very surprising, is that that trade-off is already evident. We've seen it with us. The chart you have on the right-hand side is the track of economic activity, and I would just focus on the red line. This is output, economic activity in the U.S. If you read the newspaper these days and so on, the word you hear is strong, resilient U.S. economy. The reality is that for the last 18 months, we've gone sideways. It's been stagnating already. despite the fact that we have an extremely strong consumer in this environment that had a lot of pent-up savings, which has actually materialized. The fact is, all we managed to eke out of this is basically flatlining on growth. So it is surprising to me that this reality has not quite really sunk in yet in the broad narrative that we have. And we haven't even fully seen the impact of the rate hike so far. So I think what has really happened over last 6 months is there were first fears of a recession that will be happening. Those fears have been alleviated to a large part so far. And we've got some comfort out of that. But I think as we got some comfort, I think we are losing track that what is happening is that the U.S. economy is stagnating and maybe stagnating for longer. And so instead of having a recession and a rebound, we might just be stagnating over a longer set of quarters. And that's I think is our baseline. That speaks to the trade-off that between inflation and the growth picture that we're seeing. And that is going to lead me in a minute to a very different world in terms of investment. So that's why we are not convinced that the broad macro landscape leads to clear macro investment thesis. So I think, like, if you like US equities, and there's reason to like US equities, I think it's difficult to like US equities purely on a macro story. I think this is a stagnating environment. I think there's an AI mega force that is playing out. So there's reasons to find opportunities in some sectors, and they have played out. But I think the macro story is not as powerful as it has been over the last. Again, I keep going back to my last 40 years.
Jean,
yes.
Question for you: do you, from a potential tailwinds perspective, do you have an opinion about the spending yet to hit the marketplace related to the Inflation Reduction Act and the CHIPS Act, or do you only view that as being sectorally relevant, or do you see any macro benefits from that already approved spending that I don't think has actually hit the economy yet? Do you have a...
So I think this is one of the tailwind that I think on a 5 to 10 year basis. I think this is why you have still growth, potential growth that that's going to be decent. But I think what we're gonna, but eventually we're gonna get this. I don't think we're getting the growth traction just yet. I think this is gonna take some time, measured in a couple of years. And I think before that, we get the inflation impulse of it. I think it's going to come first because that the spending is happening before we get the production benefit out of it. And the second big story out of it is, we'll come to the investment implication, but we've seen a very significant resetting of the rate landscape over the last few months. I started the year at BlackRock asking the platform, we were at 3.5% on the 10-year yield in January. I was asking, do you think we're going to end the year closer to 5 or to 2? And the platform was split on this, showing that there was a pretty wide range. 2% or 5 is a completely different world, right? We were split, but we've now decisively moved towards the 5 rather than 2. And I think this is the IRA, the spending piece, the implication on deficits is part of the reason. So to me, the implications first are inflation and the impact on rates before we see the implications on growth.
Can I ask you, can I interrupt in there? So I enthusiastically agree with your observation that we are experiencing a human capital shortage and that it is masking an otherwise weaker economy. With that, I'm also scratching my head with the fact that for all of the investment we have seen into technology over the last 20 years, that we are having a productivity slump. We should certainly be more productive given the billions of dollars we've put. And it has always been seen as sort of the last sort of kind of transformation that should enable productivity and therefore enable us to achieve more output with fewer people, which is the demographic future that we are headed toward. So how do you square that circle that we don't seem to be, we are at an all-time productivity low now?
So I mean, the counter argument, if I wanted to take the other side of what I've been talking about, I would go where you're going. So couldn't be that productivity here comes and saves a lot of the story I'm talking about here, and it could. The reason why we don't we don't account for a big force coming from that just yet is we have seen. Go back to the late 1990s. We've seen a blip of the new economy at the time, some productivity gain. We know that the digitalization of the world is a reality that has been happening over that period. It was a real phenomenon in terms of investment over that 20-year period since 2000. It's been a massive, great investment if you pick the right winners, but it hasn't translated into broad-based, growth and productivity. People go then from there to say, well, maybe we're not measuring productivity properly. I doubt that this is, there might be some of it, but it's a big thing, right? I mean, at some point we would feel it in other ways. So I think what we've seen is we've seen a lot of technology that has changed our life in many ways, but hasn't necessarily, and has created a lot of profit for some sector of the economy. So that's clearly the case. But I don't think they have yet led to a broad-based, general-purpose kind of change in technology. It could be that AI applications that we're going to see could lead in that direction. But I guess since there's been a lot of hope over the last 20 years, we haven't really seen it. It makes us more cautious to just go and base our views on the macro next 5 years on the story that hasn't panned. But it could. It could. That's the upside risk to the story I'm talking about here. We don't have enough to hang a baseline view on that, I guess, so far. So with that, I think that has a couple of implications on the next slide, which I think are profound. And even before I go to this slide, I would say one of the profound implications, if you are of the view that I've described, is that this is we're not describing a cycle. We're not describing a global economy or US economy that is actually going to an expansion and might be going to a recession. We're describing an economy that is adjusting to a structural shift. And the structural shift is to a lower track on growth due to demographics, due to higher cost of production, at least for now. And we are, and then it's a bit odd, if that's the view of the world, then it's a bit odd to ask the question, are we going to get a soft landing or hard landing? Because these are kind of cyclical frame. These are business cycle frame on a situation that is not a business cycle in our view. And so I'm saying that because when we hear that all of the commentaries on the current situation and so on, and where we're going to get a soft landing, inflation is coming down, we think this is not necessarily the way to look at the situation. The situation is we're adjusting to a lower growth track, where inflation pressure will be ongoing. That's going to continue to persist. We might not have a recession or not, but it's still going to be a growth track that's going to be weaker than we had before, and it has this big implication here, which you see on this slide. Which, if this is right, we think central banks will be in a very different place than they have been since the 1980s. And what I mean by that in particular is if you look at this chart, this is the Fed policy rate, the Fed interest rate in yellow. The red is actually the Fed itself view on or estimates of what a neutral stance would have been if you just wanted to keep the economy neither hot nor cold. And as you can see, the yellow line has been systematically under the red line for 20 years and more during that period. Why? Because as I described before, this was an environment where the shocks were coming one way. It was all like the economy's capacity were growing steadily. You got some, consumer confidence shock or things that the central bank could lean against. And they did that by keeping the yellow line below the red. But it was a world of deflationary pressure that central banks were offsetting systematically. And we think the wind has turned now, given everything I said, and we think that even if inflation gets under control or get closer to 2, in order to get there, central banks will be forced to have a systematic tightening bias. And that means that we think they'll be now on the other side of the red line on a more systematic basis going forward. That is not inconsequential on how we think about investment and portfolio. That is a very significant change in behavior forced by this environment. That's going to mean, for instance, that in the next slide, we don't think central banks will be able to come as easily to the rescue when there's downside to growth. We don't think that they're going to be, contrary to the market expectation earlier this year, we think it's going to take a while before they can cut rates from where they are right now. And when they do cut rates, they'll still be cutting rates, but keep it on the higher side of the red line on a systematic basis, because we think, again, these shocks, the inflationary pressures are coming one way in this environment that I've described. So that's going to change, bonds and equity correlation to some extent. So when you think about portfolio allocation, I think that's a change that is significant. And it changes, the inflation outlook, how we think about it. And I guess the next slide is making clear that we should not be assuming that whenever this downside shock or surprise to growth, that central banks will be automatically coming to the rescue, which has been kind of a recipe that a lot of investors, that's a playbook of investors for many years that has worked well. And I guess we're skeptical, or we caution against in this environment, assuming that this is still working. So on that, I'll just try to get to the key implications and open up for more general questions. But some of the key implications, and one of the key things I wanted to drive to, next slide, and I'll just hit them, and then we can come back if you're interested to dig a bit deeper.
Jean,
Yes.
may I interrupt you right now?
Sure.
I want to actually invite the staff, Mr. Grable, maybe at the conclusion of Jean's remarks. I'd love to hear your perspective at the conclusion. I'd love to hear your perspective on how our portfolio expectations and views match or differ from what we've heard today. And I would love to invite, and I don't want to spot, but I would love to invite any of our staff members who would like to give us some examples of any investments that might be thematic. And there's no pressure here because we were given absolutely no notice on this. But maybe, throughout this conversation, it would be nice to be a little more interactive so that we as a board can hear how this connects to the portfolio. John, thank you.
Okay, great. And I'll probably hopefully provide some useful thing to react to in the next couple of points I want to make. So the first thing, in terms of in this environment near at this juncture, what are the implications for asset class? What do we like? So next slide, pivoting to new opportunities. So I guess one of the things that has been an implication of all this is that we've seen now income being back. Interest rates are at a level where you can generate now decent income like we haven't seen in an extremely long time. And so one of the things we've been liking is short duration government bonds and short duration fixed income in general. So short-term bond yields are surging. We don't think central banks will be cutting rates meaningfully anytime soon. And so that stream of income we think is attractive, continues to be attractive, particularly in a world where things continue to be challenge elsewhere. So that's one of the things that one of the implications. A second is, and I'm just giving you some teaser of some place we like. The next slide is talking about in the equity world, which we find on a 6 to 12 month horizon as being an environment that is challenged, continues to be challenged, even if there's no outright recession. There are spots that looks more attractive, and the next slide shows Japanese equities in particular. We've been turning positive earlier this year on Japanese equities. There, the environment I've described so far is actually, for now at least, a positive for Japan. The inflation that is coming is helping grease the wheel of the Japanese economies in important ways. there are corporate reforms that, after decades of being considered, are gaining some traction now, and makes that shareholders reform and so on. And so we think there's we've been liking Japanese equities on that basis. One thing we're concerned in Japan is on the yield curve control development, the central bank's development over the next few months. But we've become a bit more relaxed on this, this year, and so that's a place we like. We think the EM world in general is more attractive than the DM world when it comes to equities, and when it comes to on the next slide, when it comes to EM debt, we are overweight hard currency EM debt in particular. So we think that it's remarkable how the EM space has been able to withstand the rising rate environment, and I think that has shown some resilience that continue to help them going forward. But as I said, when we talk about EM, the broader picture story is now need to think harder about geopolitics, and it's not like a blanket statement about the whole EM. So we need to be more granular when you get to that. The next slide makes a very important point, which I've already touched on, but it's a very different. Before I get to that point, so on the real estate side of things, which I know this is part of your of the allocation here, well, on real asset in general, I think real asset as a case going for it, which is in this inflation environment that continues. I think this is a place that should fare well, continue to fare well in general. We think infrastructure is a story that continues to play out because of the property on the inflation side, but also I think this is there's a transition top thematic there. Mega force in our view, which is due to the policy support that comes for infrastructure in that space. The IRA is an example. So that might not have a big impact on growth, but I think it has a big impact on infrastructure that continues to be for us an area we like to consider for investment. When it comes to real estate in particular, the broad macro story from inflation, I think, has to be weighted against the fact that it's not cheap real estate anymore. So we used to think of real estate as being one place to allocate to, given this inflation environment, but it's not cheap anymore. And so I think there the real point though is that this is really about granularity and dispersion. So as you can see on the right hand side of the chart here, there's not a uniform real estate story. What you see in the industrial real estate is very different from what you see in retail. So industrial is very expensive compared to retail, but actually we also think that once you look at it through this lens, there's a reason why industrial continues to be attractive, and to us it's the mega force of online, the shift towards more of an online shopping for retail, which favors industrial kind of real estate at the expense of retail. So we would not have a high conviction on the broad real estate macro story, but I think they are. If you believe these mega forces, then you come to a positive story, I think, on industrial real estate, even though it is more expensive than the other space. So there we would advise taking a more granular lens than simply the macro picture. And final and the last slide of this part, and I'll conclude with
ask a question?
Yes, please.
Excuse me. On the real estate side, I was intrigued to see how the projection for office is increasing. And I think at this juncture last year when we had this offsite, we were under the impression that the office was on the decline because of the change in the shift. Do we see the shift in demand for office going back up versus, this new work model and this reduced labor force? I was just curious what would be behind this increase on the assets for office space.
Yeah, so I should clarify here that I should have done that before. So these are capitalization rates. So the way to look at this is when this line goes up, it means it's getting cheaper.
Gotcha.
So
Understood.
So that, I mean, that's a good clarification. I should have made that clear. So I think your intuition is correct. The pink line is moving in that direction. Retail space is also similar. I think this is about like, malls and things of that sort. Whereas industrial is becoming more expensive, but I think it's becoming expensive for a good reason, given the trend that we see in play. So that's the kind of story you need to get comfortable with to invest there, as opposed to what the valuation looks at the broad real estate level. The next point, and then I'll conclude with my key points, is that pivoting from and this is one of my key conclusions anyway, is we think this environment, I hope it came clearly to everything I've said, it's less about getting a view on the broad market, like the S&P 500. I think it's very difficult to, on the 12 months and more horizon, to come to a high conviction view that the macro leads you to believe that the S&P will outperform. I think the story is more granular than that. And in fact, when you look at the performance of the S&P this year, it has been not about, we don't think it's a macro story. We don't think it's like the soft landing versus hard landing story that has really driven the S&P and bullish views on that. The story is more about dispersion, and it's concentrated. It's actually more about concentration than dispersion. It's concentrated, and it's about mega forces. It's really a story of AI so far, and it for some time it broadened in July, but we're back to AI as being like the big driver. And in investing in that world, in our view, it requires then, as a result, less of a broad lens. It's more about like picking these thematic and mega force and evaluating them. It's about strategically allocating to thematic as opposed to strategically allocating to asset class. So I think that's something we're thinking through about, like changing our processes to get to the good place. And then the other implication is that on the macro side of things, we've seen a flip-flop of narrative this year that is unprecedented. It's reflected in the bond yields volatility that we've seen at level that we haven't seen sustained that much over the last 4 years, except for 2008. And so that volatility means that picking up these macro trends requires to have a much shorter horizon. It requires to be much more nimble. I think there's returns to be created. There's opportunities to generate alpha or excess return by navigating these macro narratives, but they're going to be flipping more frequently in this environment, and as a result requires to be more nimble. And so that leads me to my conclusion here in a few slides, but it's going to be short. We think we need to evolve our playbook, which is what you will have on the next slide. We cannot stick or stay at the broad asset allocation level now in our TA. This is part of it, but the TA story is one where right now we're cautious on DM equities, for instance. We think we're cautious on long-term bonds. We think rates still have to go up more. We like short-term bonds. That's the kind of macro story, but that won't generate much return on its own. So we need to evolve to a more granular implementation. And so you have example here on that slide, but this is where we think about inflation-linked bonds, which is like more niche typically as an allocation. We think that requires, that's an example of granularity. Think about quality, the EM local debt, preferring Brazil and Mexico are example, and I talk about the others. But the main thing is the last thing, which is harnessing what we call mega forces, and I've already talked about this, but it's rather than thinking about US equities as do we like them or not, I think we want to think about how do we get exposure to the AI team? How do we track it? When does it become too expensive? The AI team is not only about the current generator of AI, it's about downstream implementations, about what it means for healthcare, what is going to change the way the financial industry do work. So that is, we think, some of the key implication that requires to be more granular, more nimble, be able to seize this opportunity in a timely fashion. So on that, I think I'm gonna just finish with the very last slide that I want to show you, which is slide 20. And that's my last one. Try to maybe put all of that together with one final point, which is, from 2010 to 2020, I shouldn't say that this way, but I'll say it this way. It turns out it was pretty easy to invest. A 60-40 portfolio or setting a strategic allocation and forgetting it, you could have done better than that, but it was giving you a long way toward generating most of the return that would have been feasible. And you can see here what you have is the nominal expected return of a 60-40. You can see what the excess return would have been over the cash rate. The cash rate was pretty much zero, so you would be getting essentially the same thing. And the Sharpe ratio, which is measured on the other axis, was at the level you can see there, about 70 basis points. In our capital market assumption over the next 10 years, we expect the 60-40 nominally look not so different. The red line looks pretty similar, but the reality is that the excess over cash you're going to get is only the pink line, which is a lot lower going forward. And the Sharpe ratio is cut almost by half. The Sharpe ratio, which is the return adjusted for risk. So what we're saying here is that simply setting and forgetting, or being very slow to adjust, will be more costly in the environment we think we're going to see ahead of us. It was pretty easy. You could set and forget, get most of the way. Now, to generate additional return will require, going beyond that. And that's where we see the Megaforce more granular and more nimble as being key to go beyond that. So I'll stop here.
Great, Mr. Santos.
Thank you very much for your presentation. I have a few questions. Going back to the geopolitical risk, where do you see China? China, are they the developed market, or they're still part of the emerging market? The economy is slowing down substantially. Also, we have the issue that potentially could take us into a war. So if you can talk about that a little bit, and then looking at the real estate and the emerging markets, if you can tell us a little bit about what do you see the opportunity, if any, with regards to the office retail sector in the emerging markets. Is that something that we can keep in mind? And also with regards to the 60-40, if you have any comments about the modern portfolio theory, in 2008, 2009, there was opinions that the modern portfolio theory did not work. So
yeah, these are all great questions, which with the challenge will be to stay not too excited on them. So that's for me. So on the first one on China, I would make a couple of points. So first, more like bigger picture. As I've tried that's my first point at the beginning about geopolitics, right? So I think things have changed materially over the last 2 years. The war has been maybe a catalyst for this. But I think now it's not only a question of contingency planning. What happens if there's a war, or if there is some Taiwan? In the old world, we would have thought about this as, okay, how we would prepare to react to this. Now I think this is a different thing. This is there is a desire to be compensated for the greater risk that investing in some place of the world, seen by some region, requires. So what that means is, I think, we've been characterizing that as, for some part of the world, and maybe you can call that NATO-based investors, or there is a greater hurdle to pass to invest in some of these regions. They'll see that as higher risk. And I think the way that manifests itself in practice is also that before you would allocate to some people will allocate to China, nobody would be asking questions. Whereas now there's a lot more question being asked about why, what's the logic, and so on. So the mere fact that there's a higher hurdle to justify this allocation is a manifestation of there's a higher compensation for risk that is required now. So we call that the geopolitical risk premium. So there's a need now. There's a source of risk that now is driving return. It gets to be priced in by these higher hurdles that I think people are facing in some part of the world to invest in some of these places. By the way, that creates opportunities for other part of the world that are not seeing these regions the same way, right? So the fact that a US-based investors might have to go through more hurdles to invest in China for good or bad reason leaves some potential opportunities on the table that other part of the world that don't see the same risk can decide. Other investors elsewhere can decide to makes it cheaper for them to invest. So this is what this is one broad statement. So I think there's a geopolitical risk premium now that when we think about return expectations on a region like this going forward, like we need to have a view on what's the additional compensation for risk now we think should be applied. The second point I would make on more specifically on the we think the growth track is clearly has been a big disappointment this year in China. We've seen the restart post-pandemic elsewhere. We thought China would have this massive restart, but then what has been happening is that the Chinese consumers and the Chinese themselves are not very bullish about their economy. There's a lack of animal spirit that has been pretty obvious in China this year. So that's the part that many people didn't factor in, us included, that we've learned. And then we've seen on top of that now, that has created, I think, a downtrack on activity in China. Consumption is not picking up the way it would have picked up based on the restart. So we revised down our growth expectation on the back of this pretty significantly, and are not of the view that the stimulus that they're going to be putting in, at least so far, it will avoid spiraling down, but it's not something that's going to lead to a boost on growth. So we are cautious, I guess, just on its own on the outlook for China right now. So that was question number one. Very, very quickly on question number two. Maybe I should come back to you on the real estate nexus with emerging markets. Rather than I don't have anything on top of my mind here, or I need to check. So we can follow up on the more specifically on how we think about real estate in emerging markets. What I had here was more from a DM perspective. So let me be efficient here and come back to you on this one. And on modern portfolio theory, I think this environment would. I would leave it short, and we can pick that up in the long answer. But I would say that we are all my story is about. We had 40-year period that were the Great Moderation. The Great Moderation from 1980, where inflation was going down, everything was moving in a very stable way. That's the world in which portfolio theory was developed, and I think there's a lot. I don't know that investors are yet used to adjust, priced in changing macro regimes, because we haven't really gone through this. And as a result, I'm not sure I would run with a modern portfolio, like efficient market portfolio optimization theory as my full starting point to think about expectations of return going forward. And I think I would ask Art question about, do we really believe this macro environment is reflected, priced in? So I think it's still a good discipline and starting point, but I think we need to now adjust it for macro regime that are changing in a way that haven't for 40 years. Thank you.
All right, Mr. Grable, I'd love to hear your thoughts.
Well, first, I think this is fabulous. I feel smarter just having, osmosis sitting, close to Jean. A couple of musings or thoughts, and I'll go back to the question about productivity. Is that which makes us more productive, all those massive investments in technology at the same time make us infinitely less productive, in that we all have effectively a supercomputer in our hand that we use to do something else. So while we're at work, we're doing something else that's not work, and we're doing that really efficiently. So I think that there may be a net trade-off with this massive investment in technology. But I think that the productivity question is a really interesting one, and one that will certainly evolve, and the answers will. I guess there is no precise answer. I love the comment about income is back. It's kind of like Justin Timberlake is singing, income is back. Because I think it's really yes, it's just really profound, and it impacts every single thing that we do, to the extent that there's higher cost of capital, and that the alternative of nothing, of cash, and I'm saying this nominally, in the nominal world, is attractive. That that impacts even the question about emerging market real estate. Well, the alternative, the threshold for emerging market real estate has to be that much higher because the cost of capital is that much higher. So I think that impacts everything that we do in our portfolio, where, over the last, several generations, where it kept on declining, and we were allocating capital, expecting the risk capital to do more, and everyone was, by definition, it was doing more. So I think that we're in a really interesting environment, and I'm taking these comments kind of out of order. I smiled, looking at Vache with the take on long-term bonds, because I know Vache, has always had that opinion, or recently has had that opinion about long-term treasuries, I think that it's. We're in a really interesting environment, and it's a real challenge that we have in front of us, but an exciting one as it relates to strategic asset allocation. And I invite my colleagues to think about themes, but I think that the themes that were presented are ones that we think about, that the board thinks about. We have a pending recommendation investment tomorrow on deep machine learning, artificial intelligence. That is, once again, profound. It's more than just NVIDIA. Had we put the whole fund in NVIDIA at the beginning of the year, we would, think differently. We'd be fully funded, and we wouldn't have to have our funding policy discussion later today. But we didn't. Infrastructure, we certainly have a large and growing allocation. It's designed to perform as in higher inflationary environments. The other macro theme being, or one of them being, energy transition. That's something that we have made significant investments in over the last period. So those are themes. Real estate, some of the themes, be it logistics, be it healthcare real estate. So I think that we have tried to, and the team's done a phenomenal job of embracing themes, but part of the way that we embrace them is in a structured way through structure reviews when we think about asset categories and different opportunity sets. And once again, maybe the biggest theme is bringing income back. Emerging market debt we discussed last month at the credit committee. I think it hasn't worked well for us, and it may have been kind of our implementation model where it's been very benchmark aligned, as opposed to, it may be more about thinking better about the implementation model and being more opportunistic. So I think that's more of a structural design problem that we need to do. I think one of the things that came across, and maybe this is not quite demographics, but maybe it's the cross-section demographics, maybe it's the geopolitical risk index at the beginning, is kind of emerging markets versus developed markets, in that we're investing in an environment today where, and it was one of the last slides also, where there's some massive companies that are almost like sovereigns, where, there's a new book out today that's talking about some entrepreneur and what this gentleman has done, with certain foreign powers. I think that the role of these big companies is Apple, who has a big developer conference or product release right now. Are they a U.S. company, or are they a global company? So I think that really impacts things. Also, that it's not DM versus EM. It's that some of these big companies are both, in a really interesting way. But I think that this is, and the one last thing, just while I filibuster a bit to see if any of my colleagues have any comments, is with the thought about modern portfolio theory, is kind of theirs goes session 3 today with the discussion about our capital market expectations. But I'm sure Tim has 3 hours or so to put something new together. So I don't know if anybody has anything
He's
to.
very resilient that way.
So open mic.
Open mic. I invite all of the team members to feel free to take this opportunity if you choose.
Yeah,
Patrick.
thank you for the opportunity. I'll be brief. I want to talk about both strategic and tactical. Mm-hmm. But before I do that, I want to talk about the comment about income being back. It's obviously very true, but in order to be able to say income is back, income had to have gone away, because that's what happened 3, 4, 5 years ago. Mm-hmm. And I think we navigated that pretty well on the strategic front. Not too long ago, the allocation to investment grade bonds was 19%. 3 years ago, we cut that to 7%. That's a huge drop, 19% to 7%. So we reacted to the market. So I think we do the strategic quite well. Mm-hmm. What we're trying to do is what John said, be more granular, be more nimble. We're trying to work on the tactical. Mm-hmm. We recognize that pension plans, public plans, find it a challenge to be tactical. We have our procedures, we have to do searches, and that takes 6-9 months, a year before an investment is put into place. So the way we're trying to deal with that, as we mentioned last month at the credit committee, is try to build that in to the mandates when we hire managers up front. Because managers can be more tactical within guidelines, whereas we ourselves cannot be.
Right.
So, for example, on the topic of hard currency, emerging market debt, again, it's a question of how did we get here? The reason that emerging market debt looks good is because it performed so poorly last year, and so yields are up. And we saw that in our portfolio, and we mentioned it. So it's important to talk about the future, but don't forget how we got here. Why is it that income is back? It went away. And in bonds, income is cushion. And that's why last year there was no cushion when interest rates went up. The price return was not offset by any income because it wasn't there. Right. Now it's coming back. So I think we do to summarize, I think we do the strategic really well. We're working to improve the tactical, give our managers more flexibility within preset guidelines.
Yeah, thank you. Those are great observations. Ms. Jones?
I did have a question, kind of in line with what Tracy said. What was shared with the 60-40 split and how moving forward, set it and forget it is not the way to look at things probably in the near future. And so I was just anticipating us moving forward with the asset allocation review. And I guess my question for staff is if we feel that that's something that should be done in the future more frequently, or should the ranges be broader so that staff has the opportunity to be flexible within those different ranges that are set within the asset classes. I guess if we were to kind of take heed to this notion that moving forward, we have to be more nimble, what would be a way to ensure that we are flexible in that area, if their shift needs to occur quickly?
It's a deep question or complicated question. And in some sense, not that I want to lose time, but the last session tomorrow about the evolution of the portfolio really gets into the core of that, how we've moved from a classical framework with 8 or 9 asset categories to 4 or 5 functional categories, which really allows us to rebalance better. To operationally, we close our books, or we strike a daily NAV, whereas we used to strike a monthly NAV, such that we can rebalance more precisely daily. I would say that within one being very big picture macro, one being very micro and operational, everything in between is how we accomplish that. And I think that there'll be some discussion about how we have more asset categories, but that have to work harder and have more defined roles as opposed to just being generic categories. But I don't want to give a bad answer to the goal, where I'm a big believer in strategic. I think that we need to do the strategic really well. I think tactically you can do it well and it works. You could do it not well, and then that has actuarial consequences. So I think that we have to really be very careful as a mature pension. This gets to the session today about our funding policy, that there are consequences to being tactically incorrect. So if possible, I'd like to think about it and maybe during the evolution session tomorrow, give a better answer.
Okay. Mr. Green?
Thanks for the presentation. I'm going to try and be linear in my question here. And I think you kind of answered it as far as in the spirit of asset allocation. I wanted to ask Blackstone, you're talking about the geopolitical risk. First, I have a question that you talk about 10 areas that you look at, that you analyze for that geopolitical risk. What are they specifically? I think you look at specific geopolitical risk. You look at 10 areas, as titled on the slide, 10 individual risks.
Yeah. So the process behind this, just so you know, is we need to identify what we think are the geopolitical risk of the moment at the moment, and then this index that you've seen is kind of a text machine reading of scraping all newspapers and try to get to a measure of how much attention there is to these geopolitical risks. But the set of 10 is changing over time. So Tom Donnellan is the one leading these geopolitical initiatives at BlackRock. And he has this kind of quarterly meeting where he's going to engage with the platform and identify what those 10 indicators risks are. At this juncture, to be honest, you're catching me, and I won't have the occasion to come back with a better answer tomorrow. So, so you're catching me a little bit.
You're welcome to come.
It's mainly for curiosity.
We can follow up. So I mean, clearly the war, the Ukraine conflict is one of the 10. There is the China-U.S. tension that is a second one.
That goes into my next question. So,
Okay,
my question is about tribalism. So I've been really reading a lot about the recent G20 summit, and we've got an offshoot of that with the G7, and then the Belt Road Initiative on the China side. And then they've got their BRICS now, and they're inviting more countries to it. And it seems like we're, as far as an economic, there's this divide that's happening within, recruitment and enlistment of these financial markets. And then I just wanted to hear your thoughts on that. And Mr. Gray will kind of answer that with, the ability to be extremely nimble and see that in real time and take action against it, I think is the solution for asset allocation, to be nimble. But where's the analysis with it? And I'd like to know what your thoughts are on that kind of tribalism that's happening.
Yeah, so I think this is another a better way to articulate, I think, what I was trying to describe as this kind of we start from a world where there was I used to be representing Canada on the G20. Back in the late 2010, early 2010. And at that time, there was kind of, people were speaking around the same framework, even China. And we're on the table, and then you might disagree on how we wanted to implement the framework, but we were speaking within the same framework. And at that moment now, I don't think there's any common framework. The framework at the time actually was called the G20 growth framework, and there was there was a bunch of others, and there was a framework working group that was actually supporting the entire initiative. I don't see any kind of common discussion on how we think about the world and the place of these countries that is currently happening. So to your point, I think there is a clear regionalization that is a block that is happening. There were some discussion about the BRICS initiative. I remember in the G20, they were like on the sideline of G20, there would be a BRIC meeting that everybody was aware was happening. But it was, and now this is becoming more front and center of the actual kind of global dynamics. So this is a clear evolution. There are things that everybody agreed back in 2012 on, just on how we go about trade and what is the right rule of engagement on trade. That's completely out of the window now. I mean, there's everybody is doing version of things that would have been seen in the past as being going back to the 30s with more mercantilist approach to trade. So I do think there's no common framework anymore. There is a pressure. I don't know, was the word like balkanization, I guess, to some extent, or now blocs that are forming. This is why, these are forming around things like how people are voting at the United Nations Security Council. And I would say one more thing, which is, one thing that is changing. Back then, what we call the finance track, so the track of the finance ministers and the central bank governors, was the one that was driving basically the international engagement, partly during post-2008, it was all financial and so on. The track that would be on the trade or foreign ministers would be secondary to, and that has been completely flipped now. So this is driven by foreign affairs consideration as opposed to pure trade. So I think for us as investors, when you look at these meetings and the landscape, I think we need to keep in mind that economic consideration are secondary to what's happening, even on the big files that are notionally about economics or finance, and that I think is a massive shift, and that speaks to geopolitics. That's another way of talking about this geopolitical risk premium that needs to be embedded in what we do now. It's not only about what makes sense on an economic front. It's the politics will create some diversions from that and will detract from what would otherwise be maybe generating returns.
Okay, thank you. And the second thing, it's fascinating, and I mean, it seems like, my interpretation is it's moving, but it's going to be, some very slightly trackable because of the political events that are occurring at the time. I mean, if Egypt and everybody joins that BRICS, that we're going to know about that. So the other part is that the
sorry to interrupt, but I just want to flag one thing. One of the implications that is discussed a lot is around the role of the US dollar as a reserve currency as this is happening. Because there's clearly a diversification away from the US as reserve for some of these countries. Now, the starting point is it takes a huge to dislodge the US dollar in the role it's playing, and it's not going to happen tomorrow. But at the same time, there is a dynamic, these kind of initiatives could lead to, over time, changing the picture. So I think this is something worth watching.
Outstanding. Yeah, and the other part I have is the AI came up and was a hot topic yesterday, at least at table one, and the implications and the positives and minuses of it. But technology risk. If AI is the new hi-fi stereo system, and you got the mono, which is. But the Starlink is over 50% of the satellites floating in the air right now, and There was an incident that happened recently with that, where it actually a private company was involved in a geopolitical issue, and that technology was being relied upon, and it was just shut off at the whim, so to speak. And I don't mean to, it's extremely disturbing, and not just looking at AI, but the analog technologies that stuff like that. I mean, what is your thoughts on that stuff?
Well, I think there's first, I think it's
that could impact global commerce, because I mean, if everybody's relying on one system and there's no regulation, it's it could be.
You're talking about the privatization of what would otherwise have been regulated.
Yes, thank you. I mean, it just it's like the evil mad scientist plan. I want $1 million. Otherwise I'm turning off the internet.
Yeah. So no, I think there's there's a lot to unpack there, and but I maybe just a couple of things. I think in the AI space, this is happening extremely fast, right?
That's what I'm getting at. The first thing I'm talking about is something that's it's trackable, so to speak. It's there's an impact to it, but this is something that and AI technology, which can be used for good and bad.
Yeah.
But it's.
So it's happening extremely fast. I think things that we haven't dealt with before. You're describing here a situation, of a private company
in a war zone, in a destabilized
private
area.
company that I don't know that I would have expected 30 years ago that it would develop in this way. So that raises a series of questions. I cannot opine, and I won't opine on like the regulation aspect. This is public policy consideration, and I think these are valid questions. But I mean, this is not for BlackRock to opine on what is the right. This is more of a elected official discussion on what is it an issue? How do we deal with this? But I do think that the speed at which this is happening for investors, I guess, requires us to think about. Whether all of the consequences are fully understood as this is developing. And I think I would take your point more broadly, which is there might be some unintended consequences. And by the speed of which this is happening, it requires maybe even more of a proactive look at these things.
And I think what Mr. Grable said, though, in preparation, right, we become more nimble in our ability to pull the plug or plug in, so to speak, right? I mean, is that as things happen? I mean,
Okay. Well, so thank you. I think that was an interesting rabbit hole we went down, but valid actually. No, actually it was valid, because it is exactly those things we don't think about that will be the things that sometimes we face. So that is a very good question. This question of privatization, something to think about for the future. Well, I just want to thank you for your comments. I think that we certainly got a lot out of it, and I am very pleased that our staff was able to also kind of react in real time to the commentary. So I would say that we have a win for the morning session. Thank you so much. And so with that, we will go ahead. John, do you want to make any closing remarks?
No, what time do you want to restart, Madam
So
Chair?
let's go ahead. 10 minutes?
I think do we have food or anything?
We only have some coffee in the.
Oh, so should we 20 minutes? Should
20
we?
minutes?
Yeah.
Okay, so let's do 20 minutes. So we'll resume at 10:30.
10:30.
Rounding up.
Thank you.
Thank you.
Thank you.
Recording stopped. Recording in progress.
Okay, so we're sitting. Thank you. All right, so moving on, we have item 7, which is the board and committee evaluation, which will be led by Makita. However, before we dive in to these comments, I'd like to make some observations and give you some notes. Going into this offsite, I had a series of lunches that Mr. Santos was able to join me on as a listening tour with the staff. And I was able to meet with all of the staff teams and hear from them what is happening within the organization, how they view the board effectiveness, what their needs are, et cetera. And I'm going to attempt to very quickly summarize what I heard. The first observation is that the internal investment process has evolved significantly under Mr. Grable's leadership. When I first was appointed by Supervisor Solis, I requested a series of meetings with staff at that time, 6 years ago, to understand the process that each of our teams goes through so that I knew how to read the investment memos. And so this is the first time since then that I have done that same that same request. And I will say that what I observed then was a series of very processes that were not necessarily aligned with one another. They simply were each individual processes in very much fiefdom form. Today, that methodology and approach, while it's still tailored by the asset class, now has a shared philosophy and a unified approach. I think that is the first observation. The second is that the level of cross-asset insights, oversight, transparency that's been built into the investment committee process is impressive, and I think it lends itself to sort of an overall better process on the whole. The third is that the team members are interested and engaged in continuous learning and continuous improvement. I think that was something that I also walked away with from the conversations. You know, we've been discussing tacitly sort of what the pathway to delegated authority could potentially look like, and I don't want to preempt the conversation. You know, but these are just simply the things that I've seen is the staff and under John Grable's leadership, we have formalized the process. We have created an internal transparency and accountability. But what is still left to be done and what we kind of have to talk about is we have to establish trust building through training and onboarding for trustees. We have to understand what we need as trustees in order to facilitate and enable that trust to continue. And we need to continue to have, post-mortem and learning from documentation for investor terminations that are not the simple sort of thing that comes out of a structural evaluation. And so sort of focusing on the what, not the who, learning how to fail with grace, being able to make mistakes as a part of learning process. I think that kind of is also an important part of things that we can think about how to do. I was also impressed with the amount of sober reflection that the staff kind of voiced while we were having the conversation. There were staff members that admit that there is a such thing as too much delegated authority, and that it is important to ensure that we build safety valves to ensure that we don't give so much rope that they can hang themselves, and that is important. There can also be too many meetings. The investment committee can be composed of many people who are not all engaged. So these are things that they recognize are possible, and they're working to try to think about how to counteract. Too many authors removes accountability. So the sort of how do you create accountability? How do you build agency? Internal. But I think the one thing that I did walk away from is that I would say most every staff member agreed that the internal investment committee process is far tougher than coming to the board. It's been vetted by a lot of people in that process before it comes to us. And I think that that's important. And I think the more we understand what that process looks like and how it works, the greater that trust bridge can be. I think that the staff, when they come to the board, what they look for is a safe environment, the ability to be able to present, make that best effort, document all of those best efforts, and not feel like they're in a gotcha environment. And I think on that front, we got a lot of kudos for saying that the tone at the board level has improved dramatically this year. So I'd like to say that we have some things to be proud of as a board. Things that do make it tough for the staff are mixed messages from board members as to how we should react to things. The tone at the top, which has improved, but that's something that we always have to be vigilant about. Not only tone between board members, but also between the board and the staff, ensuring that we have the kind of respect that we need. Learning how to productively disagree. Disagreement is not bad, but how to do it productively and efficiently and effectively. Board stability is one of those things that's always a concern. You have sort of one new board member that can swing the dynamic. So thinking about how to build the institutional kind of safeguards to a direction and make sure that we don't sort of turn any ship too quickly. That's never, rarely does that result in good outcomes. And, you know, the notion that we as a board need to have a shared vision and values, which I think we're working towards. You know, I think that you know, there was also, we also got kudos, by the way, for the efforts that we've made in the recruitment of the quality of board members. We have a very engaged board, and we did get staff acknowledgement that is enormous from their perspective to feel like they, all of the work that they do is being presented to an open and engaged group of trustees. And I think, you know, one little thing that they thought that we need to think about too is that because of the way that we have our relationship with our consultants, that we empower the consultants greatly in the investment process without necessarily creating the same level of accountability that we're creating with the staff. So something for us to think about. Staff goals, they've kind of are committed. John's team is committed to building things like a guide to the investment memo, a guide to the performance book, so that new trustees and existing trustees know how to read this data, know how to interpret it. An introduction to the investment committee process. Mr. Green was probably, you know, very, very positive on the last kind of introduction we had, and I think we need more of those so that we understand what the investment process is. Building a library of the structure reviews. When we have structure reviews, making those videos readily accessible so we can refer to them when the time comes. A library of educational presentations as well, and also just a continued living documentation of what the process is and making that available. And you know, what they're kind of committed to is a commitment to the professionalization, transparency, and accountability. And all of that results in institutional maturation, which I believe is what is happening here at LACERA. So I think that is important. They also highlighted some needs that are important to them. Technology is very important to help encourage shared meeting notes, shared diligence activity, the ability to be able to easily take on board new investments, place for new investments to be able to be caught and easily evaluated and considered for, you know, stored for later consideration or potentially acted upon. So kind of continuing to evaluate that. Operational support, but also the notion that, you know, historically within public agencies like this, there tend to be only a downside for sort of having your fingerprints on work, and it tended to shy people away from wanting to own that investment. So we have to think about how to create upside incentives so that we can incentivize ownership. You know, and that's a public agency challenge. So those are all of the observations that I made. I know that was a very long introduction, but, you know, we're about to do our own board evaluation, but I thought it would be nice to sort of hear through my perspectives, you know, what I heard from the staff. And of course, if I missed anything, Mr. Grable, I know that was a lot of comments, but there you go. So that was a very, very, very long introduction. But from here, I will hand it over to Makita to walk us through and the process of evaluating ourselves and setting our own goals.
If I may.
Yes, absolutely.
You know, one of the things that I learned in meeting with the staff, which is really, I was really happy to hear, is how staff deals with your own investment committee, right? All recommendations that come before the board has gone through an investment committee of the staff. And one particular staffer that I'm really grateful for the comments made is that this particular individual had made a recommendation to the investment committee and of his coworkers, of his colleagues, and that particular recommendation was rejected. But what was so key is that this particular individual, rather than being upset about it, he learned, and that's the key. He learned, he readjusted, and came back and made the presentation. That, to me, it is significant, because you want to be able to be judged by your own peers, just pretty much like we do here. The privilege that we have here is that not only that we have the staff's investment committees evaluating and opining on a particular proposal, but also our investment advisors also have their own investment committees that take the same recommendation through that process. And that both the consultants and the staff's investment committee have to agree and align before it comes here. It's tremendous the amount of work that is done on behalf of the members. So I thank you for that. That was great meetings to have the staff be forthcoming like that. Really appreciate it.
Thank you. So with all of that, Mr. Fila, take it away.
Excellent. I have nothing further. So thank you all. If we could just advance the slides one, please. Thank you. So I think just to echo everything that's already been said in this session, really what this is part of a process. It's a part of a process of self-reflection and evaluation of the board, and in the context of really, LACERA's evolving strategic plan towards best-in-class investor, which has really been a cornerstone of the last 3 or 4 years within the organization. And then also, as you're going to hear tomorrow, on the evolution of the portfolio. And maybe even to dovetail with the morning session, we heard about the macro environment being in a new regime, which we completely agree with, that may require additional agility from investors to respond to appropriately. So all of that ties back to governance, right? It's really making sure that the framework is right for the decision making to take advantage of the skill sets of the organization when it's confronted with the realities of the global capital markets. So that's the exercise that we're trying to do here today. And this is one step in that process. In July, we had a session just introducing the topic of governance. In August, we reviewed some other high-level models. Here, we're going to be talking about LACERA specifics and ideally really getting your feedback, because the board is going to shape all of these governance policies. That is your one of your highest duties, I would say, right next to selecting the strategic asset allocation. And so this will just be part of that. We do have a sort of process laid out where we're also going to do a deeper dive in October into some peer group plans. The idea might be to take some of the feedback we get here and then identify some of the policies and practices that they utilize that may be aligned with the direction that this board wants to go. I know there's been some talk of delegation in the future, and certainly some increased usage of that in co-investments in some private market areas, re-ups, et cetera. But I don't want to, this shouldn't be so narrowly focused on that. There are many other things that go into it. And as Chair Sanchez talked about, the trust bridge, I mean, the most, like, trust as a concept, it can be fleeting, but the trust bridge should be really well engineered. And so having those right components making sure the policies and practices and everything are in place to support that trust bridge now and into the future is really the goal of this exercise. And then so in November, and some of this timeline can change as well based on how quickly we get some of the feedback. But ideally, in November, we are hoping to come up with a series of joint recommendations, work with staff on crafting any additional language changes to policies and procedures. So that's kind of the background on where we are. Next slide. So overall, this is based primarily on a survey that you all conducted, and I apologize for some of the technological flaws with the first approach. I also want to point out that surveys are only as good as the author, and so there may be some areas that are interpreted slightly differently by other people. So we think the best way to do this is just go slow through the presentation, allow time for all of you to comment on each of the different areas. Not try to take too strong a judgment from just what's in the survey, but really just to gather the information and feedback during this session. Next slide. And now I will turn it over to Imran to just take a quick high level look at some of the survey results.
All right. Is everybody able to hear me?
Oh, you have to, there's a little button.
All right, much better. All right, start with BOI governance. So here, current effectiveness, that is in blue. In green is relative importance. 1 is good, 5 is not as good. So starting with current effectiveness, you know, a lot of 2s, a lot of 1s. So suggesting things are working. The one area that kind of stands out a little bit is the board education and development. That category got an average rating of 2.5, suggesting that might be an area for improvement. Any comments before we move on to the next one?
Yeah, let's have a moment. I mean, I think when we were all filling these out, we probably, now looking at it, we reserve the right to change our mind. Ms. Jones, did you want to react, or was that just a?
Yeah, so I guess I want to make sure, because I think as I continued to read through this document, there were some kind of polar responses. And I'm wondering if everyone interpreted the 1 through 5 the same way, because I know maybe, is it just me? 5 sometimes means good versus 1 being bad, and we flipped the script. And it was probably done to make sure we're paying attention, but so even now when I'm looking here, I was even, I guess, surprised, like board education and development, right? I thought that would be like a 1, right? So, but it's, yeah. So I don't know. I was just curious, I guess, as you were reviewing the responses, what were your thoughts? Did you think we were all on the same page, or did it seem like there were some kind of weird responses where they were, you know, segregated, separated, or I don't know. I'm just curious.
Yeah. So from my perspective, there was definitely one response where I reached back out to a particular trustee just to clarify maybe some of it, because it was very sharply in the opposite direction of what I would have expected. But I did think initially when constructing this that there would be some areas of stronger alignment. So I'm really happy to see overall, and I do think the scoring comes through basically that this group feels LACERA's governance overall is quite strong, but there are some areas for evolution and improvement. And I think it's going to be really interesting once we get onto each one of the individual topics to just go around the horn. And so maybe through our own clumsiness with the construction of it or not, but that's exactly what I wanted to stimulate, was a dialogue with each one of the questions, as opposed to just a simple survey somehow being conclusive. So I'm actually kind of pleased with the way that it turned out, but totally understand and recognize your viewpoint on maybe some of the confusion there.
So here's what I'll say, and this is how I'm interpreting this, because I know I have a perspective that I think that LACERA places a very high importance on the education of trustees. And I think without that education, I think it would be a challenge to really be effective as an accountability tool, particularly for a professional staff. And so I think that there's no question that we are on average more educated, and I think broadly probably, more in a better position to be effective as a board than the average pension in the nation. However, I do think that our policies are still evolving, and I wonder if that reaction was a reaction to policy, to the way that the policy is written, so the travel policy relative to the education, the educational, you know what I mean? Like, I wonder to what degree that's a policy reflection versus the fact that we as an organization do effectively get educated. And so I'm a little surprised that it was as low as it was, but I am the biggest critic of the travel policy as an example, because I think that it has the wrong priorities. I think it maximizes spending for a limited number of educational opportunities rather than the opposite, which is to maximize educational opportunities for a given spending level. But nobody wants to own the spending level, so they're willing to let it be uncapped in order to admit that it is a real investment.
So I guess I can see your point, and then I guess then that begs the question of, did we clearly define these categories enough for the trustees to gauge it consistently across the board? Because you raise a good point, but that was not what processed in my mind when I saw that.
Yeah.
I was thinking more of the education that's provided by the staff, as well as the conferences and the different training sessions. I got to attend investment training in Wharton School of Business, so I had a different thinking logic, and it's fine. But I think just, I guess, looking forward, maybe that they seem like it says board meetings, that's like got the highest score, and I'm like, oh, did we score ourselves and say, yeah, we do good meetings?
We meeting like nobody's business.
Right. We have the best meetings. I'm just like, how nice of us to rank ourselves so high. And so I think maybe moving forward, it seems like it should be a given, board meetings. But what was it for Gina when she ranked board meetings? What was she thinking about versus what am I thinking about? As far as I'm thinking about how the meeting flowed or the information that was presented. But then, I don't know. I just am surprised. Board materials is a 2, so that's lower than I thought it would be, because I think we have excellent board materials. I've worked in government for over 20 years and had to put staff reports together, and so and I know it's just my opinion, but anyway, I just think that in looking at some of the responses in the scores, and thank you for that, for mentioning that some of the numbers did look off, so you reached out to the trustees just to confirm. But I think maybe we don't take it for granted what these different categories are. Maybe in the future, add a little more narrative to it, just so that we're all on the same page. Or we just have an area where I guess we provide feedback, so we can explain why we're ranking it. Like if you're ranking anything less than a 1 or a 2, can you please explain it so we can have some, color behind why is it this score. Anyway, and that was just my overall sense when I read the whole packet. I know we're only on page 1, so I'll let you guys dig into it. But when I read through the whole thing, that just kept popping up at me.
Yeah, I think one of the challenges that I had, because I was curious in the output, it's one of those ones where you were answering the survey, and it's kind of like, I don't know if I'm really answering it the way I would like do it, because I wasn't sure like what the question was trying to get at. So it's kind of like, I think I think what's cool about what we do is that almost everything has a benchmark. And so when we say we want to be a best in class investor, then I'm always like, well, what's best in class, whatever. So like, even from a board perspective, while it's nice to pat ourselves on the back, and I like everybody, I don't know if we're really C students. relative to best in class, and we just all feel good about being C students or not. And so it was just really hard to kind of calibrate in any way. But
So I one thing I want to do is just I'm sorry to interrupt you, but
No.
one thing I want to do is I want to focus less on the challenges of how we interpret it, and let's like come to some conclusions about which of these items we think we do well and which of these items we think we are challenged to do.
Madam Chair, if I may, if I'm remembering correctly, I could not open up the link and actually participate in the survey. So I had to have a proxy internet connection link through staff to do it. And I don't know if something happened with that. If I want to say that this was the survey, I just could not, it wouldn't go past question 1.
Yeah, there was a technological issue with the first survey sent out, and then we redid it in Survey
And
Monkey.
maybe in that transition, because, you know, this scoring is not representative of what I feel like I answered to the survey.
So here's our opportunity to score. There are 5
Yes.
of us here. Let's score.
But I think the idea is to really peel back the onion. And so to Ms. Jones's points, I love that you had different readings and thoughts about how it goes. And Mr. Jones with the, you know, grading against the curve, like everyone's going to bring their own perspective into this type of a survey in a vacuum. And then this is where the work begins, is in this type of a setting. So, you know, while I understand a little bit of challenge and frustration with interpreting it, the idea was not to lead or, you know, pre-conclude anything. It was to be open-ended and to get this sort of feedback and dialogue and really make sure that if there is a change in forward direction, that it's truly built through a consensus and not through just a manipulation of how I ask a question in a survey. Which is also totally possible, but that was not the intent of this particular
well, it
survey.
wasn't so much how you asked the question. It was just kind of like, just compared to what, right? Like I just didn't know like how to answer without some type of comparison basis. Like I said, I think we do okay. I think, you know, we're better than average, but I don't actually know what average is.
Yep.
And so I think.
Oh, that's a good.
And that's
point.
also
Mr.
why we
Santos
sort
has
of-
a comment, though. I do want to make sure we do respect the hands.
Yeah, just looking at the what you were trying to get at, quite frankly. I mean, I'm going to be somewhat controversial. Like, for example, board education and development. Any changes have to begin from the board, and we have to set the example. Like, for example, there should not be a reason not to be at the board meeting because you attended a conference. We're not here to attend conferences. We are here to do the members that we represent work. So I'm even contemplating next time that we review the travel policy to put a limitation or a prohibition that board members should not be going to conferences that instead of being at the board meeting, because in terms of education, you learn a great deal at the board meetings. You hear from your colleagues, you hear from the consultants, you hear from the staff. That's powerful. And so there should be no excuse for somebody. And when you look around here, there should be more board members present here, especially today and tomorrow. This is the most important, one of the most important exercise that this board makes is dealing with asset allocation and all the other topics that we're going to be dealing with the next week. So that's one thing that we have to look at that. I've been critical with regards to the onboarding of new board members. And hopefully now, especially coming up next year, we're going to have brand new board members, in particular elected board members who may or may not come from the or have any financial experience. It is critical for us to educate them. Now, like for example, the external advisors, that score was 2 as compared to the. I wonder if anybody can make a comment as to your view of the external advisors. Remember, the advisors, if you're talking about the consultants, they work for the board. They have to work closely with the staff. But to me, it is very important to have an independent evaluation separate and apart from the board, from the staff. So that is really key. The board committees, my biggest issue with the board committees is efficiency. We need to be able to, and it was kind of interesting to hear from the staff that at least some of them who spoke up on that issue, they believe that committees are good. You know, we have the committees based on functional asset class. So, but how do we handle those committees? Again, efficiency is important. Can we take that particular item directly to the board rather than having the staff and perhaps the consultants go to the committee and then come back to the board? So we need to think about how we use those committees. Again, efficiency and education and understanding what we're doing, because that's the duty that we owe our members. So if we look at, rather than, I agree with Madam Chair, rather than looking at the format of the survey, let's deal with the real issues before us. The purpose of these meetings is for us to acknowledge where we can improve, and yes, pat ourselves in the back that we have done a good job. But to me, there's always room for improvement. Thank you.
I'll make a comment on the back of that, and this will be my, just sort of my comments for us to think about, and I invite everybody else, obviously, to join in the fun. The water's warm. Jump right in. So I would argue that we have some of the best materials. I agree with Ms. Jones on this. I think that if I were answering that today, right now, knowing what I know now, and I don't know what I did when I said that, I would say that the materials are probably a 1. I think that we have excellent materials. And in terms of the function of a board meeting, without good materials, it's very hard to have an effective board meeting. So, I think that's good. I think when I think about board meetings themselves, I think about the sort of board meetings are a function of how they are prepared for, how they are agendized, how they are run, and how they are engaged with. So that's a lot of different moving parts that have to all go well for us to score ourselves well on a board meeting. But I actually think we've had very good board meetings over this past year. I think that the staff has taken extraordinary efforts to ensure that we have the materials that we need in order to be prepared for a discussion. I have seen and observed that they're certainly agendized, and I think kudos. I think the board secretaries don't get enough appreciation for how much work they do to ensure that we're ready to go for go time, and so I think that works well. I'll leave it to you guys to let me know how I run meetings, but I don't think I've cussed yet, but I think that we have a very engaged group. I think that we have everybody kind of works and speaks that we speak in an equivalent way, and that there's no domineering voice within the board. I think that is a great sign. So I actually think that our board meetings are quite good, and I think we do deserve to give ourselves a pat on the back. Where I think that we have challenges, I agree that the travel and education policy, always fun as it is, does still need some continued thought to get that to where it goes. I would rank that as something that still needs improvement. We have made a concerted effort to revisit all of our bylaws, charters, and policies, and with that comes the sort of control environment that follows from those. I think that's a space that if you had asked me 2 years ago, I would have ranked that like a 4. I think we've actually made a lot of improvement in our kind of aligning our policies, but we still need more improvement. So we're moving in the right direction, but I wouldn't even give it a 2. I think it's still down at a 3 in terms of we're still harmonizing, and that's like up from a 5. So, you know, I'm pretty harsh when it comes to that, because so much of the control environment depends on good, well-written policies. You know, so I think that interaction with external advisors, you know, if you had asked me without speaking to the staff, I would say that our advisors are available to us when we ask questions. They answer them. When we have board memos that are brought to the board, we have a comprehensive advisor package that goes with that we can depend on. So I think from that perspective, our advisors do perform. But I think that we do have to, you know, think about how we create accountability, you know, not just between us and the staff, but also between us and our advisors, those advisors. And they're on a regular kind of cycle for being evaluated and put up for RFP. So we do have an opportunity, if an advisor is not performing, to replace them. But, you know, how do we give feedback in the interim? You know, I think that that's something, but I actually think that works quite well on the whole. A 1 or a 2 is probably appropriate right now, in my view. But if you guys disagree with me, disagree. And, you know, I think that I think the biggest challenge we have is overall governance structure. And I think this is a function of just governance structure generally. This is a self-policing governance entity, meaning that if one of us goes off the rails, it is the responsibility of everybody else on the board to figure out what to do about that. And that's the thing that I don't think we're necessarily very good at as an entity. And it's not unique to LACERA. It's actually unique to, it is broadly shared among most entities that try to self-govern. Self-governance is a challenge. So how we do that is something we have to really think about, because I don't think we do it well. And I think that's actually par for the course. So I don't think it's that we're underperforming every other agency out there. I think it's just challenging, and we have to be vigilant about that. But I'll open it up to, and Mr. Rue will let you kind of read the materials and catch up to when it comes time. We're just on slide 4, obviously.
Chair Sanchez, maybe if it makes sense for organizational purposes, I get a sense that we're going to get a lot of feedback in this dialogue.
Yeah.
And maybe I should have brought the bigger notebook versus the little notebook.
Ah.
But if maybe we could just advance the slides and kind of go by each of the areas, and when we're on that particular topic,
Right.
gather the feedback there, then sort of go around the horn and just capturing.
Fine.
Perfect.
Yes.
So could we advance to? No, I'm good. That was just a joke.
So,
Yeah.
yes. So for the summary page on 4, we actually have individual pages
Okay.
in
great.
terms of what the survey result was, and also with the 2.
Let's just skip
Yes.
to 7. Just go
That's,
straight.
yeah, 7. Sorry, I was running the.
There we go. Perfect.
Yes, perfect. So as Tim pointed out, the objective we have, we had in terms of this presentation is to really facilitate a dialogue and ultimately have conversation, feedback, brainstorming, to ultimately by November identify any areas that we would like to see for any potential improvements. And for that, you just saw the summary page, which already started very successfully in terms of getting some feedback and starting a dialogue. But I think, as Tim just mentioned, it will be good to go page by page so we can focus on the individual items. So the first one, starting with that, is the overall governance structure, where it's just as a refresher that we have 2 charts for all of the individual items in terms of the current effectiveness, 1 being the best, 5 being the least. And then the second chart in terms of the relative importance that was assigned by the trustees to each item. Again, 1 being highest and 3 being least. I just want to refresh that because my first reaction was I also looked at the opposite way initially, but 1 being best, number 1. So in that way, we can see that this is where we had a little split between the views, but majority, most of the trustees believe LACERA's governance structure is effective, ranking it 1 and 2. But there were respondents who voted it average and one towards lower than average. And I think this is an important page to discuss because most trustees rated it as 1 for importance, so high in importance, with a bit of split in views. So I wanted to open it up for any feedback and conversation in terms of especially who thought it works really well in terms of effectiveness and who thought maybe there are some rooms for improvement.
Mm-hmm.
You know,
You've
I
already
would-
heard from me. So Ms. Jones, did you
Yeah.
have your hand up or was
Yes,
that?
Oh, I'm sorry.
You know what, I also wanted to echo what Trustee Jones mentioned as far as determining or just, defining kind of what is most effective. What is that? What does that look like? What are the parameters that create that? I know in some evaluations, for example, they give these parameters for if you get a 1, which would be the most effective, it means you show up on time or you meet deadlines. You know, there's these,
KPIs.
Yes, exactly. And so I appreciate hearing the feedback from the trustees. Unfortunately, this is a written document that gets published.
Mm-hmm.
And so it's missing all of this texture that we're sharing today. And I'm just really just sharing this as moving forward because when I read this prior to us having this dialogue, I guess I walked away with a certain feeling based on some of the responses. So for governance, specifically for myself, I looked at it as governance is how do we flow and operate? Do we fall in line with our policies and procedures? Do we have internal controls in place as far as if, as Chair Sanchez mentioned, if we have someone that goes off the rails, what is our reaction time? What plans do we have in place to address it? Are we prepared? And so when I look at those parameters, I felt like we are doing really well. Is there room for improvement? Of course, but that we're really doing well. But is that a 1 or a 2? I don't know. It's so subjective because we haven't defined, well, what is 2 versus a 1? I'll put all that aside to say that I think I agree with Chair Sanchez. There is room for improvement in this area because there are some things that we need to, some things you never know until it hits, right? We all thought EOC was well prepared and then COVID hit and we realized we had a lot of work to do on our emergency operations, centers because we thought we were prepared. We had these procedures and policies and everything written, but then when it came to actually, implementing, it's like we find out we're not as prepared as we thought. And so I think what Gina is sharing is, across the board, not just our entity, but other entities, this area of governance could be really kind of tightened up more, right? And tested more,
Yeah.
and to know that really we do have good governance because if something does go wrong, it shows up, it's addressed, and it's dealt with right away. And can we show that in some way? But I know that my score, at least I think my score, was more on the high side for this because again, I look at it from a perspective of how people flow and operate according to the policies and the procedures that are in place. And are we all kind of in line and in flow with what has been created as a governing document? And so that's why I scored it high.
Okay. Do we have any other opinions or perspectives on that?
I got my hand raised. Is it not showing
sorry.
up?
I'm not seeing them. I apologize. Oh,
No, that's
here.
okay. That's why I wasn't.
I'm changing my view so that I can see everyone. You may go, Mr. Jones.
Oh, okay. So I think the question we have is if we're on our way to $100 billion, which I think is kind of like the next milestone, that at least the CIO and you all kind of put ahead of us, then it's probably a healthy habit of us to be somewhat insecure in our self-appraisal, right? Like, I don't know that there's any, and so I think we're partly relying on the feedback that says when you're managing $100 million and all the other complexity that comes along with that, is the current board format that was maybe good from 50 to 75, right? Is it good from 75 to 100? And so that's where it would be on the importance. I will admit, I was one of the ones that I think ranked us low on this, just because, if for no other reason than just as an athlete, there's always somebody faster, stronger, better. So you're trying to figure out a way to, to get there. So, so that's where I think I probably understated most of the numbers a little bit, just from the gap question of the gap analysis of 100 million to 75 million. What is that? And then when you look across these issues, do we line up with that? So I'll admit I'm one of the low scores.
Yeah. And it could be that you're simply reflecting the fact that if we actually had some of these scenarios we've just described, you may not necessarily know off the top of your head what to do about it. And that may be what you're reflecting in that comment. Table exercises and scenarios was something that I had thought would be a way to bolster this preparedness.
Yeah. And can I just share real quick, just for the future? I mean, I get exactly what you're saying, and I agree that there's room for improvement. I guess I'm just still, and I think I've shared it, I just want to share it again. I'm just a little concerned that it's not really reflected in this printed document that will be on the website and there for people to see, and what are they walking away with when they read this? So I'm just wanting to share this for the future, and I won't.
And this is a draft, and I do think we have to make sure we somehow underscore that. I agree, which it doesn't show that right now. So a valid point.
Yes.
Valid point.
And yeah, ultimately this will conclude with a series of policy recommendations, all of which will be, very concrete, and then we'll articulate all of the reasons why any of those changes are made. So from like a, reader's perspective, that'll ultimately be the document that I would point someone to, as opposed to just this, which is simply trying to gather feedback.
More feedback.
More feedback.
Yeah. So do we have any comments from the left side of the horn over here on your kind of feeling in terms of how prepared you feel to respond to any kind of a board crisis, emergency of any kind, governance challenge, let's call it?
I think we talked about this recently with the question that came up, and Ms. Jones will remember from Wharton, is democracy dead? And I think that my short time on the board, but I do have experience on working for our union, and the issue of someone going gunny sack or freaking out, so to speak, I think would probably be handled in that democratic process. And my observations of how this board and the board of retirement addresses issues, it's with maturity and a thoroughness, and I think in a respectful manner, even if it's disagreed. So what if the possibility of someone going haywire or whatnot, I think it would be addressed swiftly and probably in a manner, and just if the result of that is I think they'd still be able to be heard and whatnot, but I don't really see it as much of a threat. I think that the traits of all members and staff included, the positive traits, the maturity, the robust discussion, the analysis, educating themselves, getting into the weeds on stuff. I think all that will prevail. So I don't really, see as far as self-governance, I believe democracy in the process is extremely strong here. So I'm not too worried about it.
All right. Okay, we're starting. Yes, Mr. Ryu.
Just quickly add that I scored it as relative importance as very high. I was one of the ones. For current effectiveness, like my colleague here, I'm fairly new to the board. See nothing wrong with it. I think we're operating effectively. But obviously I haven't been through any external or internal crises. And I have heard of previous stories, but I think the board is pretty well positioned. However, the one concern I do have is there's such a huge turnover right now, or there's going to be a huge turnover. So I did feel like a security blanket with, our board chair and some of our more experienced board members who have the history and the knowledge. The good news is, I hope you guys don't skip town. You're still going to be around for us to.
You have my cell phone.
But I was concerned about the large board turnover, which is no fault of anybody's own, nobody's fault. And so I did raise later on in the later slides, higher need for training, education. So because that's the only way to.
Yeah. That's a really
besides time, right? Besides time, just seeing the iterations. So I think I'm almost going on 1 year now, but I'm still.
But human institutional memory and oral history does not take the place of institutional maturation.
Yeah, so for this one, I think I scored relatively high on both, but I want to put the caveat for the later slides. Education is tremendously important.
I think we're getting to some consensus here. On this.
That's awesome feedback.
Yeah.
Thank you.
Okay.
Yes.
One
And
down.
then peeling from the layers of overall governance structure, the next few pages all relate to each other, but the next page is bylaws, charters, and policies, where most of the trustees rated highly for current effectiveness and in terms of relative importance. Unless any additional feedback that would like to be shared, I'll move on to the next page, which is about the board meetings.
Go ahead.
Based on my colleagues' comments, one of the issues that we should think about in the future is, so what happens if a trustee, I think you say haywire, they go haywire, whatever. How do we enforce our policies against a particular trustee? Right? So if I go haywire somehow, what mechanisms do we have to police ourselves? I believe that the current policy doesn't have that. There's something for us to think about that, because I have seen it in the past where the trustee just, in my personal view, went totally the wrong way, and we had a very difficult time dealing with this particular individual at the time. And I believe that we still have that issue, so it's something for us to think about.
To vulnerability.
Exactly. What happens in that, like you said, Mrs. Jones, is that we all think that we have all these great policies in place until we get challenged with a new challenge. So anyway, something for us to think about that.
Yeah, the room for improvement.
Yeah.
And I think, go ahead, Ms. Jones.
Oh, and I just wanted to append to your comment with also making sure that our policies and procedures flow with each other and not conflict with each other, where you can.
That's my comment.
Right, where you could take two different interpretations
and play mommy against daddy.
Exactly. And so I think I agree. That's a review that really is a continual process, right?
Mm-hmm.
You can't even do it and say you're done, because then things change out in the laws in the world, and then, or somebody does something strange and it's like, oh, now we need a new policy because we never even thought of that. So it's ever evolving, but it's always area of improvement.
Yeah, and that is speaking to this particular slide here, which I agree with. I think that there's always room for improvement. We have made a really concerted effort. I know staff has made a concerted effort to work on harmonizing and, quite frankly, updating some fairly old policies as well. And so I think that we've seen a lot of progress here. But, it's one of those things that, unfortunately, there's always more progress. Yes. Yeah.
And
yes.
Madam Chair, Mr. Santos, he's lived through a period where, and it's speculation. It's probably got a sliding scale. There could be a grossly independent opinion of something going on. That would be on the lower end. Someone that's maybe disruptive or animated to a point of, deconstructing the process. And then the other side of that is, violations of law and policy. And I think, in my mind's eye, I'm thinking of more of the disruptive, working against the flow, so to speak, of the process of analysis and the democratic process. I think there is rules and laws in place that would either fine the individual or there could be gross repercussions, legal repercussions.
We don't have that.
Unless you commit gross fraud, we don't actually have any other mechanism. That's the challenge.
It will be up to the district attorney. So that means a criminal violation. Other than that, we cannot be removed. The only way I can be removed is by the members. But anyway.
Yeah.
So
these are things to think about.
Yeah, and maybe that as that situation arises, then through the process of debate and discussion, and maybe that's when it becomes addressed, and that I believe is robust in this group, that we would have the ability to sit back and go, okay, what are we going to do about this situation, and then move forward from there.
I think my experience is you want to fix the roof while it's sunny, because when it is raining, it's challenging to then say, okay, let's step back and think about how we want to enforce this sort of conduct, because that moment won't happen. Yeah, it's often too late. It's a challenge. It's just a vulnerability that I think is worth kind of acknowledging. And I think what we're acknowledging on this slide is that that well-written policies and procedures probably should also sort of contemplate that element with regard to the board, but quite frankly, that the policies themselves shouldn't be in conflict with one another. I think that that's valuable. Any other comments on this slide? I don't think there was actually much disagreement.
Yeah, and maybe just to quickly summarize the takeaway, I think the first is, making sure that the policies are harmonized and evolve. And I think staff has done tremendous work over the last several years on that, but it clearly is an ongoing process. And then the other one would be just do a little bit of research on, any enforcement mechanisms or other tools for sort of self-policing or other controls that can be put in place.
Okay, well, with that, we can move on to the next page, which is already on the screen, board meetings.
And
I'll
so good.
Yeah, basically, most trustees current rated effective and important in terms of the results. Board committees, sorry, the page went back, I guess. Board committees was the next page. Yes, and here in terms of
Did we want to get any feedback there?
Yeah, can we
for the
get
board
feedback?
meetings?
Yeah. Let's
Sure.
pause at each slide. Go ahead, Ms. Jones.
Oh, I was saying, I was curious if the person wants to share, what would be the concerns for board meetings?
Someone gave it a 5.
Yeah.
You don't have to admit these are.
I'm just curious if there are concerns, what they are.
The concerns that I have is I see colleagues that come into the board meetings and have not read one, not even the summary. I mean, I remember when we used to get the hard copies, see colleagues ripping the envelope at the board meeting. and by some of the limited questions that they were asking, clearly, again, they didn't even look at the summary. So we all need to do the homework, and that's really important, because for me, as a beneficiary, I welcome your opinion from my appointee colleagues, because my interpretation of the documents coming from the staff or the consultant may be different than yours. And I want to hear that. Even if you disagree with me, I want to hear it, because perhaps I'm wrong. And that allows to get more consensus with each other, so that we can make the right decision. So that to me is key. Attendance is important at the board meetings, and being able to disagree in a very respectful way. We cannot be making rolling our eyes or whatever we all do when we hear a colleague asking a question or making a comment that you personally may think is silly or stupid or whatever you want to call it. We cannot do that because we should encourage everyone to provide your feedback, your input. It don't matter what is coming out. What's important is that I get to listen and figure out one way or another. One thing I can tell you is that the board colleagues have been really good in being able to disagree with each other by going through the chair, and I disagree with so and so, and this is the reasons why. It's all very important, and we do that effectively, but we need to be better prepared, in my view.
That's valid. That's a really, really important point. Okay.
Can I have a
Yeah.
comment? I 100% agree. And if I had thought of what you just shared, probably would have changed my score, because I do think that being prepared and attendance are, really important. I think when I looked at it, I was just thinking of how we conduct our meetings, the work that's produced during the meetings. But I agree with you. We can agree to disagree as long as you've read the material as
as well as I have.
As I have, so that we can have an intellectual debate over it versus, being an uninformed debate. But I also just wanted to put out there, I know in my own organization, the what would be like the board members have a little bit more time to review the material. So I don't know if we want to consider if we can get the material a day earlier, just to have a little.
Half of the staff just fainted.
I know it's a hard ask because I've been on the other side having to produce the material early, but I just know that giving sufficient time may help assist with being prepared as well. Or at least we really get to say you have no excuse.
To find time in a week.
Right, exactly. So I'll just put it out there. No need for a consensus or anything. I just want to drop it out there to see,
It's dropped.
Yeah.
Okay. All right. Those are great comments. And that was fantastic listening as well.
Mhm.
I agree with that.
Yes.
All right. Any other comments on this slide? We'll keep moving.
Next page is on board committees. And here, most trustees believe LACERA's board committees are effective. In terms of the relative importance, this is the first page for the series that we're seeing a little more split views in terms of the relative importance. I wanted to open it for any discussion if there's any you would like to make.
So I'll throw out a comment here. I actually, one of the things that the committees creates is sort of a stopping point before the board, which can create up to 6 months of prolonged waiting to push things through in terms of investing. It slows us down. I think that if we do take the continued efforts toward delegated authority, I think that issue goes away, and then the committee structure becomes an educational opportunity rather than just a stopping point, a kind of wrench in the process of investing. I think that is probably if we kept things the way they are, I would also think that they're just not helpful. It slows us down as an organization. However, if we do remove that as an impediment to investing, then the committee structure becomes an opportunity to create kind of what I like to call shelf life educational pieces that new trustees can look at when they come on board as part of an onboarding process. And we can create a living kind of library of things we've learned in the committee context. So it can just give us an opportunity. And also staff does a tremendous amount of work. I think it is unfair not to give them the opportunity to tell us about what that is and what they learned and how they do things. I think that it's a really great opportunity to be able to involve more staff members in the process of communicating with the board. So I think that it serves a lot of purposes. But if it's an impediment, we will resent it a little more. I think we can remove that issue with the right set of policies, and maybe make it more effective in terms of, that other educational use that it could have. But Mr. Santos.
Yes, the original thinking when we decided to establish these committees was to allow for the board members to specialize in a particular area. That gave me the opportunity to become as proficient as I can for a criminal lawyer in private equity. And it was, to me, was very educational. But I don't want to see ourselves silo in a particular area. So I question whether that is really effective, if that's what we want to do. Do we want to make sure that we all are at the same level in terms of knowledge? So I question that, whether that is, and I'd be interested to hear from staff, particularly Mr. Grable, whether or not you think that that particular goal that we set out way back when we decided to establish the asset class committees, is that really working? What's your view on making the changes? I know some of the staff that we talked to in those lunch meetings, at least one particular individual said that they thought that committees are good. So I think in that situation, because the staff has to do a tremendous amount of work in preparation for these committees, and then again, a month later or so to the board, is that the right, are we looking at these committees the right way? And again, I believe in efficiency, and definitely looking at it in terms of what will be the role of these committees if this board does decide to delegate authority to the CIO.
I think that much of what the chair was saying, I think that the committees are best used for education. I think that it's really a way to develop current, relevant knowledge for everyone, because they're open to the whole board. I think as the way station to an investment may not be, the optimal use of the committees, but I think that the committees can be best used for education. As it relates to trustee specialization, I think trustees have the opportunity to go to conferences or educational opportunities for areas that they may find interesting, but the portfolio is so dynamic. I think that it's trustees, and please correct me if I'm wrong, aren't on the board for expertise in a particular asset category. It's more about general governance, policy, and oversight. So, and just one tangent is the discussion about policies that we just had. I think that the board has done a tremendous job moving away, not just policy harmonization, but moving more towards principle-based policies as opposed to rules-based. And I think that makes them much more extensible also. So, but hopefully I answer the question about committees.
Through the chair, if I can push back a little bit, is, well, how does the staff feel that you provide an hour or so of education, let's say at the private equity committee, and then the matter goes to the board the following month, and then there's a couple board members that never attended the session on private equity
on drawdowns,
and then all of a sudden we get hit with all these questions that were covered. I always question whether that was sufficient. I mean, if we can get all the board members to come in at 8 o'clock in the morning when we have a particular meeting, that will be different. But I see many times that we don't have everybody here. So in that situation, I question whether or not it was better to educate the entire board.
And make the committees everybody.
I see the point. If I were to craft everything, I think that the committee should be the whole board in that sense for the general education. If it's not the way station or the preview of an investment, then there is benefit to general knowledge for all trustees. So I agree with that.
Something to think about. Yes, Mr. Rue.
Yeah, this is again, being a newer board member, I didn't want to comment, but as Trustee Santos is saying, from my limited engagement of our board, of the committees, yeah, I do. I feel like it might be. I wanted to see the cycle at least once or twice to make that same assessment as Trustee Santos, but yeah, it seems like it's a repeat. So, and I can't speak for all the committees because I'm only on some of them, and I'm on the more the equity ones. So it's the ones that are focused on anyways during the board meeting. So, if I combining it, I think would be a more efficient way instead. But then again, I do want to see the cycle a few more times to see if that is the case. But in general, from what I've seen so far, I fully agree with Trustee Santos on that.
I have a slightly contrarian point of view. From being where David was a year ago, and then I remember going home and telling my wife, I said, I think I drew the short straw because they made me chair of the Real Assets Committee, right? It's kind of the one that nobody wanted.
The most fun.
Yeah, through that one. So, but anyways, it did give me like an immediate area of focus because I felt, again, just from a teamwork perspective, saying, okay, well, if I'm in that charge, well, then I need to deepen my education in that thing, which then directed me, well, how well have we been doing in real assets before? And then, well, what are the gaps? And so it just kind of gave you a sense of direction. Now, I will say the tempo of the Real Assets Committee is very infrequent compared to the other ones. The conferences that I choose, 75% of it directionally is towards the area of expertise. So I don't, again, from an optimal $100 billion board, I don't know if we can expect everybody to do everything, right? At some level, do we break off into some areas so that, at least for me, from a real assets perspective, as Herman and I even were in Berlin, it's like, listen, I'm here, I'm taking notes, I'm doing everything because in my mind's eye, I want a best in class real assets and infrastructure program, right? So then, yes, you trust the staff at some level, but I think part of our role is also getting competent enough to where we can hear what they say and push back intelligently and everything else. And I just think that takes a little bit of focus, like in that area. And so I would be hesitant. And if anything, I would say, just for me, and I haven't necessarily talked to Jim about this, at some level, there's Jim Rice, who's the lead investment officer on this, is just kind of getting like, okay, well, I've kind of felt like the way the committee's run as a board member, I've been a little bit passive. Now that I feel like I've finally gotten up to a level, like I do want to say, hey, have we thought about X? Have we thought about Y? Hey, I was at a conference. I noticed Daniel came over a little earlier in the conversation. I said, listen, I noticed this is a very familiar theme. I'd love to find out more about what we're doing specifically in that. And I don't know that would be a large committee conversation. It seems like that would take place inside the committee thing in that role. So if you think about the board members of the future, and if we want people to have a higher level of commitment, I think that also means we need to give them a higher level of direction so that they're not kind of just wandering and then just kind of figuring out, well, I guess I can be useful if I'm over here or over there versus saying, hey, we really need you to kind of help the entire board understand this area well so that when we have these conversations on a larger level, you can kind of be the person that says, yeah,
That's such a great observation, and I think it actually underscores the intent that Mr. Santos kind of vocalized earlier, which is you're saying that when you got that kind of responsibility, that it engaged you more greatly, and if we split up the work of the board that way, it can create greater levels of engagement. And maybe not every board member becomes engaged in everything, but that's probably not the way you want to do it anyway. So that's a great observation. Yeah.
I think it's bandwidth to your point, and also to yours. I mean, it's a lot. There's a lot of stuff to nuanced stuff and to get into, and we have people on their own time, government time, all that stuff, and we can't necessarily get into anything. I think it's but the information's there, which is good, and anybody can join. And I do see the value in everybody being engaged in it, but that's a great point. I agree with both sides of it, which is that, it gives you that, it allows for that hyper focus, and again, my understanding of these committees is to, kind of have the dialogue to bring to the board to, so they can focus on that. I don't know, it's tough. I mean, being new, I don't have the bandwidth to do everything. I mean, that's an honest statement, but I'm getting my sea legs, so to speak. I think, and I think as that will generate more bandwidth, for that. So I wish I could be everywhere all the time, but so yeah, it's a good point.
Just quiet, just listening to, just knowing that there was a lot of background. I didn't want to ask the stupid question all the time. So sometimes I text Gina, well, I thought I heard this. What was that all about? Right? I mean, just trying to catch up without being disruptive to the flow of the board. So.
Yes.
Since you brought that up, and I really appreciate that. And that's why I was a little hesitant to comment on that right now, because I haven't been through the cycle at least 1 year. And I'm really glad to hear Trustee Santos say, there's no stupid questions. And actually, I remember saying that to my staff. There's no such thing as stupid questions. Ask. But I have to admit, I don't ask, right? Because it's, and what I have done is after the meetings, I've been meeting with staff and asking 1,000 questions, right, and writing them down. So, yeah, I guess the difference in styles, right? I guess if I was a chair of a committee, that would up the bar for me to be even more engaged. But
you will be next year.
Well, I should not even mention that. But yes, I think that is a good point, because committee or general or the main board meeting, I tend to refrain from asking questions, and I just write it down and I ask separately afterwards. But yeah, but I could see your point on that. So we'll see.
Okay. All right.
I think, sometimes to a fault, but I think it's very important. And yes, there's been great mentorship from board members and staff, that have tenure in that. But I would encourage all board members to, if they have a question, germane to the topic, to ask it. That in spite of the risk of being vulnerable and failing, to dare greatly, as they say, and put it out there. I mean,
risk becoming a meme.
Yeah, at what loss, I mean, and so, I want to keep asking questions, whether they're for the membership that I represent and for my own knowledge,
Yeah.
No, I will say one thing as a compliment to the chair and to Herman before, and then who was the chair before you? Was
David Green?
David Green was, again, as a new member, and I realized, there's some of us appointed, but I've always kind of felt like, or at least when I came in, that there was a collective effort. It wasn't like individuals just kind of meeting with competing agendas, or at least maybe I was naive enough not to pick them up. But so I think maintaining a team orientation, right? And I think by doing that, having certain roles and feeling that my investment of non-compensated time doing X and X is really my obligation back to the team, and then back to the members by extension. And then I think that way we can continue to maintain a level of collegiality, and kind of we're all trying to pull come together. And just compliment to the chair, because I've never felt like it was different sides or faction, then you had to decide whatever else. I kind of felt like everyone was trying to pull together. Yeah.
Thank you. All right. So I think we are getting some consensus here. The next item, I think we've sort of already covered on governance. So I don't know if we have more on board oversight.
Can I make one comment
Absolutely.
on the committees? I think one thing that, the current committee setup is a decision-making entity. We are also broadly having some conversations of delegating authority. So then that leaves the void of what then for a committee, which I think Chair Sanchez mentioned education, but I also wanted to point out in a delegated environment, oversight becomes the much greater responsibility. So while the charge may change slightly, I still think the importance of having some of that specialization may come into play.
Good point.
And in a positive way. Like right now, when you have too much specialization and then you were to have turnover, if the group's relying too much on, you know, a small group of people who are highly trained or specialized in an area, you have a vulnerability. But in an oversight role, I think that specialization could be quite powerful.
That's a great point. Thank you. Let's make a note of that as well. Okay. I think on the next slide, we've kind of discussed it
Board
in the
oversight.
context of governance. Does anyone feel like, because we have many more slides and lunch will start getting cold. All right.
And then the
continue.
next page is the board education and development, which we kind of talked about during the summary page. So I'll just immediately stop and see if any more comments.
I've got one comment again as a new person who's been through, who was a freshman through the cycle. I think we could structure it a little bit better just to make sure that as a new person coming on, you know, I took the online Berkeley class, which I think is a requirement. But I think if there are one or two kind of basic, you know, public plan, finance classes that you just build in as that core foundation block, right? That's through there. And then, you know, maybe define the elective set of series. Because, you know, Linda and I, half the time, I'm texting her all the time. Like I get an invitation to a conference and the first thing is like, is this worth going to? Right? Is anybody else going? Right? It's just trying to evaluate whether it's worth, like it looks interesting. They all look interesting. Oh, here's the speakers and da 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 da. But not every conference is equal. And so I think maybe even coming up with a short list of what we have found over time to be truly high value experiences from the board would be helpful in that sense. Mm-hmm.
You know, on that note, that just made me think. You know how we have the list of all the upcoming conferences. If it's possible to notate which ones are more conferences versus educational, right? Because like obviously the Wharton one and the Berkeley one, we're told we have to take one of those. I mean, that's a requirement. And I thought the Wharton was. I went to the Wharton one; it was fantastic. But I'm always calling Linda asking which one is this and what is that, and then other people are finding all these other conferences. So it would be great if there's a notation just so we know which one is more educational focused, like the Wharton and Berkeley, versus you know, the super returns.
May I make a recommendation that in previous meetings has been considered unpopular, but we really should consider having a mandatory write-up evaluation of the events we go to, so that when people ask about these rankings, Linda has more material to draw upon, so that we know if a conference wasn't worth going to and someone made the mistake of choosing it and going to it, that it gets noted that it was not as valuable as it was costly. Because the other thing that we have to think about is cost effectiveness of, you know, I think that would be an important element to help us evaluate what we do and how we spend our time, and how others may choose based on our actions to spend their time. So if I go down that rabbit hole, you get sucked down that rabbit hole too, because you didn't know that I thought it was terrible.
Well, currently, if I may, Madam Chair, the Travel Policy Committee, and please correct me if I'm wrong, Mr. Rice, it requires that every time we go to a conference, at the next board meeting, we make a report, verbal report, in good of the order at some point. Yeah, and that is critical because we need to hear
what do we get?
Exactly, and that's important.
Yes, the current travel policy does require that report.
Right. Okay, kids, homework. Good to know. All right. So any other comments on that? we'll just keep trucking right along here.
And then the next two slides are a little more about the staff, with the first one being board and staff interaction. And the graphics are very straightforward, so I just immediately open up for any feedback if anybody would like to share anything here.
Well,
go for it.
Can I ask a question? So I think I kind of feel like I've probably had the least amount of staff interaction. Like I'm always hearing about, oh, well, we had lunch with so and so, we did so and so, and I was thinking, wow, am I supposed to be doing that? At that that level, beyond the meetings. I mean, is there a modest milestone that we should put in place? Should we ask? I mean, I would set it aside as part of the time to do it. It's not necessarily convenient per se, right? But like if it's in the collective order, staff would like more interaction with board members away from like these type of meetings or something else, say within the subset of the committee, the real assets, getting a chance to meet with Daniel and Jim and the rest of the team. Like if that's there, again, it wasn't explicit to me, so I never kind of made it a point. But then as I just began to listen more about other people who were meeting with staff, I was like, well, why am I being derelict by not doing so? So I'm not sure how to evaluate that question. So I'm kind of asking a question.
One of the things that I did that it was really powerful for me was coordinating with staff when they were going to a particular conference or they happened to be in town around a conference that I was attending, and be able to ask the staff, do you mind if I sit in some of those meetings? To me, that was really powerful. One, because I understand how the staff does the work, and also educated me tremendously in the process. And so that's one thing that we should think about, whether we want to do that, especially if you are going to be in, let's say, in New York, for argument's sake. The staff is usually in New York doing due diligence, and do we want to sit in those due diligence or whatnot? So that to me was really educational.
Yeah, that is a good point. I do think that we want to be careful about the ride-alongs because you do change the atmosphere with your attendance. And so I want to make sure that we don't impede the staff's ability to have frank discussions with their managers, because the manager starts kind of orienting at you rather than the staff person who's trying to do a job. It is a challenge. However, I will say that doing it on occasion is probably helpful for your own learning process. But the idea of coordinating when staff are going to a conference and you're going to that conference because they're speaking, and carving out some time to have a coffee and catch up and have them have an opportunity to have interaction with you that isn't formal and televised on Zoom. That I think is always valuable. And I think, staff looks for opportunities to have that interaction. So I think that cognizance is important.
Right. And through the chair, if it pleases the chair, I would like to ask some of the staff members that I had the opportunity to attend some of your meetings. Did it change the dynamics? Did it help? Did it not help? Because I think it's really important.
They are not going to say it. That is so unfair, Herman.
I'm going to...
You don't have to answer.
I think, and I'll say it not for staff, I think that when I go to a meeting with staff, I take the air out of the room. So I think that we have to just look at the context, the type of meeting. Is it a first meeting? Is it a follow-on meeting? Is it a long-term relationship? Is it just a general update? I think that the context and the nature of a meeting really depends, but I recognize that my presence in a room changes the meeting, that everyone in the room looks at me, and if it's a first meeting, if it's diligence, that diligence isn't happening.
Yeah. There's something to think about.
It was interesting because at the lunch meetings that we have with the staff, when I asked a question directly, not one stated that it changed the dynamics of the meeting. And if I remember correctly, in fact, the staff said that actually it was helpful. So it is something that we need to be honest with each other, with the staff, because the last thing I want to do is be at a meeting that is going to change the dynamics of the meeting. I didn't see it because I was quiet and I was just mesmerized with the staff's ability to ask questions and push back. And the way I interpret it, it was like if I wasn't there. And I like that because I really had very limited to add, or I wasn't going to ask a question because based on what the staff was doing, I was afraid that my question might be stupid. And that would be embarrassing as compared to a question here in this board meeting. But anyway, that's my view, something for us to think about, because it might enhance the ability of the board members to understand what the staff does in the subject matter.
Mr. Green.
Downshifting on the same road. I think it's pure intention to try and gather as much information, and as Mr. Grable said, it's probably a timing thing. But I would like to, generally speaking, I have to say, I gave this high marks. Staff has been incredibly helpful and available and patient, and with interactions, including outreach, which, and I believe it's important, and not only for informational purpose, education, agility and understanding of stuff, but also building that relationship. And so I rated this extremely important and effective. I think that they're going above and beyond, at least for me personally, and I think it should be noted. So.
Okay, thank you, Ms. Jones, and then Mr. Yu.
I wanted to, I'll echo what Trustee Green is saying, because I was actually curious when I read this, what would cause a ranking of a 2, 3, or 4, because my interpretation of board, staff, and interaction, was geared towards, the staff respond to questions, to requests from the trustees. When we come up with ideas, how do they implement those ideas? When we have discussions and problems or issues are addressed, they come back with solutions. And so, I really thought this board and staff interaction would be a very high score. So I was really surprised by the variations.
Yeah. Okay, I'm going to do a time check right now. It is noon, and I know that we do not have heating facilities for our food. So I wonder, Mr. Grable, if it makes sense to pause this discussion right now for lunch and pick it up and allot a certain amount of time so that we can kind of get through the rest of the materials that we want to go over this afternoon, which means we might gobble up some of the conversation we were going to have on capital markets assumptions. Is that okay?
Yes.
Okay, great. Well, then let's go ahead and take a break on that note for lunch. We will come back at
1 o'clock.
1 o'clock
Sharp.
and begin this conversation from where we left off. Thank you.
Recording stopped.
up at slide 14 of 28, which is LACERA staff.
Yes, so we just discussed the interaction component. The second part of the staff was the staff itself, LACERA staff. And in the interest of time, I'll just open it for conversation and feedback immediately.
Okay, well, I think we all agree it's important.
Yeah.
Yes, Mr. Ryu.
Just wanted to concur with what a lot of the other trustees said. I think I can't remember what I scored here, but I do want to say that staff has been super responsive, and I've every time I've reached out and I've met with a lot of staff for them to give briefings and presentations. So I just want to say that they've been super responsive on the numerous questions I had. So.
Right.
Can I share? I was just curious to see, I'm always the one that wants to see what other people are processing or thinking when, they're ranking like a 3 or a 4 or 2. What areas of improvement do we think should be implemented?
And this category, by the way, staff effectiveness is staff doing their job effectively.
Right.
We all agree on that.
Well, at least that's what I interpreted it to be. So I was just curious what our trustees felt were areas of improvement in this.
Just one brief comment. I think what is really important to remember from board perspective and the staff relations is that any action requires an affirmative vote by at least 5 trustees. And the problem that we have had in the past, that you have one trustee that goes to the staff and say, I want A, B, and C, and the staff person feels compelled to respond. And that's something that if one of us wants something in particular from staff, it should be raised at the board meeting and asking for whatever, and at least everybody's aware of that, and the CIO or whoever has the ability to either push back on that request or no, we're going to work on it. But I think it's important that we all understand the level of authority that we have or lack of, because we cannot function without our colleagues.
Okay, so that's use of staff resource by board, but I'm thinking then that's a good comment for sure. From my perspective on staff effectiveness, and this is my experience having done the onboarding 6 years ago, interacting with staff in the interim and going on that listening tour, is that to me, there's been an incredible commitment at the staff level to professionalize, and the staff, I can see a pride of work and a pride of authorship in terms of what they do. And your comment about people not preparing, it's most insulting when you spend a portion of your soul in that, in trying to present a really cogent and coherent argument in your materials that nobody reads. So I do think that from that perspective, I would rank our staff a 1. I think we have an excellent staff. And one of the reasons that I feel very confident, thinking about delegated authority is because I have seen the commitment over the years to that continuous learning, that commitment to, and in fact, the fact that the staff themselves were so reflective about the fact that we need well-designed policy at the board level. They don't want enough rope to hang themselves with either. They also understand what incentivizes people to not take authority or to not take ownership, and what incentivizes people to take ownership. And all of those are really good reflective observations. So that's why I rate them a 1. But that's my comment.
One more comment, if I may.
Yeah.
The staff has been incredibly responsive, especially when we get invitation to speak at a particular conference. I think it's really important to work with the staff. The staff will put a presentation together for you. And what I've done in the past is I tell everybody, anything that I say is not a reflection of what LACERA is doing. If you wanted anything, go by the presentation, because that's the official LACERA position on whatever the issue may be. And it's really important, because the last thing you want to do is get up there and say something that is not correct. So that interaction and the fact that, like in my case, the staff have taken the time to meet with me, go over the presentation that put together. They make sure that I was fully prepared, so that way we can be effective and look professional.
Okay. Any other comments on staff effectiveness?
I'm sure. I mean, to your point, I mean, I have some anecdotal tethering here, which is there was a situation that we had, this recent, the recent contribution report, and it needed to be addressed to, constituencies. And as an example, to Mr. Santos' point and everybody else, staff was more than available. It required patience on my behalf to ensure that I was delivering the proper message. And with diligence and a thoroughness, staff enabled me to and provided me what I needed to deliver that message to, make sure that everybody understood what was happening and whatnot, without talking about the who, but the what. And so it was, it's good. I mean, that's like my stance is still the same. I rate, staff's effectiveness is I found no mediocrity in any interaction or anything. I'm very impressed. It's humbling to be a part of this group and the efforts that everybody that does, and many things. Again, like I said before, the availability, the patience, and
Great. All right. Super. Moving on to external advisors. We have had some comments that Mr. Santos has already made about external advisors and their importance, I think, to the board. I'd love to hear any other comments about how you have felt like you could utilize them, and are they helpful to you?
I'll just say I meticulously read the documents they put together, which I find are very informative, and very factual based, not a lot of their opinion, which I appreciate. They also put in the very back of many of their documents, they have their disclaimers, like these are things you should be aware of. It's there, it's written, and they have it color coded, so it's easy to reference. And it facilitates me to be able to ask questions during the meetings from an informed basis, from being able to read the documents that they sometimes prepare. I have not actually interacted with many of our advisors personally, but I don't think it's necessary. If I felt like I needed to reach out to them, I'm sure they would be responsive. But I have found that their material has been, sufficient. So I haven't, had a need.
Felt the need.
Yeah.
Interesting. Great. All right. Any other comments here? All right. We're making progress. Board materials. So here we've definitely discussed this quite a bit on the board materials, but I'd be happy to entertain any other comments if you have any other comments about board materials. Current consensus. I mean, the one comment I will add to it is that the board materials have evolved dramatically since in the 6 years that I've been here, in terms of, templating and being able to create an expectation for board members to see more or less the same format really helps when you're digesting a lot of information. And so I really appreciate that effort that you've made to templatize. And of course, you have the best designer. We have very good presentation design. It's really impressive. And I think that the addition would be to build or create a guide to for new trustees so that they understand how to interpret what they're, what they are seeing. All right, now we're getting into the nitty gritty of some of our real big roles and responsibilities. Strategic asset allocation. This is the risk that we as a board agree that we are going to take on behalf of achieving our members' promise. Thoughts?
I'll just say this is the one category it seemed like we had the most consensus on, which is good because I think it is the most important component. But I also look forward to what strategic asset allocation is going to evolve into and look like as we go through the new process. Scary, but also excited for the depth of experience we have here on the board to help as we navigate through this process. But I definitely think that if we're all on one accord, this is the right topic to be in that space with.
And I think it's no coincidence that this is the space that is probably the most supported professionally, right? Any other thoughts, though, about how prepared you as board members feel when you're saying, yes, this is the strategic asset allocation we should take?
Well, I if I may, Madam Chair,
Yeah.
I was paying attention when this topic was coming up with the independent assessment and staff's discussion on it and the emphasis on how this should be the lion's share of a focus in structuring our portfolio. And I from a layperson's observation, and I believe in that. So I think but it Ms. Jones had said what that looks like. It's TBA, so to speak. But I believe in the message that it's an important thing, and it makes sense. And what was in second string behind asset diversity, right? I mean, it's more important than a diversified portfolio, and
Yes, and it's also the name of John's children.
My goodness.
Yeah. Yes, Mr. Santos.
And strategic asset allocation is so important. In 2008, I don't know if Mr. Masaridian is here. Hi, Vache. In 2008, everybody was very nervous, obviously, including the board, and we made some mistakes, in particular in private equity. And I wondered if we had stayed true to our asset allocation, that perhaps the outcome would have been different in terms of the opportunity losses that we suffer as a consequence of going into a moratorium in private equity. One of the things that when we were faced with the COVID-19 and the shutdown of March 2020, I mean, that was the first thing I asked Mr. Graybull: continue our investment process somehow, some way. We have to continue. And again, so the asset allocation is what guides all that and the investment beliefs. And I think that we are better off, if you agree, Mr. Graybull, about what I'm saying.
Yes. All right. Okay. All right. Moving on. Tyson, I feel like I'm taking your job. So the next items are really about oversight and how we consider risk as an organization. So if asset allocation is the risk we agree that we should take in order to achieve our goals, the next two items are how we ensure that we don't make a mistake that can permanently impair our efforts. right? Performance and risk oversight. Ison, you want to
Yes.
add to that?
Yes, performance and risk oversight, and then related to that, performance and risk management, where again, most trustees believe performance and risk oversight is effective, and the management is also effective and rated highly in both of them, both of the areas. And here, very uniformity of opinions, if you see between all the ones and twos for the effectiveness. Next is staff oversight, which is another area where most of the trustees believe that the staff oversight is effective.
Did you want
Sorry.
to see if they have any
Sorry,
comments on
I was kind of
those, or-
looking
Yeah.
and with the sorry. Any questions or any feedback?
I feel like we've covered a lot of that. There's a lot of consensus in these two.
Just one comment. I mean, we do have a team, staff team dedicated for this topic. And that is incredibly important. I'm not sure if we all know about that. With regards to the team that we have in place. I don't know, Mr. Grable, you want to say a few words about the staff that you put together and the new team that you?
I believe the team was formed in 2018, Performance Analytics Group. The team will be presenting tomorrow the fiscal year financial results, including risk and performance. The team used to include corporate governance, but now corporate governance and stewardship has spun out to be its own group. And going forward, this is a great opportunity. We're adding a new senior investment officer for ODD, which will be part of this group. And wow, thank you very much for the question. This is a great time to introduce that we promoted Esme to be the principal investment officer for portfolio analytics. So as it relates to performance and risk oversight, Jude did a great job. Esme, may I say, will do an even better job.
Okay, thank you. Congratulations, Esme. Very well deserved. Great. All right. So I think we're good on those topics. So the next couple of topics are really about kind of oversight, one selection, but let's start with staff oversight, because we as a board, we only evaluate John Grable, and then John Grable evaluates the rest of his staff. That is the current function as we do it. So has everybody here now been through a performance review process yet, or still new to it? Yeah, you probably haven't been through it yet, but it's an important role, obviously. I tell me your thoughts.
So the first time I went through the review, I think we actually did it partially at this event last year, right?
Mm-hmm.
Yeah, I thought it was a great opportunity for us to put down our thoughts or ideas throughout the year. Like if there were things that came up that you wish you were able to articulate, this is an opportunity where you get to put it on paper and submit it to have it on, on the record. But I also thought it was a time to really acknowledge some of the accomplishments and achievements of staff and appreciation of the staff. But I thought it was pretty open. Like I liked that, as Herman discussed, like he's saying, don't appease me, tell me the truth, is this working or not? And I felt like we had that type of open dialogue where it may not have always been all pleasantries, but we were being honest, we were being constructive, informative, and also for the greater good. We were having those hard discussions, whether it be on paper or, in a verbal dialogue. So I like the process, and I think it works well. I think we do it differently this year, though. or we didn't do it?
I don't think we have gotten the review process. Yeah, October is
Oh,
when
October.
we'll do
Okay.
it. Yeah.
So yeah, I like the I like both pieces of it.
Mm-hmm. Yeah. You've been through it a lot.
Yes, and I'd be interested to hear from the CEO because the Board of Investments, Mr. Rice, correct me if I'm wrong, we have the legal authority to hire and supervise the CIO. But this board delegated that authority to the CEO. And so I'm wondering from the CEO, because I know the CEO is responsible for evaluating the CIO, because we delegated that authority to the CEO, and the CEO gets input from us, and wondering, Mr. Kryman, whether or not it has it worked. How do you see that? Or input? Any comments with regards to the process that we use to evaluate the CIO?
Yes, I think that the input that we received, that I received from the board trustees, is invaluable, and so it's important that you hear from me in terms of what my perspectives are and what I'm seeing from a day-to-day operation perspective. And you're right, there is a policy apparently about how Mr. Grable will be evaluated. And so we do follow that policy strictly. Last year, I believe it was a little different. So what you were remembering just was my performance evaluation, the CEOs.
We did one for Mr. Grable.
Yes, you did do one, but it wasn't at this. It was at the board site, right? So, but I think that my observations and the interaction that you all have since my arrival here 3 years ago with the CIO has been stellar, quite frankly, in terms of the give and take, the things that are important to you all. And Mr. Grable and his team do an absolutely phenomenal job in terms of executing on the strategic direction that you all have laid out for him, quite frankly. And what I like about it is that it was really a joint effort between the staff and the trustees about what was important and where we needed to get to. And I know that it started before I got here, but I think that you can see great progress, quite frankly, in achieving that particular vision that you all had back in 2017 or 2016 or whenever that first came on board. And then, of course, there's the consultants as well that do provide input in terms of some observations. And I look at the relationships that they have with Mr. Grable, for example, the kind of conversations they have, and quite frankly, the materials that are presented to your board are absolutely top shelf. And so those are the things that I look at. Of course, the relationship that Mr. Grable and I have is important as well. We have a very good working relationship. We don't agree on everything, but we do work those things out. And my job is really to support him in making sure that he carries out and executes on your vision. And so I think that's what we've tried to do. I look at John as a partner, not necessarily as him working for me. We're running this organization together, quite frankly, along with my executive team and of course my general counsel as well. So those are my observations. I think it works very, very well. The way we're organized in terms of how we evaluate Mr. Grable moving forward and in the past.
Okay, thank you. All right. Additional comments? All right, we can take the next two, I think, together, which is external advisor selection and oversight, which normally happens in RFP process, and the oversight is done with an evaluation questionnaire that will go around the time of RFP to consider whether to re-invite the consultant to bid on the next RFP. That's the process. Some of you may not have gone through that because we've only recently replaced some of our consultants, and maybe some time before we go through the next process based on the length of time. But I think, I don't know how much comment you have, since some of you may not have experienced this yet, but given that I've just explained how we do it, do you have thoughts on kind of whether or not there are more opportunities or ways to do this more effectively? We did get some staff comment that kind of focused on the fact that we empower our advisors a lot in the investment process. However, we hold the staff accountable without necessarily any intermediate feedback to consultants, meaning that they've done their job if they've given us the kind of materials. But what happens when an investment goes south? How do we think about that as an organization, right? It's just something to think about more than anything. I don't think anything's broken, so I'm not bringing it up to sort of cause a conversation, but it's just my thought. All right. I think we're getting to the end of our navel gazing sense. So any other thoughts? All right. Okay, so staff recommendation approval. This is probably the thing that we'll probably discuss the most at some point, which is how we do staff recommendation approval, the approval process as it stands right now, versus eventually changing that process. Thoughts? We've started the issue a few times. I feel like you're exhausted and you're going into food coma. Niggle, niggle.
I think I believe what you're asking is the process of staff recommendation approval by the board. I mean, are you asking if the staff recommendation, if the reports are thorough or interpretation or?
I mean, I think that based on the commentary here, they're considered effective, but are they considered important? That's the question.
I think so, because.
Well, I mean, but my point is that should it be a delegated authority? That's the question I'm kind of asking us right now. Is right now we have a process where the staff brings a recommendation and we approve it, which means if it goes wrong, technically a little on us on that, but how much background are we going to be able to, second guess a recommendation that has had an intense investment process behind it, right? That brings that the kind of support that has to be gained internally is much greater than we can do as a staff. I'm going to kind of throw the question out there. Yeah. Is this something that, I think we're thinking about it already in certain areas of the investment complex.
Well, I always thought about it again as a new person now, 3 years into it, that it was just part of the process, right? Part of the public process, right? The staff brings it through, they walk through it, they get to see us consider it, however intelligently or not, in that process. And then ultimately, then there's an official vote, right? And so
everyone's different.
Yeah. And then I kind of feel like that's part of our job, is to be responsible for the vote on the recommendation. That's kind of tantamount actually to what it is that we're doing. So therefore, before the recommendation even gets to us, the level of oversight and engage, kind of becomes important, right? Just to ensure that what we're getting at the final recommendation, we have confidence that it's gone through some type of process of integrity and consideration and all that other stuff. And then our public vote is there. So I don't know that I would want to somehow skip that under some idea of efficiency or whatever else, because I was just
it's greater than that. Go ahead.
Nimbleness.
Nimbleness.
In a excuse the word, trip to $100 billion, we need to be nimble. And one of the issues that I've seen over the years is that because we move so slow, right? Typically, at one point, everything was going to the committee. The committee then will recommend that to the board. And at one point we were interviewing the managers, and how can you select a particular manager just by listening for whatever 10, 15 minutes of presentation. While in the meantime, the recommendation has gone through the internal investment committee, which is, in my view, is very powerful. Also, the consultants, at least with regards to private equity, I don't know if Mr. Fernandez is here right now, but if you can speak up a little bit about the process that your firm goes through, the particular recommendation for LACERA, and how your investment committee, or if you can explain to us the whole process for your firm to make a recommendation to the board.
Yeah, sure. Thank you. Good afternoon. I mean, I think, as you said, we have an independent process, right, at Stepstone, and it's a lengthy process. So any potential investment opportunity we're reviewing for a number of months at a minimum. It results in the memo that you see at the end of the process. But that process includes multiple meetings with the manager. It includes reference calls with portfolio companies, service providers to that manager, peers of that manager. So that's a large part of our effort, is reference calls that are made by a number of people at the firm. We always do a site visit at the offices of the manager, at least one, sometimes more. And the review process includes not just the investment opportunity and the risk that are highlighted, as was mentioned earlier, but also operational due diligence review that is conducted by a separate team at Stepstone that just does operational due diligence and goes into all the areas of operational risk, from cybersecurity to how they do the accounting, the valuations, all of the operational aspects. It also includes environmental social governance review by a separate team that focuses on just that aspect. And the investment team focuses on the investment opportunity and risk. We have investment teams dedicated to each area. So whether it's buyouts, or if it's European focused fund or Asia focused funds, there are different investment professionals that are dedicated to that. Those teams function essentially as their own investment committee. So they have to agree that this is a good investment opportunity before it comes to our firm-wide investment committee, which is made up of the 10, 11 most senior partners at the firm, who then approve that investment. So long story short, it's at a minimum a months-long process. Sometimes it's actually years before it ends up on the memo that you get to read, approved by 2 internal investment committees.
So through the chair, if you can share with us an example of where we lost the opportunity to invest with this particular manager because we are so clumsy in how we a process is that it has to go through the board. Do you understand my question?
Yeah, absolutely. Yeah, look, I do think there are being nimble is important in many times. The opportunities in private equity, same with real estate, do have a timeline where the funds close, and if you unless it's an open-ended fund in the real estate world, that doesn't exist in private equity. Where if you don't commit by a certain date, you can't commit until they bring a new fund a few years down the road. So given that our process is long, the internal process at LACERA that staff conducts independently can also be long. The additional timeline that it requires to come to the board, you can miss that deadline. The other part is that for the most highly sought after managers, they tend to have allocation constraints, which means they can decide who their partners are, and they want certainty that if LACERA says we're going to commit, or we like this opportunity, we would like to invest around $100 million, which is a large amount for any manager, no matter how big they are. That manager wants to understand sort of what is the certainty that that investment will actually close, and having that process where they have to go through Stepstone, they have to go through LACERA staff, and then ultimately to the board. The board introduces sort of an additional element of risk for that manager of whether this is actually going to get approved or not, and should I give that $100 million allocation as a manager to somebody else that may not have that additional approval step. And many times they can decide, I'd rather not take that risk. And those tend to be the most sought after managers, the most difficult to get into. So I do think that removing that step and having the discretion at the staff level can, in some occasions, increase your ability to invest into some of the best managers.
Thank you.
All right, Mr. Ryu.
Madam Chair, to answer your question, my initial instinct is to say, yes, we should do it. Well, we should get more involved. However, I still have not seen the cycles, but based on what I'm hearing and my experience so far, yeah, I think it would be knowing that hiring a contractor or making an investment decision, there's, as previously shown in this example right here, takes months and months of work. I think us getting involved in that granular level would really delay the time. So yes, while my initial answer would be, as Board of Trustees, we should be much more engaged and we should be involved in the decision making of that. I am confident, and I think it's been running good so far, of the staff making the recommendation, staff vetting it out, and then making the recommendation to the board for final approval. I think that's much more time efficient and probably a better way to go. But
and we don't have to make the decision right now. Remember, we're
Right.
just evaluating and considering.
yeah.
So thank you for that. Mr. Green.
I want to echo what Mr. Jones said so eloquently. I'm not going to be as eloquent, but I do feel strongly. I understand the ability with granting delegated authority to staff to make decisions for timing purposes, but my understanding of the process is the product is identified. There's a manager interviews or an RFP process. Due diligence is then done by staff, which also goes to, they have consultant review that might be going on at the same time. Then there's also an internal committee by staff that's going through the process for analysis. Then it goes back to staff, and then ultimately comes to the Board of Investments. And I think with Mr. Jones, what I understand you're saying, we're part of that. We're part of one of the cogs on that wheel of that process. And it's our duty as fiduciaries. We are the fiduciaries of the fund. We ultimately bear that burden, and as defined in the SURL. And I think it needs to be a case-by-case basis. We've discussed things with the real estate and dumping of stuff that needs to happen, and it has to be done timely. And this board has granted autonomy to staff to handle that. I think a general, just kicking it down, again, with the climate of some of the things in other areas legally that are being discussed, I think it's prudent that the Board of Investments stay engaged and be able to have those questions raised if need be for their constituents and for the people that have put them in the positions. I think it's critical to reach that $100 million goal. And history has shown that the process, again, to your point, Madam Chair, was like, if it's not broke, why fix it? To summarize, not to, but historically, the process is weathered, the 08 crash, the 22 downturn, and it's been working. And That would be my.
Yep, no, I appreciate your comment. One thing I will make, and this is a historical comment, is that in fact we've actually evolved quite a bit. So there's nothing that we do today that is similar to what we did, say, 5 years ago. It has actually evolved dramatically. The one thing I would comment, and again, I don't want to make any decisions here. I just kind of want to evaluate what we can and can't do and what good governance looks like. And every program is different. So there are different models for everyone. And the next conversation we're going to have with Makita is about peer group analysis. And so I just kind of wanted to have this navel gazing discussion before we get into that peer group conversation where we can think about that. But I do want to make one point very clear, which is that engagement in policy creation, in understanding the procedure, and in having a full-fledged Q&A when investments are presented as a matter of transparency to the board does not preclude all of what you've said. It's just simply a matter of when the decision gets made and who gets to make it. So all of that fiduciary obligation still remains, even if you make the choice. So I want to make sure that we don't mistakenly think that one precludes the other. You can still be fully engaged in your fiduciary obligation and have a process that requires reporting back to the board and board Q&A that kind of creates that accountability.
With the delegation of authority.
Yeah.
The process is
right. So it's just an option. Next comment, Mr. Jones, Miss Jones.
Thank you. I know we briefly talked on this at another meeting that we had. Again, I just want to preface what I'm going to say with the understanding, to be really clear, I have the utmost confidence in our CIO, 100%. However, when it comes to making decisions such as this, I have always through my career had to make decisions based on internal controls, based on not persons, but positions.
Mm-hmm.
So when a policy is being established and we're giving authority to a particular position, it means that whoever is in that position could flow with that authority. And so obviously my concern in this scenario is if there were someone else in the CIO position, would I want to give them the same authority? And the answer is probably no. And so in that scenario, we also have to look at internal controls. Is there proper checks and balances? Is there proper segregation of duties? We have a very detailed process in place that outside advisors are involved with and staff are involved with. However, the CIO has influence over both of those parties, the staff as well as the outside advisor. So if you have the wrong CIO in place, that could be still potential for, challenges that will not benefit because our fiduciary responsibility is making decisions that will benefit the plan as a whole. And so, I just have to say in good conscience that I would only approve a process that has those checks and balances in place, those internal controls in place. And I just feel like, and some people have shared thoughts differently. That's why, we have the trustee role. We are there to take that responsibility on to vote in that capacity. It is our job to review the information from staff, to ask the questions. I do understand, Chair Sanchez, we do have opportunity to ask the questions, but in some cases that could be after the fact. I also have to look at if we're not on the board and we have a practice that's been established and that practice gets in place where the CIO has that authority and the current CIO retires, there's all new board members, but this practice has been in place for so long, they just continue that practice. And the board, now is making, decisions based on a new CIO. And so my decision-making is based on the fact that whatever is established can be continued in that same capacity through 5 years from now, 10 years from now. I do understand the board has the authority to change those directives, but the same board members may not be here, 2 years from now. And so who's to say that they'll want to change it? And is that still in the best interest of the members? And so, I understand wholeheartedly the confidence in our CIO in being able to make these decisions, especially with the steps that are in place. I support that 100%, but I cannot support a policy that cannot stand the test of fraud, or, when you go through audit, you have to look at, is there a way that someone can maneuver the system? And the fact that the CIO has influence over staff and the advisor.
They don't have influence over the advisor. They report to us.
But they have, I didn't say they have authority over the advisor, but they have influence. Mm-hmm. There's a difference. Mm-hmm. And that would be my reason for my decision.
Yeah, no, I mean, I understand we're not making a decision. We're just simply talking about it. But you're basically commenting that internal controls, checks and balances, and appropriate segregation of duties. And to be fair, even when we had the conversation with staff, I think a responsible policy was as important to them as to us, right? So I do think that those are all valuable observations. And Mr. Jones, you have the last word.
Yeah. So just in the circle of this, so the problem we're trying to potentially solve for is just nimbleness. And so if there are 100 opportunities to swing, how many nimble, high nimble opportunities are we talking about? If it's an exception, then we should probably talk about an exception, not a rule that says, hey, if it's a hot to trot manager and so and so and so, then there's some mechanism where we can do something different, but just as a rule that's through there. I'm not so sure. And so maybe as a part of that conversation, I'm not sure if I measure exactly what Mr. Fernandez says. I get in that particular anecdote, but how often does that come up in that process that we would miss out on something? And then let's have an appropriate policy response relative to how common that comes up.
It's interesting. We had that conversation when we had the staff conversation. And one of the issues is because of our process, there are a lot of opportunities that they simply don't look at as a matter of, we know we couldn't do that, so we're not going to bother because it's just simply not possible. And so by that extension, it's a bit of an unknown because we're not counting all the ones we just kind of know we can't do. Mm-hmm. So that's a challenge. So I don't know that you're going to get the quantification as you would like to have it is,
right. Just in terms of measuring the report. And then the last thing I'll say is, I think there's already a temptation, unless you have a high personal standard as you come to this board, to kind of not read the materials. But if you kind of feel like you're not the final decision maker, right? Like on the recommendation, I think it's going to be all the more. I mean, part of the reason, a nice bottle of red wine, a cigar on the deck with the pile of stuff is because I feel like, okay, well, I'm going to have a vote of record on this. Mm-hmm. I better read this, mm-hmm. right? Like I better know who it is and try and like do a little bit of work in it. If I just kind of feel like, okay, well, it's kind of going on without me. And I do think we have a good process where we've given the CIO authority where if the board has already approved a manager, if we've already come through the existing process and there's a chance to re-up or something of that nature, then he already has the flexibility within certain limits to do that. Mm-hmm. So I think we have kind of a hybrid process, but I would still argue that it's kind of our responsibility to be that last little speed bump mm-hmm. In the process when introducing a new manager into the overall idea.
Well, it's the conversation. I think we're coming to the last slide now. Yes, one last
comment.
Last word. Last word.
Last word. As we get to 100 billion, and even today, a ticket size should be about $250 million per deal because of the size. Not that many managers will be in a position to take $200 million to $150 million. That's number one. And number two, we have a lot of competition in the market. A lot of the sovereign wealth funds don't have the same criteria that we do. And they have billions of dollars ready to deploy. And so they're waiting for us to drop, so to speak, so they can come in and make the investment. So it's something that it needs to be fully flushed out, because when we get to 100 billion, it's going to be very difficult. One last point is with regards to the comment about the people that don't read. Remember that we are liable for anything that happens on this fund. Okay, so if you don't read the material and something happens, you're going to be liable no matter what. So you cannot hide behind the voluminous reports that we get, because we're going to be liable. If we give the staff authority, again, they mess up, we're liable. So something to remember about that.
Okay, so and we will have more on that in November. So in November, we're going to evaluate peer groups, and that'll be. So the last item up for bid is compliance. Thoughts? Because otherwise we'll dive into capital markets assumptions. Nobody likes to talk compliance. I do think compliance is effective in the sense that it is well documented and it is a part of our materials. So I do think that there is that. I think, of course, in any organization, there's always room for improvement, in compliance. But that's my comment there. David, Mr. Ryu, is your hand up from? Okay, thanks. All right. So with that, I will hand it back over to do capital markets assumptions. Thank you, everyone, for your very, very honest comments. I think that this is the most reflective board conversation we have had in terms of self-evaluation and thoughts. And I think it will set the foundation for all of the decisions we make going forward. So thank you. Pat yourselves on the back. I think we got through that. And thank you to Makita for facilitating the conversation.
And maybe as we transition from one to the other, if I could just weigh in with one sort of final comment and observation just from that one. In the areas of opportunity identified, one of the comments was that I believe the LACERA board must do more to govern itself and to create accountability and proper incentives for staff. So that delegation conversation isn't all about nimbleness and being responsive to market opportunities. It's also about alignment of roles and responsibilities and accountability. So to the same way you feel more pressure to review materials and be engaged in those decisions, the opposite could be said of staff when they know they're just passing the buck on for somebody else to ultimately approve. They have some accountability to it, but as the non-final decision maker, so you're always tipping these scales and making these trade-offs in any type of governance arrangement. So I just want everyone to take a real deep breath and look at it from multiple different angles as well.
Thank you. And I think I know you've probably filled up about 3 of these little notebooks you got a bigger set of notebooks. Yeah, so we will look forward to a more updated version of our self-assessment process and consider that in the next November update.
Perfect.
All right.
And so Krista had, I think, a wonderful introduction that she was prepared to give, but I think in the interest of time, we'll just move on and we'll probably even skip my background and introduction. I think everyone hit on the points earlier that, strategic asset allocation and governance are probably the 2 most important items in front of this board. And we've been going through a thorough process for the strategic asset allocation. Reviewing the CMEs is one component of it. We also heard a little bit of feedback on perhaps the durability of modern portfolio theory. And if you'll all recall from the past presentations, while the capital markets expectations do in fact fuel those models, that is not the only approach that we rely on and that you rely on in making your decisions. If you recall the last time, and Vache hit on some of the points of what changed in the strategic asset allocation, much of that was the result of reviewing the scenarios as much as it was sort of optimizing to any expected return target. So these are an important input. It's certainly not the gospel of asset allocation, but definitely important and worthy of your review and attention. So I guess maybe with that, we can flip forward a couple of slides and I'll turn it over to Leo to just give a little bit of what's going on and what's changed. Maybe one more, please. Sorry, next one. That should do it. Thank you.
Good afternoon. Can you hear me well?
Yes.
All right, good. So this may be one of the most important slides. Is this not?
Yeah, you have to hit the, oh yeah, there you go.
Yeah.
All right.
In this section. For the first time in well over a decade, maybe two, we are at a time when the market environment is more conducive to making the types of return that a pension fund such as LACERA needs. When I first started in the industry and for the next 2 decades, pretty much we've been on a either declining or a stable interest rate environment.
Mm-hmm.
If you were to look back maybe 18 months ago, rates were at or near zero. In this chart, we look at the expected returns at the time. So starting in the year 2000, looking out 10 years. And if you fast forward to 2020, you see how they've been coming down. If you look at the green bar, that represents the expected return on a mix of high quality bonds, not just treasuries, but also credit and other, asset-backed securities that compose high quality bonds. That's about 2.5% to 3%. Very hard to make 7% when bonds yield that much. But if you look at where our 6-month treasuries are today, that's about 5.5%. So they're saying that raising that tide lifts all boats definitely does apply to investments. So it's a lot easier even for equities to yield or to make it 7% over a decade on an annualized basis when you start with cash rates at or about 5 to 5.5%. So that inflection point is certainly very welcome by all pension funds. What you have seen over the past 2 decades has been a push for additional return from alternative asset classes. So you have seen increased allocations in the liquid categories like private equity, private credit. You heard earlier Vache mentioning we have to get back and cut back on investment grade bonds. They're pricey, they're not going to yield much. We need to make a change. And that happened about 3 years ago. I would argue today, high quality bonds and short duration bonds make a lot of sense. Mm-hmm. Is that going to hold? We shall see where rates end up if this is another 6-12 months and then we cut back drastically, or we remain at more elevated rates or compared to the zero. Anything else you want to add in this section?
No?
Yeah.
That's great. Yeah.
So the rest of the presentation provides some perspective as to the process that we follow at Makita, provides some context for you. We don't intend to spend a lot of time on the specifics and the model for each asset class, but understanding the starting point, this is a big change. How interest rates have changed, that has been the primary driver. The secondary has been how that affected valuations across many asset classes. The two of them combined means, despite the pain that we suffer in the past year primarily, now going forward, returns look much more attractive. So maybe we'll move over to the next page. And here we summarize for you what we do. This is pretty standard in the industry. Consultants typically do this once a year in cases when there's a lot of changes pretty quickly in the marketplace. We may do it the second time in the year, maybe around mid in the summer. So for example, during the GFC, we did it in 2022 with the big 2 negative quarters. We did it as well, but usually once a year. So we tend to have our report out by about the 3rd week in January with the new projections and data, and comes on 3 major axes. So we have returns, standard deviation, and correlations. We move to the next page, please. this has been growing over time. So we slice and dice the data in different ways, and the asset classes is there in quotation marks because this is when the science and the art mix a little bit. So in investing, there's no formal definition of asset class. We try to use some ways to identify them, but it's driven by client demands, but what's in the marketplace. And there's certainly other assets that, while they're very differentiated, they may not be appropriate for institutional investors. So you're not going to see us modeling rare coins or art because they really wouldn't be utilized by folks like yourselves. On the next page, we start with the return stream. And so we look at 10 and 20 years assumptions. In your case, working with the staff, 10 years has been the focus. And for the major asset categories that you see on the screen, there's a couple of components that apply broadly across all. And so you always have some sort of income stream. Could be dividends if you're thinking about equities, or interest if you're thinking about debt. You have some growth component, and of course you have valuation. I would argue if we were looking at very short time horizons, the valuation component may either disappear or might have a lower weight in the computation. But when you have about a decade out, valuation plays a role as well. On the next page, we'll see that some of these factors have more predictive are more predictive than others. And I would just highlight one in the interest of time, and that is fixed income. If you're looking at yields, they're great predictors of future returns. When yields were in the low digits, 2, 3, 4%, that's more or less what you get when you look at 10 years out. So you'll see there, an R square or, prediction power of about 85%. So in other words, the yields that we have today, 85% of that yield is accountable for what we're going to see in the future. So it's a pretty robust metric. On the next page, we look at the other two inputs. I mentioned earlier, standard deviation and correlation. Here we look at 15-year historical experience. For deviation, we look at also the skewness. In other words, how it may tilt to one side. And so most asset classes will not have very symmetrical distributions. You may have tails. And so it's important to know if you're going to have tails, if you're going to be on the left side or the right side. If you're going to be on the left side, that's quite detrimental. So that's why we penalize to some degree the standard deviation to account for that. We'll move on to the next page, please. This is just the yield curve in the US, and we're looking at just the 1 year change. If we were looking at today, that blue line would be even higher, at least on the short end. As I mentioned, the 6 month is at about 5.5. I looked it up, I think it's 5.53 when I looked it up earlier today. So that is the biggest driver of the change for us and for others. There's other groups that put out capital market expectations, and there is one actuary that typically would compare and contrast these, and it comes up every August. So I think Gina had some comments.
Leo, so obviously we're in an inverted yield curve situation right now, and that is not sustainable. What are you assuming in terms of the timeline for how that fixes itself in your 10-year assumption? Are you assuming it's all going to happen this year in terms of the kind of repricing of the long end?
Yeah, one of the underlying assumptions at Makita is that reversion to more historical terms. So of course, you just alluded to one. So this is not typical. This happens infrequently, and when it does, it tends to not last for a decade. So you're absolutely right. So we assume that it's going to revert into a more normal upward sloping curve. I don't recall this specific to your team in terms of how quickly it goes over.
It's just averaged over the calculation period, essentially. So no, it doesn't make a specific timing assumption. Yeah. So, but I think the other way, when we do the capital markets expectations, let's say the short-term government bonds outlook is not just purely the treasury return at the time, that also gets discounted back to, a more historical level, or there's also some kind of qualitative adjustments that are applied to it. So that inversion probably won't come through as strong in the capital markets expectation as is just expressed purely in the market chart.
Okay. I mean, I think the one thing that's worth noting is when you get a really fast adjustment in interest rates, you get a big price hit. So you get, killed on the price immediately, but you start collecting a higher yield immediately. That higher coupon gets collected immediately. So if you have a 10-year period, you can actually do okay if you just like rip the Band-Aid off. But if you slowly pull the Band-Aid off one little hair at a time over the course of 10 years, you don't collect that higher coupon over that 10 years. So it really affects your outlook, potentially your outlook for your bonds, which are a component of what we were talking about earlier today in the macro outlook. So just tell me how you think it is affecting the capital markets assumptions we're going to use to make our decision.
Yeah, so I think what we also need to keep in mind is that Makita produces a set of inputs that also have to be consistent over time. And so we try to minimize these adjustments to some degree, noting that we are not imposing necessarily these inputs on clients. And some clients, especially those that have staff, may want to engage in dialogue and maybe revise one or two. So I think Makita is not fixed and saying, okay, these must be used by all clients. So if there is one area to the board or staff would want to review, we certainly can. I think ultimately, and at the end of the day, we will be using, we will be looking for your approval of the capital market assumptions early next year when they come out. And so we'll see at that point in time what we have done. Obviously, this has not happened that frequently, at least with this severity and magnitude of the increase.
Right. It is rare that we have this kind of situation that can't last.
Yeah.
It's very unsustainable. Okay.
I would also point out that in some sense, the Band-Aid was largely ripped off, and we experienced that, right? So we went from the low rate environment to a somewhat
In the short end, the Band-Aid's been ripped off wholly, but in the long end, we're still hanging out at 4 1/4. So,
but up from 2 and 2.5. So if just there still has been parallel shift. It's definitely inverted, and then clearly everything that we're showing in this presentation is also as of end year. So the short end has come up, but now we're notably higher than the 4% shown in this chart currently. So
yeah, but even if you were to get the rate cuts that are priced into the Fed funds rate, you'd still have a flat yield curve, which is also equally unusual. So just a thought, just something to think about, because it could put some upside potential in the calculations you make in your bond estimations, how you factor that through the model. Mr. Green, did you have a comment?
I just for a point of clarification, I guess my education, I want to back up to your guys' process in setting the market expectations. When you guys go for your baseline, you're looking at private and public market data. The two reports, one being released at the end of the year, one being released at the start of fourth quarter, right? The private stuff. My question is the private market data that's self-reporting, right? In your analysis, how do you determine that that's accurate, being that it's coming from a private market? Or are you relying on the observable historical track record of that after the fact? I just want to know part of the process. And is it true that the private markets, there is some level of cloak and dagger going on?
I think some people talk about it. Yeah, exactly. The accounting diversification. So there is a lag in reporting as far as the inputs that we use here for capital markets expectations. Essentially, it's solely based on the observation between public and private market assets over, the historical track record. So it's really, think of it as if private markets buyout strategies, let's say, have outperformed U.S. public equities by 200 basis points consistently over the trailing 10-year period, that's what we're looking at, not necessarily what the accounting reported values are as of 9/30 that we then incorporate into our reports. It's based on the historical relationship of the two asset categories at a more theoretical than that actual sort of accounting granularity level.
And is the public information available in that real time, that the term you spoke of, the asset? Can you see that with more clarity in real time versus the private stuff?
Yeah, so the real-time expectations and what you'll ultimately be approving is based on every readily available public market data input as of 12/31/2023. So whether we're looking at commodity prices or equity valuations in different areas of the world, bond yields, all of that is just, we take all the publicly available information, run multiple different data sets, and then start our analysis all with that one particular starting point. So that's why, to Leo's earlier comment on when you do have significant market movements over the course of the year, some of this can change. And so right now we're not asking you to actively approve these because we already recognize that they're quite stale. So this is meant to be education and clearly pointing to the new regime that we're in, that we also heard about in the global macro session. You know, the environment has changed from the last time we did strategic asset allocation. So we're basically trying to highlight all of that and then let you know that, you know, in February, you're going to be seeing data that looks very similar to this, but we know has already changed because this is so stale. I mean, you look at equities up 20% this year. The forward-looking equity returns are going to be quite impacted by that. The fluctuations in the yield curve that we've seen this far are clearly also going to have further impact on what we produce at the end of 2023.
Can we skip several pages to the efficient frontier? I think that could help point us in close, you know, touch a couple of these items together. It's going to be a couple more pages. You have to go maybe 5 more. There we go. Yeah, one less. There you go. So there's a couple of observations. So we just brought the topic of private equity. So you'll see it way on the right, and at the left, you'll see cash. And you see a dot. I would say, don't think of the dot as having any meaningful precision. It just happens to be the center point about a distribution of returns for each of those asset classes. Think about superimposing to this chart on the vertical way a distribution of returns, almost like the typical shape of a bell curve. For cash, it's going to be pretty small, but as you move to the right, it's going to be very wide. So that private equity on average, we may say it might yield 11% over the next decade, but the actual experience can be 20% or it could be 0. With cash, it might be 2.5 with a range of maybe 2 to 3. And so as you move to the right, think about that, this is just what you see primarily is just the return is what most people focus. I want to make sure, don't get the sense that there's a lot of precision here. There's a lot of art again in this. It's estimates, and you need to also account for the uncertainty, or in other words, the dispersion in returns. We could also discuss the correlation about how these different classes move together, and would say during normal times, there's going to be more or less different. During difficult times, a lot of these will move together, and maybe cash and high quality bonds may move differently. So I just wanted to point that out because we may be focusing later on some tables and having some numbers. Obviously you need some numbers, but they're going to be assumptions, and more likely than not, they're going to be wrong. But hopefully they're going to be close enough. And we have a lot of data about us going back 10, 20 or plus years. They tend not to be too far off. The other point along the lines of the first comment, you'll see the whole distribution moves up and to the left. So for the first time, you don't need to take more risk to generate returns. You have options.
Yeah.
Yeah, I think that's the major takeaway with this sort of regime shift. I mean, what elements of it may be permanent and what the yield curve may do from here to there in the next year or so. But clearly you do have the opportunity to still solve for your expected return goal in a way that allows maybe some additional diversification or just higher probability, less risky asset categories. So to the earlier speaker from BlackRock, he mentioned that short duration bonds look attractive. That's not typically something that you've had in the portfolio, because when yields were at 0, it didn't really, it created a major obstacle to achieving your 7. When those same securities now yield 5, that's useful in a portfolio role to add some additional stability. So you're going to be actively making these decisions, and the Leos, and none of this is meant to be an exact prediction, but it should be, we think there's durability to the directional sort of components of all of this. So, and there are, increasing range of outcomes as you take more risk. I think we all know that. And now you just have an opportunity to contemplate some different set of circumstances than the last go round.
Yeah. I think one thing that would be helpful too is remind ourselves that, our hurdle rate is 7, right? And 7% on that green line, we don't have to take a whole lot of asset class risk to get there. So it's something worth kind of noting that we want to make sure that we get, rewarded for adding complexity to our portfolio. So just a thought. It may not endure, but here's where we are now. Thoughts? Our last comments? Continue?
No, I mean the issue is, it's been thought a lot recently with the yields being high. I mean, I know some investors who are essentially buying very short duration treasuries, immunizing against their near-term cash outflow, and say, okay, I'm going to essentially prepay and segregate my liability stream, knowing that, hey, for some reason the market is volatile, I don't have to worry about selling any assets. When you were making 0 to 1%, it was really expensive to do it. And of course, if rates were over 7%, you could immunize the whole portfolio if you wanted to. I mean, if you're looking at Brazil, that's what they've been doing. That's one reason why 85% has been pretty much treasuries from the Brazilian government. Now in here, it's been a different story. And also I think one needs to account for, okay, the rates are 5.5%. Where are they going to be next year and the year that follows?
And where our salary is going to be and where our wage is going to be
Exactly.
in that environment. Exactly. Wouldn't it be nice if we could ladder out the whole portfolio? We can never get there, but
No,
it is
of course.
it is a lovely thought.
Well, it's been a thought, and I know at least some investors who at the minimum have begun to immunize the short end of the portfolio, which, others have done it earlier, and I think right now at least you get paid for it. I mean, just getting paid to hold cash, it's quite nice this time.
It's a moment.
So there's a couple of things we can spend some time. One, we can look at the historical, track record of Makita, how we fare more or less. We can go back and looking at the actual outputs from the last study, which again will change by the time we use your numbers next year. So maybe we skip another page or two. We should be able to see the history. Let's see, keep going, please. And I'll tell you where to stop. Couple more. Sorry, there we go. So if you go back to the prior one, so you'll see on
Up one more.
Oh, that's
Are
it.
you're not. Okay.
No, just with the charts. I think it's good for now. One more down, sorry. Thank you. So this is essentially, Makita has been doing this for a while. So we go back, 10 years or longer, and we didn't have the 104 asset classes back then, but we had several. So we're choosing some of the more representative of the major asset classes investors use. And so you look at investment grade bonds, you see a pretty good trend. Some years spot on, others is, I think, within reasonable ranges. I don't see any systemic overweight or underweight. So high yield bonds is also pretty close. And in other classes, half the time is up and half the time is behind. So if you look at the next page, when we look at equities, you look at the US equity, half the observations, we were more favorable, and in the other one is just the opposite. So same thing with private equity. And there's been a few times when, the returns turn out to be materially different, actual from predicted. I'm going to argue that likely that occurred to most practitioners, because if you were to go back now to pages, and I'm sorry I'm jumping all over, that's the comparison to the average from the Horizon study, which is the actuary that I mentioned earlier that computes this. So we're not too far off. We're not coming up with our models trying to be average or in a certain way. It's just where we end up. Historically, I haven't seen, and we'll review this yearly, I haven't seen any sustained overweight or underweight in any one asset class. It tends to be, pretty reasonable, I would argue. Team, anything to add there?
No, I would just say, I think the other thing that's important to remember here is that this was a pretty significant change in environments. It's definitely one of the biggest jumps that we've ever seen. And so, you also have to take that into account of the fact that you're a $75 billion investment organization growing towards 100, and also have a relatively high allocation to private market assets. It's difficult to steer the ship. So we don't want the strategic asset allocation to be so responsive or hyper responsive to changes in market conditions, because you still have to be able to account for practical considerations like implementation over the next 3-year period. I think it took almost the full year period between strategic asset allocations to reach the full last approved strategic asset allocation. So, it's important to understand all these drivers, but there are also practical real world considerations when making these decisions.
Okay. Do we have any comments or questions? All right. Well, thank you for that. So I think we're now at our afternoon break. What time will we begin after this break, John?
2:45. 2:45.
2:45. So we will take a break until 2:45. Thank you, everyone.
Recording stopped.
Okay. Go ahead and find our seats. The Nossaman team will be pleased to know we've all recaffeinated here on the board. So thank you. All right, so we're on to our last item of the agenda for today, which is the actuarial funding policy review. And so here we have a panel to discuss actuarial policy. You're going to make it really, really interactive. All right, so take it away.
Good afternoon, Madam Chair and trustees. As we just heard, the final agenda item on today's schedule is an educational session on actuarial funding policies. At a very high level, funding for a is a very simple concept. It can be summarized as money in equals money out. The money in consists of contributions from a plan sponsor and investment gains, and the money out consists of benefit payments and expenses. Of course, this format of money in equals money out oversimplifies because it leaves out all the important details, such as how much money has to come in and when, how much money is expected to go out and when, what's the present value of these expected cash inflows and outflows, and how do these values respond to changes in various assumptions such as expected investment return, inflation, salary increase, or demographic risks. And what if the real world differs from these assumptions? How do you get back on track? Also, what are the governing rules, the duties, the best practices? And what principles and objectives should guide trustees as you set funding policies? Well, today's session is intended to help answer these questions. The goal of today's educational session is to lay the foundation for a future board meeting at which LACERA's actuarial funding policy can be updated. The current policy has been in place for over 10 years, so a refresher is timely. We've prepared a panel discussion with esteemed guests and knowledgeable staff. The session reflects a collaborative effort among various LACERA divisions, consisting of investments, legal, accounting, and the executive office, as well as our esteemed guests, fiduciary counsel Ashley Dunning, a partner at the law firm Nossaman, and our consulting actuary Nick Collier, a principal at the actuarial firm Milliman. Ashley's and Nick's bios are in the presentation materials. Also on the panel are Ted Granger, our interim CFO, and Louis Lugo, LACERA's deputy CEO. The moderator for the first panel will be Steve Rice, LACERA's chief counsel. If you can advance a couple pages, please. Back one, maybe? Great. The presentation is in 4 parts. The first part explores the purpose and goals of a funding policy and discusses the legal and actuarial framework. The second part dives into the elements of a funding policy. This is really the nuts and bolts of how the actuarial value of assets and liabilities is calculated. And although the discussion is of a general nature, Nick will make the connections to LACERA's plan and policy. Daniel Joy from Investments will be the moderator. The third part focuses on LACERA's policy. Cindy Rivera will be the moderator and Ted Granger the panelist. Ted will review the history of LACERA's actuarial funding policy, and he'll discuss how the policy is implemented. For example, how earnings are allocated to various reserve accounts. This section will also tie together some of the general policy elements discussed earlier and apply them to LACERA's specific policy. We'll also highlight the key principles to bear in mind in updating the funding policy. In the final section, Deputy CEO Louis Lugo and Investments Own Calvin Chang will provide a brief recap of the topics discussed, as well as concepts that can guide a revision of the existing policy. Now, we want to make this session as conversational as possible, so we encourage trustees to actively participate by asking questions and sharing thoughts. As I mentioned, staff plans to return at a future board meeting with recommended updates and enhancements to the existing actuarial funding policy. So the more feedback we receive, the better able we'll be to reflect your preferences in the funding policy. So without further delay, I'll pass the baton to Steve Rice to kick off the conversation with our panelists.
Thank you, Vache. If we could go ahead to slide 5. We're going to start with a discussion of the purpose of a funding policy because it's foundational for all of the other topics that Vache gave in his introduction. Legal, actuarial, and operational considerations are important in the work the board's going to be doing in the coming months in reviewing, revising, and then applying the funding policy. We'll start with a question for Ashley. Ashley, from a legal and fiduciary perspective, what issues should be considered, and what is the purpose of having a funding policy?
So the Board of Investments, as you all know, has the legal authority and the fiduciary responsibility to fund LACERA properly so that you have enough money on hand to pay the promised benefits. And what a funding policy does is it allows the Board of Investments to exercise that authority and discretion over funding related topics. So Steve, you asked what the issues are to be considered. Though they are to clearly state the principles that guide you when setting your funding policy in a way that can be easily understood by your membership, or articulated to others, your stakeholders, and to your actuary as well. The purpose is to create a governance document that's separate and apart from your annual actuarial valuation, that again articulates these principles for funding the plan that will then guide your actuary, guide your staff, exercise that authority you have as a Board of Investments over this most important function of the board.
What is the origin of the Board of Investments' responsibility over actuarial matters?
The County Employees Retirement Law of 1937 provides, you're the one retirement system in California, county retirement system in California that actually has a separate Board of Investments that has authority over the funding of the plan. And within your governance documents, your JOG-C charter, for example, as well as your reserved power of the Board of Investments document that you developed several years ago, specifically articulates this actuarial authority. And you've exercised that over the years through the adoption of your annual valuations. You also adopted this funding policy that you have that's the subject of today's discussion. And later in the presentation, Ted will talk through the various iterations of that. But the origin is statutory as well as constitutional. You have plenary authority and fiduciary responsibility over the administration of the plan, the investment of its assets, and part of the responsibilities I noted for the Board of Investments here at LACERA relates to the funding.
Nick, what is the purpose of a funding policy from an actuarial perspective?
What we like about having a funding policy is it guides us, it gives us insight into what the employers, what the system's goals are. So that helps us make recommendations with regard to the actual methods used in the funding of the plan. It also provides support for our recommendations to be consistent with the funding policy.
And Ted, how does the funding policy assist LACERA staff, and what operational issues does it address?
Sure. So,
Mike.
Oh, sorry.
Here we go. Okay, I apologize. So I'm going to sound a little bit repetitive, but a funding policy does provide guidance to staff. So, for example, it can define terminology. It can serve as a platform in terms of things like, for example, the reserve accounts and how those are structured and what the definition is. It can provide some guidance regarding the interest crediting part, and we'll talk a little bit more about that later. It can also provide guidance and outline what the actuarial process and the experience study process looks like at LACERA. So from a legal perspective, there are minimums, but from a practical perspective, how does LACERA apply that?
Nick, does the funding policy assist you as LACERA's actuary in performing your work for the system?
Yeah, it definitely gives us guidance. I kind of want to go back because I realized, thank you.
Please.
Yeah, if I could go back and talk a little bit more about the purpose of the funding policy. I realized I kind of shortchanged that. We actually had a slide to talk about that. If we go, I think it's slide 7.
Yeah, slide 7.
Just to talk more about the purpose of a funding policy. So this is kind of what an actuary looks for in pension plan funding. From an actuary's perspective, clearly the most important thing is definitely to having a plan, a solid plan to reach 100% funded ratio. Without that, there's a lot of sleepless nights among the system's actuary. So just a reminder, 100% funded ratio means that we've accumulated enough assets that if they kept earning at the assumed rate of return, they could pay off all the accrued benefits as of the valuation date. What's critical about that 100% funded ratio is a lot of benefits. As you can see here, it provides benefit security for members. And because moving towards 100% funded ratio, you're pre-funding the plan, you're putting the contributions ahead of when the benefit payments are due. By getting those contributions in, ultimately, you get more investments on that. So in the long term, you'll actually have lower employer contributions. And lastly, it looks good to bond rating agencies. Obviously, when you're funding a plan, invariably, there's going to be fluctuations in the assets. And when the assets fluctuate, that flows through to the unfunded liability. And that is, the unfunded liability is the basis of your contributions. So if your unfunded liability bounces around, then your contribution rates are going to bounce around, and that's obviously not ideal from an employer perspective of having their contributions bounce around a lot. So one of the purposes of the funding policy is to set it up so that we can maintain reasonably stable employer contribution rates. How do we do that? We go into our actuarial toolbox, and one of the first thing we look at is the cost method, the actuarial cost method. That's used to allocate the cost of benefits earned each year. And we want that to be allocated in a level manner because that's a part of the contribution. So keeping it level keeps the employer contribution more level. And the second piece is having a reasonable period to pay off the unfunded liability. This balances funding progress and employer rate stability. If you have a short enough period, then you have what's called intergenerational equity. That means you're not passing the costs of the current employees on to future generations of taxpayers. The flip side of that is if you have too short of a period, then you're having to recognize changes in the employer contribution rate over a short period, and that causes unnecessarily volatility in employer contribution rates. So really one of the key things in that funding policy is to balance that progress towards contribution 100% funded ratio, but while maintaining at least relatively stable employer contribution rates.
And just as a reminder, where are we in our funding rate right now?
You're about on the funding ratio.
Mm-hmm.
Yeah, you're about 80%. So you're about a 20% shortfall.
Got it. So we got some more. Yeah.
Oh, I just picked 80% because I like round numbers. I think it's 79.6 or something.
Yeah, that's correct. 79.6.
Okay.
Got it.
All right.
Yes.
So when you were talking about 100 from the ratio. You stated that that will be sufficient to pay the accrued.
Exactly.
And that will be all employees who've been in the county over 5 years, because it takes 5 years to vest. Is that correct or no?
Well, it's more of a theoretical number. It's as if your current members didn't earn any more service, because the service is funded by the normal cost, right? That's the value of the benefits being earned each year. So my example was, if we had the money right there, it would pay for the benefits being earned as of the valuation date, assuming no more service. And we in that calculation, we do assume that they accrue service for vesting and eligibility, but not for benefits.
Got it. So we will, in that scenario, we will have enough money to pay 100, assuming that all county employees, I believe we're at the 120,000 people. If we all were to retire today at 100% ratio, we will be able to pay every single individual?
No, I mean, if it would be, then you would still need, because if everyone retired today, well, most people couldn't retire today because most people aren't eligible for retirement. Basically, it's following the assumptions of when people retire.
So the 5 years are key.
Yeah.
Okay. Thank you.
Okay. Thank you. Sorry to take us down that rabbit hole.
All right. Ashley, you and Nick and Ted have described what a funding policy is. What is a funding policy not?
A funding policy doesn't replace your annual actuarial valuation. It doesn't replace your triennial experience study. It doesn't have all of the contribution rates that are owed to you, or all the contribution amounts owed to you by your members, your employers. And it probably won't articulate all of the assumptions, or maybe even any of the assumptions, or all of the methodologies that your actuary uses. Those are all set forth in great detail in your evaluation. But what it does do is it identifies the principles that inform you as you work with your actuary to assess the results of your experience study, and perhaps change some of your assumptions as you implement those assumptions and methodologies with regard to your evaluation that results in the setting of contribution rates. So there are three distinct documents that have different roles from one another.
Before we transition on to the next section, are there any questions, additional questions about the purpose of a funding policy?
I just have a question on information regarding that. Our LACERA's funding policy in relation to CERL, akin to like FLSA law. FLSA is the floor, but through contractual agreements or policy, greater than the floor can be paid. Is LACERA's funding policy lockstep with CERL law, or is there a difference between the two?
That's a great question. The funding policy should reflect any rules that apply to you with respect to funding under either CERL or other applicable law. So one good example of that is, and we'll talk about this later, but when the Public Employee Pension Reform Act of 2013, PEPRA, was adopted, it mandated that your members who are PEPRA members pay 50% of normal cost, which means that each year you need to readjust the member contribution rates for your PEPRA members in order to comply with that statutory mandate. That's reflected in your funding policy. It's those types of guardrails that are set forth through the statutes that are helpful to be articulated in your funding policies, so that people know the rules of the road. You don't sort of lose them within the weeds of the complications in CERL. You pull them out, you expose them, and that shows that provides the framework for why you're taking the actions you are.
So it is in lockstep. I mean, of course, it's in line with the law. I guess my question is it Is it more than the law? Is it more stringent or?
It's not neither more nor less. It's a governance document that that articulates how you're going to exercise your plenary authority and fiduciary responsibility over funding the plan. So and we'll talk about this a little bit more later, but your members have a vested right under California law to an actuarially sound plan. And so the question then becomes, what does that mean? What makes this an actuarially sound plan? And in your funding policy, you can articulate as a board how you are reaching that, how you're complying with that legal responsibility. You're not setting a bar lower or higher for yourself. You're saying how you are doing this, how you're just exercising your discretionary authority. You're not going to have the same determination as another SERL board about how to get there, and you might both be right as to how each of your plans are to be funded in an actuarially sound way, but you're exercising that discretion through that the articulation of priorities.
Yes, that makes sense. It cleans up it simplifies the language and makes it more digestible for everybody involved with it.
Yeah, I like that you said that. I think that's also a goal, transparency, to say things in clear language or state these principles in clearer language and in a more digestible format that you'd find in a policy than you'd have in a 300-page valuation, which has lots of very important information, but it's not easily read by your membership or others.
Dickens, it is not.
Right. Well said.
All right. If there are no other questions, I'll pass the presentation at this point to Daniel.
Great.
Good afternoon, Chair, trustees. We're going to focus now a little bit more, after reviewing the funding policy, we're going to focus a little bit more on the technical requirements. Cindy, if you mind going forward a little bit. Maybe another one. So these are the core elements that we're going to be looking at in funding policy. We're going to address each one of those different elements. They're a little bit more technical than the ones we discussed previously. It's how do you determine the contribution rate? How do you reach your target funded ratio? So we're going to focus on the actuarial perspective, and we're going to start off by the funding goal, and then we're going to and then after that, we'll address the actuarial cost method, which is going to go a little bit down the rabbit hole that Mrs. Sanchez mentioned. Nick, how do you address the actual cost method in your funding goal?
Do you want me to start with funding goal, or you want to start?
Sorry, yes. Why don't you start with the funding goal? Apologies.
Okay, yeah. So first off, the funding goal really isn't a core element of the funding policy, but it is important, an integral part of the funding policy, because it provides the framework for the other core elements, because it sets the goals that we want to achieve. And so that leads us to how we want to phrase our other elements that are more actuarial in nature. So looking at the funding goal for LACERA specifically is to get to 100% funded ratio, which I talked about a little bit more a little bit earlier. Obviously, and then the other benefits of having the other objectives that are in the funding policy are very similar to what I talked about before. If you get to 100% funding ratio, that provides benefit security for members. One of the objectives of the funding goal is to maintain stable employer contributions that are as low as practicable, and also to provide intergenerational equity. So that kind of sets out the goals. And then the kind of core elements are where we go next, and that's how does the actuary take the plain language instructions, and as much as possibly actual stuff is, and then convert it to mechanisms to achieve those goals.
So generally speaking, the goal is to reach a 100% funded ratio, but then by doing so, we need to keep contribution rates stable and favors that intergenerational equity that we mentioned, so that certain categories don't get treated differently from other categories between different generations. Ashley, would you like to add something upon that?
The fiduciary framework to consider all of this in is your duties of prudence in administering the plan and your duty of loyalty to the members and beneficiaries. And that's what's reflected in this desire to provide benefit security to your members by seeking your 100% funded ratio over time, maintaining an actuarially sound plan that avoids significant volatility in employer rates, and seeks to pay off the UAL. So I'd say all of these core elements are contributors to the framework that's allowing you to comply with your fiduciary responsibilities to your members with respect to the prudent administration of the plan and funding of it.
Any questions? Yeah.
So what happened? So the board sets the employer contribution rate. Let's assume it was 18%. And the employer, the county, LA, says, I'm not going to give you 18%. I'm going to give you 10%. What is our rights as a board, an obligation to enforce the 18% that was set by the board based on recommendations by the experts?
We are very fortunate in California that we have very strong law that supports your absolute authority to demand that payment.
You go to court.
Plenary authority over administration of the plan, which includes the proper funding of the plan, and that's also written into CERL. So it is a ministerial act by your employers to pay the amount that you determine in your judgment is due. The judgment obviously needs to be informed by the recommendations of your actuary, and that's also in CERL, that your decisions need to be based on recommendations of the actuary. You can't be taking actions that are arbitrary or capricious, because those will be determined to be so by a court. But if they are consistent with the recommendations of your actuary, consistent with prudence, not seeking to overfund the plan, say, by 150%, which would not be consistent with your constitutional obligation to minimize employer contributions, but instead are consistent with your obligation to fund the plan prudently to pay the promised benefits, you have an absolute right to do so.
Any further questions on the funding goal?
Yeah, Mr. Santos' thing, correct me if I'm wrong, but if LACERA was unable to meet their obligation to pay, the county would, under that same law, would be ultimately on the hook for it. I mean, which could include litigation to ensure that. If obviously we're talking about scorched earth or something, that I don't see that happening, but if we weren't able to fund it on our end, ultimately the responsibility falls on the county.
Yeah, there are a couple of things going on with your question. One relates to the right of members to receive their the deferred compensation that is promised to them and enforceable as a debt due to them when they retire. And that's an obligation that the employer has to fund the plan. And it's an obligation that LACERA, as the fiduciary, has the obligation to pay. So yes, ultimately the guarantor is the employer, but you as trustees of the Board of Investments have a immense responsibility also to make sure that the plan is funded properly so you can pay those promised benefits. And that's a big benefit in California to have an actuarially funded plan. It's different from other plans in other parts of the country where the legislature gets to decide how much they're going to pay. So the actuary determines what should be paid, and then the legislature says, well, we'll only pay a portion of that. That's why you see terribly underfunded plans from time to time. But you don't see that in California so much because we have this strong constitutional and statutory based protection of benefits and of the funding of those benefits. And that's why your actuary is so critical to this process, to make sure that you are prudently planning for the future and bringing in those contributions, demanding, to Trustee Santos' comment, demanding that they be paid in the correct amount, and keeping your eye on the ball. It's not just waiting until you can't pay the money because somebody's retired and you don't have it in the trust fund. You have an obligation to look ahead and determine if assumptions are not matching, or if your experience is not matching your assumptions, to make adjustments.
And for those of us who are appointed, I know, I have this conversation with our kind of supervisor in her office. I always remind anyone that I talk to about unfunded liabilities is that they are significantly more expensive to pay later. You can pay them today in present value dollars, or you can pay them later, and it will be a lot more expensive. If you choose to underpay today, it will be a very expensive option if you're wrong about what, if you think we can return more than we end up returning, we'll be on the hook for the difference, right? So if we underperform our expectation because the markets change on us, the cost of having to pick up the tab later is significantly more expensive because you won't have the benefit of that money compounding.
Your comment, may I, Trustee Sanchez, illustrates a couple of important points I think that we should just focus on for a second.
Mm-hmm.
One is each of you are fiduciaries wearing that single fiduciary hat on this board. So regardless of what the supervisor tells somebody in that side conversation, or what a member of a union who wants to pay lower contribution rates and therefore doesn't want you to change the discount rate says, that is utterly irrelevant to the question of what you should be doing as a fiduciary to make sure the plan's properly funded. So that's point one from a fiduciary perspective. Mm-hmm. The second is you're a pre-funded plan. This is not a pay-as-you-go plan.
Right.
So to the point of being able to properly minimize employer contributions by diversifying the investments of the plan, maximizing your risk-adjusted returns, and therefore anticipating that you're going to earn money in a way such that the employer doesn't have to pay a large unfunded liability over time that doesn't get the benefit of the markets. It all has to be taken into consideration. And that's why it's important for this Board of Investments, in this sort of segregated governance structure that LACERA has of a Board of Investments, Board of Retirement, that investments take on the actual funding practice, because you're responsible for the investments, and therefore you're also responsible for the contributions. It's that side of the equation. Board of Retirement is responsible for paying the benefits, but you got to make sure they have the money on hand to do so.
If I can give the actual perspective on Ms. Sanchez's comments, that would be amen. You're spot on.
Well, thank you.
Anything else on the funding goal? I'll move on then. So for the next three, we're going to follow the outline on this page. And so for the next three circles or bullet points that we're talking about, the actuarial cost method, actuarial asset method, and amortization, those are more the mechanics. The actuarial cost method is really how we account for our liabilities at a high level, if you think about it. The actuarial asset method is how you account for your assets. And then the amortization is sort of how do you match those two and the asset liability mismatch in terms of timing. So can we move to the next slide? So Nick, can you please delve into the sort of the mechanics and the different ways we can account for cost of an employee in terms of pension benefits?
Yes, definitely. If I can just kind of go back to your comment on the prior page, those basic elements that we talked about, those aren't things that I just determined or someone determined. Those are guidance both from actual organizations and from the Government Finance Officers Associations, the GFOA. So those are kind of standard parts. If you look at other funding policies, that's what you'll see. So talking about the mechanics of how the liabilities are calculated, and particularly the normal cost, we use the actual cost method to do that, to allocate the cost to the given year. And it's actually kind of a complicated process, which I'll spare you, but I just want to highlight two things about it. One is we use, or LACERA uses, the entry age cost method. And On the public sector side, that is kind of the gold standard of actual cost methods, with about 90% of public sector plans using it. And you can see why in this graph on the lower right-hand side, if you, as a member works their way through their career, when early on, there's a lot of time to earn on increases in salary, and you get investment earnings. The costs early on are very small, but as somebody gets close to retired, you don't have time to fund that. So when a person gets close to retirement, the true cost of that benefit being earned in that last year is quite expensive. Now, having you can see that blue line is pretty steep and increasing. Well, that's clearly not ideal for employer budgeting. So the entry age actual cost method is one of our little actuarial, it's in our actuarial toolkit. What it does is it goes back from entry age, hence the name, to retirement, and kind of smooths out the cost as a percentage of pay to get a level allocation. So therefore, at least in theory, as a member works through their career, the actual cost of their benefit that we recognize and contribute for is a level percentage of pay. So it keeps things smooth. And when you've heard us talk about the actual valuation, a lot of times we say we know things are going to move around, but the normal cost will stay very stable, and that's why. So that's all I have on the actual cost method.
So on the graph is you see how the actual benefit accrues here on the value of the benefit earned, and that's the liability that we're accruing. And next we're going to see how we account for the asset value of things. So that's the next slide, please.
Just a quick question, Madam Chair.
Sure.
Yeah.
At your discretion.
Yes. Go for it.
But this is representing, and I'm just for clarification. This would be the entry age for legacy members, right? Because post-PEPRA employment, it's a set value, shared costs with the employer. Is this still applicable to that? I mean, or this is for legacy type membership?
Yeah, that's a good question. Yeah, there's really two things going on there. There's the member contribution rate, which, as you said, legacies, their member contribution rates vary by entry age, but for the new PEPRA members, everyone pays the same. This is really sort of the total cost of the benefit being earned. Obviously, as you know, the members share that total cost. So when in that example I was using, that's the total cost of the benefit.
Slide 10, please.
And so what we're doing is then the member share in PEPRA, that orange line, that is the cost, and say it's 20%. PEPRA says, hey, members have to pay 10%. So members pay exactly half of that orange line, because that's the total benefit being paid. Employers pay 10% of it. And the employers pay 10% of pay, or half of it, and then the members pay 10%. Now, for the legacy members you talked about, the people early on who enter early pay less. That's the way the formula works. They pay a lower percentage of pay, whereas people enter later, they pay more. So that one does vary. But this, I've really kind of focused on the total piece, the total pie of the benefit being earned, not the split between the employers and the members.
And Nick, can you remind me also, when you're doing when we do our experience study, we're not only looking at the experience of the performance of the portfolio, but we're also looking at the experience of how many people actually retire relative to how many we thought would retire, and the longevity and the maturity of our organization. Is that correct?
That's exactly right. Yeah. Which, from our perspective, that's, it's a big chunk. Obviously, the investment return gets a headline, and we love a good investment return, but obviously the liability side has a big impact, can have a big impact too. We can do a little bit better job of projecting the liability side than the asset side, unfortunately.
Right.
So the way I look at that is the economic assumptions. Obviously, we can kind of figure out what those are, and the demographic assumptions, I think, is what Nick was just referring to on the liability side.
Right. And how close have we been traditionally in that regard, in terms of, have we had just like a rush of retirements that we weren't kind of budgeting for and an unfunded liability that we then crystallize?
No, we haven't seen really any blips until the last few years. We saw a few blips, but they kind of went both ways. Obviously, there was more deaths than expected during the height of COVID. It wasn't as bad as it was nationwide. That kind of had like a slight dropping on the liability side. There was I think there was more retirements. There was definitely more terminations. That's what we saw across all our systems. But there wasn't enough of a rush that it really drove the liabilities. We were still pretty close on our projections. COLAs were a little bit higher, but really, if you looked from year to year, our liabilities were were plus or minus 1%, whereas obviously the assets can be up 10% down. So that's obviously a lot more variance there.
Yeah, thank you. Okay.
Should we continue? So can we please go to slide 11? So on this slide, we'll be talking more about how we account for our assets, and Nick will help us get into those technical details.
Okay, so as we talked about, one of the keys in our actual toolbox to mitigate variance in the assets, we know from year to year the assets are going to move up and down, is asset smoothing. So if we have a big return that's well above our expectation, we don't recognize all that one piece. We recognize it over 5 years. Similarly, when we have a loss, and we tend to have, we don't have 5 huge big gains in a row or 5 huge losses tends to be. So what we do is recognize them over 1/5 at a time, and that tends to smooth out the valuation of assets, and that's used to calculate the unfunded liability, which we have to make contributions on. So that keeps unfunded liability from not moving as much as it would other. It's not as stable as the normal cost rate, but by using asset smoothing, it kind of dampens a lot of that volatility. LACERA in their funding policy specifically says 5-year asset smoothing, as you see in the chart on the left-hand side. We have 5 years is used by about 60% nationally, and that's even more within California. So definitely it's the kind of the most typical one. I think it has a good balance between mitigating year-to-year asset volatility, but also still staying recognize where the market's at and not getting too far from that. And I'm going to spare you the one on the right because you guys have been so great asking a lot of questions. But I would love to talk to you about offsetting gains and losses, but maybe that's a happy hour thing.
That'll drive us to drink. Moving on.
Any questions so far?
No, I think we're good.
So what we saw is how we smooth our assets in order to get stable contribution rates from the employer. Next, we're going to touch upon the amortization. Next slide, please.
As I talked about, when we're talking about the employer contribution rate, it's made up of 2 components, the normal cost piece that the members don't fund. So as we talked about, that normal cost tends to be pretty stable. And then the second piece is payments toward the unfunded liability. Now, actuaries would love it if employers just wrote a check for the entire unfunded liability in one fell swoop, but we know that's not going to happen. So what we do is we use what's called layered amortization. The other options are closed, like your mortgage, where you just pay over 30 years and then you're done. But if you do that, but what's going to happen is the unfunded liability is going to move around. So by the time you get to the end, it would make your contribution rate very volatile. And the other is rolling, where you just refinance every year and then you never get paid off. So neither of those work very well. So we use kind of a combination of that, and it's called layered. So we set off our initial payment, say you're basically your mortgage payment, and you pay that off over 30 years, or in this case, LACERA's case, 20 years. So we pay that off, and then year to year, then the unfunded liability is going to change, and then we set up a new 20-year payment, sort of like a home improvement loan, and pay that off. And you can see that this kind of the layers that we've shown here of the different years that we're paying off. And as they drop off, your contribution rate will drop off. If we're still around here, what's that, in 2038, we'll start seeing the employer rate decline from as those layers drop off. But you can kind of see, the point I want to make was that, so LACERA used to be 30-year amortization of their unfunded liability. Now, when you do 30 years, you end up with what's called negative amortization because we fund as a percentage of pay. So we're expecting the payment to go up every year by about 3%. So if you do it over 30 years, the rub of it is it takes about 17 years before you actually start paying down your original principal, because with negative amortization, your amount actually goes up every year. So about 5 years ago, LACERA switched to 20-year amortization, and that has, because it's a shorter period, the big payment's much bigger. You actually immediately start making some progress on the principal, and we're very happy that LACERA made that change. Once again, that's another thing that helps me sleep at night. So the kind of how does that all play out? You can see that in the projected unfunded liability on the right-hand graph. You can see that. Immediately that the unfunded liability is projected decline, and you can see the projected payoff is actually slightly less than 20 years because LACERA went to 20 years a few years ago, and so we've already made some progress toward that. So a positive picture there.
Okay, Ms. Jones.
Thank you. I have a question. Let's just shoot forward in time, and it's 2039, 2040, somewhere in that time period, and everything turned out just the way it was supposed to. The UAAL, the unfunded liability, is down. So we have, whether we have a loss or a gain in that year, what does the smoothing look like? Do you need to do the 5-year smoothing because your unfunded liability is down, or do you smooth to prevent it from racking up too quickly again? Or I don't know, what does it look like once?
So you got the flip side. You've got two things going on. You got your asset smoothing on your assets, which are, so your assets we use to calculate unfunded liability aren't going to be exactly equal to the market value of assets because it's going to move around. And the second thing is by layering, we've kind of dampened the increase there. So we would continue with the same asset smoothing would be my recommendation. But once we get to that point, it's possible, let's say you had a big deferred asset loss, then you might want to, at that point, reset your assets and recognize that loss. And kind of, so instead of having this big decrease in your contribution rate when those layers dropped off, but we knew we had this actual asset loss on the horizon, and then all of a sudden next year, we've got this unfunded that reappears and bounce up. So we might want to kind of do a little work with the asset smoothing at that point, but it depends on where the situation's at.
And that's important, right? Because I thought that was part of the issue previously when funds were fully funded and things were great, and then all of a sudden the market tanked.
Yeah. So one thing under PEPRA, once you hit your fully funded or your 100% funded ratio, it used to be that employers took contribution holidays.
Right.
So that's not allowed under PEPRA anymore.
Yeah. Hello, New Jersey.
And then what if there is a gain? So you have a surplus. How does that factor in?
So PEPRA specifies, and that's kind of the last piece of the policy, which I'm glad you brought up because it kind of relates to amortization. It's the flip side. It's what happens when you're overfunded. Mm-hmm. So if you're between 100 and 120%, you still pay the normal cost. So you're paying the ongoing cost of the benefits, and you're kind of hoping your funded ratio kind of just hangs around at 100 to 120%, then you're just paying the normal cost and everybody's happy. If you get over 120%, it's possible to lower the contribution rate below the normal cost, but there's a lot of stipulations put in by PEPRA. So that's obviously way down the road. But I actually have a client, San Mateo County. They started their thing. They had their unfunded, and it got paid off in 2022 and 2023. So their rates went from 40% down to 20%. So they've had that big decline, and we've done a couple things to. They always like to be conservative, so we've kind of done a few things to kind of smooth things out. So we didn't end that situation where it's a big decrease, and then we're going to have this rebound increase. So we've trying to kind of smooth things out for them, and that's probably something similar to what we do.
Right. Understood. Thank you.
Any further
Mr.
questions
Ryu?
on amortization?
Mr. Ryu?
I just forgot my first question, but my second question is the chart amortization, the chart that we have up right now. Can you re-explain these two charts, what we're looking at?
Okay, yeah. So sorry, I went over that one pretty quickly. So as I said, we use layered amortization, and back about 5 years ago, LACERA, the board adopted, went from 30-year to 20-year. So we at that point we had a number of layers. So as I said, these were payments towards different portions of the unfunded liability. We did some compression, but really the dark blue one was the one from. I don't have my glasses on. I apologize. Looks like from about 2018.
2018, yeah.
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 Or I could go back. I'm nearsighted, so if I went back to this, I bet I could see it. Yes, so that's the initial UAL. So that was from 2018, which was when the change was made. So the amount was, say, $5 billion. So then we set up this payment schedule, amortization schedule, to pay that down, and it's funded as a level percentage of pay. So we expect that contribution to be about a little over 4% of pay. Then there was a loss. I think there were some changes in the assumptions. There was some negative asset experience. So that caused another increase in the unfunded liability. So we set up this new layer. So this new amortization schedule. So we're paying that over, and that's going to kind of trail by 1 year.
So in like 2039, you're saying the initial unfunded liability will be zero for the 2018. That's why it's.
Yeah, and so it drops off because it's under. I think it was a 20-year schedule started in like 20.
And then our projection here, based on the two charts, is we'll be 100% funded, I guess, by 2040.
Yes, and so so the other one is the percentage of pay, and this one is actually the total dollar amount. So currently your unfunded is about $18 billion, but it's projected to decline each year. Of course, it's not going to exactly do that, so it may go faster or may go slower, but
and a lot could happen in the next 20 years.
Yes.
And one of the reasons that we actually were increasing those is because we were decreasing our discount rate, because we were the markets were just, you're starting your process of building your assumptions at 0 in the short end. Now the short end starts at 5. So there is also a possibility that as we start to recognize a different performance expectation in the portfolio, that will also have an effect on this.
And then, I'll follow up on Ms. Jones's question. So if we get to zero, if we get to 100% funded, right, whatever year that is, then what the employer contribution still has to, does it disappear or does it?
No, well, you have to pay the normal cost, the value of the benefit earned under PEPRA. So that contribution we pay, you wouldn't make any contribution towards the unfunded amount.
Oh, right. Because if you don't pay it, then you'll go to negative. Oh, and I remember the first one. I don't know if it's for our staff or to our board chair. Can we, and I've spoken to several people about PEPRA. Can we get a summary of that whole, how that all got created from staff?
There's a presentation that was given by Fern that's on record, and I think she had some handouts on it.
Yeah.
I think that's available.
Yeah.
Mr. Chair, if I may, I just have a couple questions, human capital questions, theory. The amortization model that you're using, because of the, we've discussed this before, is there assumptions in the model, assuming the population of the county employees remains the same?
That's correct.
And that assumption, is there any dialogue being done regarding, recruitment and retention? We've had the discussion before. It's an area of concern with a nexus to Pepper because, it creates an unattractive, employment environment, so to speak. So is there been dialogue looking at that in these amortization modeling?
Yeah, I mean, first off, we do a risk analysis that we provide to the board. I think is it in June usually, and one of the things we look at is, hey, what happens to the amortization schedule if we do have a decline in population? So we do provide some analysis of what ifs if things don't go according to the assumptions, which we know is going to be the case, and kind of provide the relative impact of how that could possibly affect LACERA's funding.
We're at 110 active employees, right? 110,000 active employees. I think that's the count.
Close to 100,000.
Close to 100,000. Yeah. So, and do you have the what if starts where? What is your what keeps you up at night, as you say? What's that marker? What's that thing to shout, watch out?
As far as
decrease in population. 20,000.
Yeah, I mean, I know that's going to increase your contribution rate pretty significantly if you had that drop. I work with CalSTRS and they're the teachers' retirement system, and they're projecting declining school population in California. So that's something, we're really concerned about. Yeah, so it's the same thing. Yeah, if you get a declining population, it's going to increase its percentage of pay. Now, the interesting thing is that since you have a lower payroll, the actual contributions aren't necessarily going to go up. It's just the contribution rate as a percentage of payroll that will go up. But yeah, that's... But yeah, we know the populations are going to move up and down a little bit, but if we see a sustained decline, that would be a concern.
We've discussed that. I mean, I think in the June presentation, I mean, it's not just the number of contributors, but it's also the higher earner contributors not coming into county service. That I think there's a double edge to it. Potentially creates some risk. So,
and Trustee Green, just to follow up on that, we're working with Millman right now on a report, I believe, for the next board investment meeting to kind of explore that a little bit further, that topic.
Thanks. I think we talked about, thanks for doing that. That's huge. Yeah, we'll shed some light on it. I think it can answer some questions on, I mean, again, looking into the future. So I don't know what other trustees share the same fear of it, but I really think it's prudent and important to look at.
Thank you. I don't. I mean, the county will have to eliminate the fire department, the public defender's office, the district attorney's office. I don't see that happening. Even if they were to have layoffs, I don't think that it will be that substantial, given how the Board of Supervisors is so fiscally conservative, which is a blessing, quite frankly. So I don't stay up at night thinking about that. I'm more worried about the returns. Are we going to meet that 7% bogey that we set up in things like that? But I'm not worried.
Okay.
I don't know. What do you think?
Any more questions on amortization?
No.
Can we go back to slide 9, please? Back up. So we talked about the funding goal. We've talked about the actuarial cost method, so how liabilities accrue, the actuarial asset method, or how you account for your assets. Amortization, how you pay off the mortgage. It was Nick's way of thinking about it. Nick, can you maybe talk a little bit about the surplus management?
Kind of already talked a little bit about, yeah.
Yeah, that was Ms. Jones's question.
Yeah,
I think we
yeah.
hit on the PEPR limitations on that.
I think
Okay,
covered
we're good.
that.
Okay,
Yeah,
just
we're
want to
good
make
on
sure we touched upon it, but I know we talked about it a little bit more. So after seeing all these different elements and so these requirements that we need to put in a funding policy from an actuarial perspective, how do we compare to other systems? Can we go to slide 13?
Yeah, I think that's really a pretty short answer. LACERA is definitely in the mainstream of what other systems in California are doing. As I talked about the entry age cost method, 5-year asset smoothing, that's what other people are doing. Funding it as a level percentage of pay. This graph kind of shows the one area of a little bit of difference, even though it's fairly tightly bunched. That's the period they're paying off the unfunded liability. Any changes in future unfunded liability, that is. LACERA is at 20 and there's some down at 15. Actuaries generally tend to like to be conservative, and paying it over a shorter period seems like a good thing, but we've done a little bit of analysis on that, and we found that if, as far as the period that the future changes in unfunded liability are funded over, we didn't see any significant difference in future funding levels for LACERA at a shorter period, but we definitely saw a noticeable increase in the year-to-year employer contribution rate volatility. So we're very comfortable at the 20%, at the 20 years.
And moving on to slide 14, how do we compare on contribution rate and funded ratio? Slide 14, please.
Yeah, so there's a lot of things that obviously are going to affect, where your funded level is, what your employer contribution rate are. But I would say the funding policy, definitely has a pretty significant impact. So this kind of gives you an idea of a couple of the key metrics of how your funding policy, has it worked? Are you achieving your goal? Are you at least working towards achieving your goal? So kind of looking at where the other systems are, how you relate. First off, we talked about you're just a tick below 80%, and the average plan in California is about 82%. So you're a little bit lower. And I think one of the main reasons I talked about earlier is LACERA used to be funding over a longer period, that 30-year period, where other plans are under 15 and 20. And now LACERA has moved towards the 20 years. So they've kind of leveled the playing field there. So that's maybe why you're just slightly behind. But I would note that it was talked about by Ashley that California is very responsible in funding if you look at the systems and the law. So if you took LACERA's funding ratio and you took it, maybe your peer systems nationally, the large statewide systems, you'd be about ahead about 67%. You'd be ahead about 2/3 of the systems. So you'd be look better there. Looking at the employer contribution rate, here you're well below average, where that's a good thing that the employers are having to fund, having lower contribution rates than your other systems in California, or at least most of the other systems. Part of that, I think, is due to your legacy plans, particularly your Plan E, which has a lower normal cost rate, so that contribution is less. But that's kind of how. So I think it's if you contribute less, you generally expect to be lower funded, but your employers have contributed quite a bit less, and you're really not far behind the average. So I think your funding policy is working pretty well.
Yep.
What impact, if any, the funding of the plan is impacted by the fact that this board, on at least 2 occasions, delayed the implementation of the lower return hurdle? That's one. And 2, what impact, if any, the fact that we were taking into consideration the Star Cola funding as part of the overall funding, You understand my questions?
No, I definitely understand your question, and I'm trying to do the math in my head. But yeah, it's LACERA would have a higher funded ratio now, but it wouldn't be 85%. You'd be 81% maybe. So it's not. It would be a little bit better, but one tick of 1% is is $1 billion, so it does make a difference, but it wouldn't really change that picture significantly.
Well, and then you take that $1 billion and you invest it.
Yeah.
So it compounds I'm going to say the losses.
Yeah.
And I think I raised that to my colleagues here is that remember, decisions that you make will have impact in the future. So we need to be judicious in making sure, and I'm guilty of that because I voted for that until last valuation where I suggested that we no longer use the Star Cola funding as part of the overall funding of the plan. So those of us who are not going to be here in the near future, ask you to please be diligent because we cannot afford to lose that type of money.
Mr. Santos, when was that? When did that happen?
I don't know, Nick. It was 6 years ago, and then after that was like another 6 years before that. So like
It's like 3 years ago.
Yeah, there was one about 12 years ago where the investment return assumption got ratcheted down by like 5 basis points. And then I think your recollection is about right. I know on the Star was, I think, around 2010. Is that?
We had the county CEO come in and ask just about beg the board to delay the implementation or not to reduce the discount rate. That's irresponsible on the employer, in my view, but it happened. So I'm asking to keep an eye on that in the future because I'm going to be the beneficiary. I'll make sure that we get fully funded. A little selfish here, but what can I say?
He knows when public comment is.
A quick question.
Yes.
Which system is the one on your graph with 78? What is that? 78% employer contribution? Who is that?
I didn't want to like call them out in public session.
Okay, I'll ask you afterwards.
Okay.
That's a cocktail conversation.
Madam Chair, just on the point that Trustee Santos made, not to let that fall too hard. The board made a judgment call at the time based on the information presented to it about how to manage the plan in a prudent way. And we've talked about the balance that needs to occur with respect to consideration of various principles when managing the funding of the plan, one of which is minimizing volatility of employer contribution rates. So to the extent that a decision is made to say, phase in a discount rate in order to achieve an appropriate goal from the perspective of prudent administration of the plan, there's no fiduciary violation. There would only be a fiduciary violation if you were doing that to the detriment of the plan stability. And your actuary were not recommending that you made that sort of, took that sort of an action.
So are you talking about the action 3 years ago or the action?
Right. Well, I'm not talking about a specific action. I'm just talking about the general comment that the board was, or a suggestion that the board was irresponsible. I'm not opining one way or the other. I'm just saying that in retrospect, one might view a particular action in a way and characterize it as irresponsible. But what one needs to look at from a fiduciary perspective is what was the information presented to the board at the time? Were the appropriate considerations being was the board considering the appropriate factors, and that this is complex, it's nuanced, And you have to make these decisions in consultation with your actuary, considering the various different factors.
In response to that, in support of Milliman, they did not recommend that. Nevertheless, the board went ahead and did that. They felt that they would not recommend it, but it was still reasonable. I believe that was the word that was used back then. So.
Right, and I don't mean to rehash old, what's happened in the past. On the other hand, recommendations of your actuary are important. The board's exercise of its own independent judgment is also important. You're not a so-called rubber stamp for your actuary. So to the extent that your actuary is telling you that something is reasonable, within the realm of reasonable, and the board decides for prudent reasons to follow that approach, that also can be defensible from a legal perspective, given that you have plenary authority and fiduciary responsibility over this. A retiree or two might not like it, and that's their right to express in public comment. But you have the most important responsibility of managing all those variables when making your decisions.
I mean, I think it is important that every one of the decisions that we make is made with the information that we have at the time, and we want to make the best possible decision we can make at that time. No one is going to hold us accountable to be, to be omniscient or,
clairvoyant.
Right. Yeah. So
well, and as
clairvoyance is not a requirement for fiduciary duty.
Precisely. And as Trustee Santos, you made a good comment earlier also in a different presentation about it takes 5 votes, that ultimately it's the majority of the board who decides. So you each should express your different opinions if you have them about these things, and attempt to persuade one another so that you achieve the right result from the perspective of as many of you as possible.
Great.
Madam Chair, just a quick question. We probably have, I'd say, another 20 minutes or so, and I see that we're running up on time. Would you like to pursue and overrun, or would you like to do something else?
Can we kind of focus on, say, finishing up in about 10 minutes, so half that time? I'll split the difference with you.
Okay.
And maybe let's do the highlights of what we want to kind of get to at the end.
Okay, so I'll hand it off to Cindy to talk a little bit about LACERA history.
Thank you.
Thanks, Daniel. So far we've discussed the funding policy broadly, as well as reviewing some of those core elements. For this next part of the discussion, if we can jump 2 slides. Great, okay. So a question for Ted. Please walk us through the history of LACERA's funding policy. When was it created, and what have been the milestones since then?
Yeah, absolutely. Thank you, Cindy. So the first blue circle is sort of on the left-hand side of the timeline, really are addressing the county's efforts and their thoughts and considerations in terms of funding the retirement system. In 1987, they issued some POCs, some pension obligation certificates. In 1993, they adopted a resolution to issue the POBs, or the pension obligation bonds. Again, the county's thought process. In 1994, that materialized. They did issue the bonds of about $2 billion. That agreement set up in 1994 between LACERA and the county was, in essence, a transactional type agreement, getting the money from the county to LACERA to fully fund the retirement system, about 97, 98%. Fast forward to 2002, the county had some experience. They had some history. They recognized or realized that the funding level wouldn't stay at 100%. It would fluctuate a bit. It would go up above and it could go down below. That is when the first point that, in terms of our research, we found the county starting to think about some of these funding type concepts. They talked a little bit about surplus earnings in this agreement. They started thinking about funded ratios. So again, that was kind of the groundwork from the county's perspective. When we look at the purple circles, 2009, 2013, the shift focus, and that's the key, I think, takeaway of this slide, the shift focus over to the LACERA side. LACERA developed a funding policy, and that's where we laid out these actuarial principles funded ratio, actual cost method, unfunded liabilities, all the things that we've been talking about today so far. That's really when it was first sort of put in writing from the LACERA perspective. 2013, there were some updates due to PEPRA that were required. Ashley's mentioned those. Nick's mentioned those. The employer must continue to fund the normal cost ratio, normal cost. And also when the funded ratio goes above 120%, then we can talk about excess earnings. So kind of just a walkthrough real quick.
Thank you, Ted, for the historical context. Can you also walk us through how the policy is implemented at LACERA? And we can move to the next slide for that.
Yeah, absolutely. So two quick things in terms of implementation. This policy is, this slide is rather complicated, but I'll try to break it down really quick. Over on the left-hand side, it really talks about the interest crediting policy. In the middle, we have all the reserve accounts, and the waterfall graphic sort of marries the two. We apply interest crediting and the realized earnings in a waterfall perspective in terms of applying it to the reserve accounts. So what you might recall is the board memos that I prepare every 6 months with respect to the crediting of the interest to the members' accounts. This is where that is derived from. Essentially, we look at the realized earnings every 6 months. We take a look at the reserve accounts. We figure out what interest can be credited to each reserve. And in essence, if we have enough realized earnings, we can credit the members' account to 3.5%. And literally, our systems team does post interest to the member accounts for the contributions on deposit. So just kind of a high level of what we use the policy for in terms of our application at the accountant level.
And can you also walk us through the role of other parties that are involved? I know you walked us through FASD's role, but if you can also share.
Sure. If we can move to the next slide. So this slide is somewhat common knowledge, I think, by the board. We have an annual evaluation and we have a triennial experience study. I think we all know that as part of the annual evaluation process, Nick measures the funded status as well as determines the contribution rates for the employers and the employees. In order to effect, and let me back up, on the triennial side, that is where we are measuring the effectiveness of the plan actuarial assumptions and methods and making adjustments where necessary. So that happens on the experience study side. As far as effecting the annual evaluation, it really takes three parties. It takes Milliman to calculate the contribution rates. It takes this board to approve those rates, and it takes the County of Los Angeles, the Board of Supervisors, to implement those rates. So we do have those outside parties included. On the experience study side, the triennial side, we have the experience study, we have the annual evaluation, but we add one additional layer, and that is our actuarial review process. So we have another consulting firm come in and review Nick's work. They take a look at the assumption setting process. Does it align with standards? They take a look at the valuation results. Are they reasonable based on their models? So that would be the fourth party we would add sort of on the right-hand side.
That's a second check.
So the second check, yes, we call it the actuarial review process or the actuarial review consultant. Yes.
And Nick or Ashley, just a quick comment on the frequency here of the evaluation cycle. Are we in line with peers or a bit of an outlier with this annual and triennial approach?
Definitely for a system of your size, having annual evaluations definitely in line. Triennial review of the assumptions is shorter than most systems do, but obviously the 37 Acts, it's triennial is what everyone's doing, so it's definitely consistent there. The only thing I'd add is that, and having the second actuary review our work, there's guidance that should be done within at least at a maximum of every 5 years. Doing it every 3 years makes sense because then they review when we recommend changes in assumptions, and having that second set of eyes on the assumptions, I think, is the most valuable part of that review process. So definitely think the cycle makes sense.
And the CERL requires at least triennial valuations, and you're absolutely within the mainstream. I don't actually know of any CERL system that does not have an annual valuation. And then the triennial opportunity to do your assumption checking, experience study, and also the review is also in line with your peers.
Thank you. So now let's advance from implementation to structure on the next slide. Nick, if you can help us recall the core elements we covered earlier in the discussion, and perhaps with Ted's help, walk us through how LACERA's own funding policy aligns or addresses these core elements.
Obviously, we talked a bit about the funding goal and that LACERA has a goal of hitting 100% funding ratio, which we definitely concur with. The next ones are the actual methods, which are basically how we're going to calculate the contribution rate, and what, as we talked about, LACERA is well within the norms. The actual asset method smooths year-to-year contribution rate volatility, and also the layered amortization we think works well. I think what's interesting is to actually look at how it's worked, but I think in order to keep things slow, I will spare you going through the historical pattern of how the contribution rate has moved down. But I would just say quickly, without going to that slide, the normal cost has been very stable over the last 20 years. It has not moved very much. The unfunded liability contribution has moved up and down quite a bit. And we've talked about part of the reasons for that, obviously the dot-com and the financial crisis, caused significant drops in assets. And that was combined with the challenging environments of declining interest rates and declining investment return assumptions. So we definitely saw a lot more volatility in practice on the than we would ideally like to see. But if you look at the employer's contribution rate, I think over half of the 37 Act systems went up over 40%, whereas LACERA's, I think, LACERA's employer contribution rate is capped out at over 25%. So things have worked, I think, fairly well.
So I want to add just a couple of quick comments. In looking at sort of the right-hand part of the slide, the LACERA funding policy elements, I think it's important. I think that we're starting to show that LACERA sort of checks all the boxes and has some of these core elements. What I think is really important, and it might sound repetitive in this discussion here today, but is that we are using all of our actuarial tools available to stabilize those employer contribution rates, to smooth out our asset return volatility. Again, and I think for this last experience study, Nick and Milliman was instrumental in terms of making sure they were fully vetting the assumptions and going through all of our options, and making even some of those fine tuning and some of those additional tweaks, like, for example, the 5-year smoothing with offsets. That was something that was new to me, but Nick said, hey, it's important. It does ultimately impact that employer contribution rate. Let's take a look. Let's see what the board says. And the board did, in fact, adopt that. So we have the 5-year smoothing, plus we have the offsets. And that's the complicated one that Nick said he can explain.
Yeah. Smoothing upon smoothing for simple
Right.
terms.
So again, using our actuarial toolbox to help manage the fund in terms of the flows, the contributions, as well as the investment earnings. I think that's important.
One thing missing from these core elements is any guidance regarding reviewing and revising the policy absent any legislative triggers. So as we heard earlier in the discussion, the last time that we visited the policy structurally was back in 2013 with PEPRA. So absence such a legislative trigger, a question for Ashley is, if we do move in that direction, what should we be thinking about in reviewing it again, absent some of these legislative triggers?
I think it's good policy to, it's good policy to have a trigger built into your policy as to when you're going to review it, just like most of your other policies. And my recommendation would be that you consider reviewing it every 3 years. You look at you have your experience study every 3 years. There may be changes in the law that need to be reflected in your funding policy. There may be changes in your valuations as a result of your experience study that should be reflected in your funding policy. So if you incorporate a 3-year review into the funding policy, you're just going to naturally trigger that refreshing of the document. And as we talked about at the beginning, this is a really important governance document for you as a board of investments. It's an educational tool for all of you. It's a way in which you you inform your actuary and your staff about how you expect the funding to occur. So I wouldn't let it sit for another 10 years, certainly. And I think 3 is probably the right place to land.
Thank you. And a question for Louis, if we do move forward towards an update or review of the policy here, what would we consider in that exercise from LACERA's perspective? And
Yes, thank you, Cindy, and good afternoon. If we can go to slide 21, please. Really, it's a summation of a lot of the conversations that we had, and I just want to touch base on some of the things that we're honed in on. Obviously, benefit security, as well as a stabilization of employer contributions is of the utmost importance. If you look at our mission statement, is to produce, provide, and protect, provide the promised benefit to our members, and it really aligns with our funding policy. And tomorrow you're going to hear about the mission, vision, values, and this statement on transparency, or one of our core values of transparency. And really, how do we bring this to plain language? There was a lot of technicality as it relates to the funding policy, as well as actuarial tactics that we approach, whether it's smoothing or looking at some other amortization processes. But for us, what we want to look at is really taking a principled approach. If you look at the fact that we last looked at our funding policy in 2013, it's an opportunity to really revisit it. And I do want to assure the trustees, as you know, you have an annual evaluation, actual evaluation that we perform, as well as a triennial study. So through that process, we do update the board and make sure that the actuary is presenting recommendations to the board, even though we're not actively engaged in updating our policy. So for instance, if you look at the STAR reserve, we talked about that at the end of June 30th of 2022, as it relates to really separating that as a asset valuation. We also looked at the smoothing, specifically offsetting in 2019, I think, if I recall, and also the 20-year amortization when we used to have a 30-year, and we updated that in 2019. Actually, I think we did that, Nick. So for what we want to do is, as Vache mentioned earlier, is look at the current funding policy, apply some principled approaches, whether it be legal parameters, really spelling out our processes as it relates to our actuarial annual evaluation, as well as our triennial experience study, and then also some other areas as it relates to potentially even our IPS, our investment policy statement. How does that funnel into our funding policy, investment markets? Is there anything in there that we need to update as it relates to having some augmentation to our funding policy as well as to the IPS policy? So those are some of the things that we want to take back to the collective group, the team, for them to review and bring back to the board for discussion and potential revision of the funding policy.
Thanks, Louis. We have one more slide, and my colleague Calvin will just wrap it up, give us the conclusion and next steps, if that's okay.
Yep.
Okay. Thank you.
So as we wrap up our review of our actual funding policy, I'd like to highlight a few key takeaways from today's discussion, which have been enhanced and enriched by the diverse perspectives of all the participants. From our dialogue, we learned that the Board of Investments carries a fiduciary duty under California law for overseeing LACERA's actuarial funding. Conducting periodic reviews reinforces this responsibility from a governance perspective. Furthermore, the funding policy serves as a platform for the BOI to articulate the guidelines, which guides LACERA's actuary and staff in implementing funding decisions. We have delved into the core elements of a funding policy mandated by both legal requirements and actual standards. We reviewed our implementation of the policy and how LACERA compares relative to its peers. Additionally, we have explored the 5 principles to reflect upon as we update the policy. Moreover, we have initiated the early phases of considering potential enhancements to LACERA's existing policy. Now, looking forward, our next steps would involve thoroughly considering the feedback from the board and preparing a initial draft of the next funding policy, Subsequently, we'll engage in further discussions and make additional refinements before arriving at the final version. And lastly, I'd like to express my gratitude to the panelists and our trustees for the engaging conversations today. Our collective efforts will not only provide financial stability, but also advance our commitment to delivering the promised benefits to our members. And once again, thank you all. And now we'll open up for any comments and final questions for our panelists.
Any last thoughts? Yes.
I'm sure you guys have already worked through this because we recently updated a previous policy and I really liked the process. So I'm sure you've already thought through how we're going to step through this. But I really do like the last time, I don't remember which policy it was that we updated, but it was broken down. I think it was last year during this same offsite event. It was broken down into sections. And then we were able to add comments and feedback. And you guys said, well, this is what's currently there. These are some recommended changes. And then we added some feedback to that. So I don't know, is that already in the works?
Oh, well, I believe that's you're referring to the investment beliefs, but as we are going through the next phase of this process, we'll take that input and and provide the board with a report, a version of it. So
I thought the process, I don't know if anybody else has feedback, but I thought it went really smooth and probably quicker than it could have if, with you guys giving your recommendations and then us giving our input to it.
Right. You're just saying being given the red line with the sort of highlights, or?
Yeah, so it was the other document had the current verbiage, but then it also had like staff's recommendation.
Right.
Yeah, off to the side. And then we put our input in.
I think that was like more like the vision and belief statements, which I think was open to a more community. I think this is a little bit more.
Yeah, this tends to be a redlined
yes, more of a legal document.
No, I understand.
Yeah.
But I guess, and however you're going to work through the process, great. Just, you keep it simple. That was the objective of what I was saying.
Okay.
In short.
We got it. All right. Cool. Any other comments?
No.
Yes.
I'm sorry, I don't want to be the person that at the very end asked the last question, but I
do it.
I just can't help it. And this for Mr. Grable too. I'm recalling something that we were talking about this funding liability in a past meeting, and I have a question for you, Ashley. Also, I know the actuary recommendation 100%. That's what we want to get, but I seem to recall something about not having 100% liability, and in the spirit of agility, it created liquidity for us to. Am I recalling that correctly, or did I dream it? I mean, is there a negative impact of 100%?
I think that the context could be that we're mature pension, cash flow negative. Hence, we spend a lot of time focused on liquidity management, but also part of the strategic asset allocation exercise will focus on the liability just to make sure that at all times we model sufficient liquidity, based upon different scenarios. So that may be the linkage between that and the actuarial discussion.
Okay, and then legally, I understand that we are bound to acknowledge the actuarial report, but under SERL, are we required to be 100% funded? In the generalization, we're required to ensure funds are available, but
Right. No, you couldn't possibly be required to have 100% funding because the assets do what they do in the markets. I mean, that would be an unrealistic requirement. What you're required to do is plan for the future, well stated, and make sure that the term that's used in the case law is actuarially sound. I think a lot of actuaries don't exactly like that terminology, but what the way that I interpret that is you have a prudent means by which to fund the plan so that you have a reasonable and sound expectation that you're going to have enough money on hand to pay the benefits when they're due. Could we just go back to slide 20? I think we didn't even stop there. And we spent a lot of time on this slide. So I just want to make sure that folks see it, because these are the principles that should guide any funding policy. And benefit security is the key. That doesn't mean you're 100% funded today.
Yeah, and just to tell you my logic chain, it's in context of that recollection of liquidity. In a previous discussion, I thought we had talked about, having the agility, and there is some.
Well, we grazed over we went over a topic a little pretty fast about sort of surplus earnings and interest crediting. And there is absolutely a component under the Searle system framework where you should be addressing interest deficiencies in prior years before you start spending money on other things. And so the way that your funding policy works is it does that. It doesn't take each year independent of the last and view it as unrelated. It views it all together. And if what you need is liquidity, then you manage for that. And your funding policy may actually end up saying that. And there's a reference to the IPS here as well.
Okay. So I think we're at the end of our comments. We have an opportunity for good of the order today and tomorrow, but if you feel like you need to enter into the record a good of the order today, speak now or forever. All right. So with that, I just want to thank everyone. This was a lot of material. I want to thank Mr. Grable and his staff and all of the staff that participated in getting today ready, and to all of our consultants and to all of our experts who came to help us through these, meaty topics, and quite frankly, to all of us for remaining engaged all the way through. That was it's been a long day with a lot of intellectual. I think it's Mila time. So so on that note, I will consider us adjourned for the day, and we will see you at dinner tonight for those of you who are attending. Thank you.
Thank you.
Recording stopped.
I was like, wasn't just me? Good job collectively. I know you guys did a lot of heavy lifting. I think this, I think this should be part of